Yes, everyone. So, hello, hi, namaskaram, and good morning, students. I hope you guys are having a crazy, amazing day. If not, let us make this a crazy, amazing day, my dear warriors. So, welcome to CA Final AFM Rocket Revision series. Yes, your FR paper is over. You guys are having 1.5 days to prepare for your AFM. Yes, in the next 5 to 6 hours, we will ensure that we cover 60 marks of your AFM in a rocket way, wherein we'll understand the concepts, see tricky adjustments of the questions as well, so that you guys get a head start. Now, yes, couple of important pointers for you guys. Yes, point number one. Yes, this video is going to be applicable for CA final students as well as subsequently, if any CMA final students are going to watch, this is going to be applicable for them as well. Point number one. Point number two. What all chapters we'll be covering in this rocket revision series? We'll start with the chapter equity valuation, then we will go for bond valuation, then we will do mergers, then we will do portfolio, then we will be doing mutual funds. Is this clear? Approximately around 50 marks we will be covering in the next 6 hours. Concepts also we will be discussing. Yes, important question adjustments also we will be doing. Is this clear, everyone? Yes, important files. Yes, whatever we are discussing. Yes, most of the files we have uploaded on the Telegram group Think with Tabish. So please go to the Telegram group Think with Tabish. Their important resources are available for you guys. Super 100 questions also we've made it available for you guys. For the last day revision, yes, a theory PDF approximately 30-40 pages. Yes, gives you a complete coverage of theory. That PDF is also available. Yes, if you guys want to have, yes, a theory revision video, theory marathon is also available on YouTube, my dear students. Now, before we go ahead, yes, please do let me know, yes, your name, yes, which place you are from, so that I can accordingly see where you guys are from, so that your friends can also see, okay, boss, we are having, yes, students from all across India for the marathon, so that we can have a fun, interactive, full energy oriented marathon, my dear students. Now, just to give you guys a very simple thing, yes, I'm having a very bad throat. Okay, yes, doctors have advised me that, okay, for the next 15-20 days you should literally not speak at all. Okay, and literally after every 5 minutes of speaking, yes, my voice goes off. Okay, still for you guys, we are coming up with so much of efforts. Okay, yes, I really could not, I had planned that, yes, we will do it live together on YouTube, but I'm not in a position to speak. Every 10 minutes I'll have to be taking a break, or else my voice will literally die off. Okay, so what I did is, yes, the last 3 days I sat, every day I took, yes, I recorded 10 minutes, okay, I took break of 10 minutes, 10 minutes, 10 minutes, 10 minutes, 10 minutes. That way I have recorded, and this will be premiering live on YouTube, my dear students. Yes, the efforts I hope is going to make justice for you. Trust me, that much efforts we put. If you have loved means, yes, boss, please do put a like. Yes, we'll keep a like target, boss. Yes, we have put in a lot of effort. Okay, this is the first time with so much health issues I'm recording it for you guys. Yes, so that we can help you in the last day revision. Please do like it. Please do share to all your friends. Tell some crazy marathon is coming, crazy rocket revision. Yes, for students who are watching it subsequently, know that this is a rocket revision. One day before examination, we are not here to explain all the concepts. Quickly, we'll tell the concepts. We'll see the important adjustments of questions. Okay, if you guys want to know the concepts, there are detailed revision videos available. Please do watch that. Is this clear? This is going to be a rocket revision, quick rocket revision. Okay, yes, and yes, after you finish watching, if it has made value to you guys, please do put in your valuable comments, so that students who are coming subsequently get to see that and get to know how much validation is there. Is this clear, everyone? So you guys are only our marketing tool. Yes, you guys, yes, have to study properly. You guys are having 1.5 days for your examination. Know that this is going to be the last examination you're going to write. Have that mindset. Whatever happened in FR happened in FR. Boss, this is going to be a new paper. We are going to rock it. We are going to give it our best shot. Okay, so have that. Yes, give your freaking best in your the next 1.5 days. Trust me, AFM is going to be a game changer for you guys. Yes, everyone. So hello, hi, namaskaram, and good morning, students.
Good morning, sir.
I hope you guys are doing really well. So we are discussing chapter 1A, which is equity valuation. In that, we have successfully finished unit number 1, which is valuation of equity shares. Now, at the end of every unit, at every session, once the concept gets over, we are revising. At the end of the video, we are revising. At the start of the next video, we are revising. But still, at the end of a unit, we'll be having a comprehensive revision of that particular unit. And we'll be making it available, so that any point in time you want to refer, you can keep referring to that. So we'll be revising the concepts also, and important tricky adjustments also in a single video. Quickly we will be revising. It is going to be a quick rocket revision. Is this clear, everyone? Perfect. So let us start with the chapter equity valuation. Before that, yes, we had seen unit 0, wherein we have understood value of an asset. Value versus price. Value means how much benefit I am getting, or how much price I should be paying, versus price means how much price I am actually paying. Yes or no, everyone? Perfect. I have purchased an asset. How much benefit I will be getting? I will be getting future cash flows. Yes or no, everyone? But they are in future. I want to calculate the value today. That means I will discount and bring it to present value. So value of any asset, it is the present value of future cash flows discounted at the required rate of return. Yes or no everyone? Value of a share, from a share what all will be getting? Will be getting dividend, sale price. So it is present value of dividend plus selling price discounted at required rate, which is going to be key. Yes, value of a bond, what I will be getting in case of a bond? I will be getting interest plus redeemable value, yes, or the sale price, whatever the case be. So it is going to be present value of interest plus redemption price discounted at the required rate, which in that case is going to be KD. Yes or no? So on and so forth. I can keep doing for any asset in the world. Perfect. Then we have told decision making framework. Simple. We will purchase only those assets where the value is greater than or equal to the price. Yes or no everyone? Yes, if value is greater than the price, then the asset is underpriced. That means we'll be buying the asset. Yes, if value is equal to the price, it is correctly priced, we will still be buying, because how much return I want, it is giving me. But if my value is less, the price is more, that means the asset is overpriced, we will not be purchasing. If in case we purchase, we will be selling the asset. Is this clear everyone? Perfect. Then we went into some basics of AFM. First we had seen cross multiplication. Yes or no everyone? Yes, I have told, say for example 2 shirt is equal to 1000. That means 10 shirt is equal to how much? Cross multiplication. The pair having a question mark will come in the denominator. The other pair will be going to the numerator. So it is 10 into 1000 divided by 2. I will get my value as 5000. What is 5000? Yes, it is the amount payable for 10 shirts. Yes or no everyone? Perfect. Say for example 2 shirts is 1000 rupees. If I am having 7500, how many shirts I can buy? Again it is cross multiplication. The pair having a question mark will come in division. Other pair goes to the numerator. 7500 into 2 divided by 1000. It gives me 15. What 15? It is going to be 15 shirts. Is this clear everyone? Perfect. Then we have discussed time value of money. Yes or no everyone? Two techniques are there. Yes, either I am going front. Yes, which is going to be called as future value compounding. Yes or no? I am going front, include interest into 1 plus r, or I am coming back. Yes, it is called as a discounting. Yes or no everyone? Yes, eliminate interest divided by 1 plus r. Using that, whatever is possible, everything we have understood just by drawing a line. Simple philosophy for you guys, life philosophy. Any question, any problem in the world, draw a line. That line should be straight, whether you are straight or wrong. Yes or no everyone? Perfect. So with this background, let us come back. Yes, dividend based valuation. Yes or no everyone? Then we had also seen, yes, value, time value of money in case of perpetuity. Yes, in case of no growth. Yes, we have told it is cash flow divided by discounting rate. Yes or no everyone? Perfect. With this on the back of our mind here, let us come to, yes, concept number 1, which is valuation of equity shares. In that we had dividend based valuation, which was our concept number 1. Yes, two situations: if share is held for limited period, or if share is held till perpetuity. If share is held for limited period, say for example 3 years I am holding, what all I will be getting? All the years I will be getting dividend D1, D2, D3. At the end of third year I will be having selling price. Yes, what is value of an asset? It is the present value of future cash flows. So it is the present value of dividend plus selling price discounted at required rate, which is going to be cost of equity. Perfect. Now if share is held till perpetuity, how do I calculate? Three situations can be there. First is no growth, second is constant growth, third is going to be variable growth. Yes or no everyone? Yes, in the regular class detailed logic we have told. Here we are not telling, we are quickly doing a rocket revision. Yes or no everyone? In case of no growth, what is going to be the formula? It is dividend divided by KE. I am capitalizing. Yes or no everyone? Simple example, say for example required return is 10%. And yes, if I purchase the share gives me a dividend of 10 rupees. So what I'll tell, okay boss, if I invest 1 rupee, my requirement is that I should be getting 10%, 0.1. This share is giving me a 10 rupee dividend. That means how much I should invest? 10 divided by 0.1, it is going to be 100. Dividend divided by KE. Yes or no everyone? Yes. In case of constant growth, what is going to be the formula? Gordon's growth model. Yes, value of an asset, it is a D1 divided by KE minus G. Yes or no everyone? Yes, wherein how do we calculate D1? Yes, it is a next year dividend. Yes, it is a D0 into 1 plus G. Yes, cost of equity. Yes, we have discussed in detail how to calculate. We'll come to that. Growth, if it is given in the question, great. If it is not given in the question, we can calculate the sustainable growth rate. How do we calculate the sustainable growth rate? It is retention ratio into
the return on equity. Is this clear, everyone? Yes. How do I arrive at my retention ratio? It is retained earnings divided by Patesh. Yes or no, everyone? Or else I can also tell it as 1 minus dividend payout ratio. Return on equity. Yes, it is a return divided by equity. Tell me how much profit we are generating for our equity holders. It is the Patesh divided by equity. Equity is nothing but my equity, which is equity share capital plus reserves and surplus. Yes or no, everyone? This is on a total basis. If you want on a per share basis, means Patesh divided by number of shares becomes EPS divided by total equity divided by number of shares becomes my BVPS, book value per share. Yes or no, everyone? Perfect. We had also seen the income statement and balance sheet from AFM perspective. Yes or no, everyone? Perfect. So income statement, we've told that we'll start with sales. Sales minus cost of goods sold gives me my gross margin, gross income. I will reduce my other operating expenses. I will arrive at my EBIT, also called as my operating margin. From that, I will reduce my interest. I will arrive at my EBT. It is also called as taxable income. I will reduce my tax. I will arrive at my profit after tax, also called as net income. From my profit after tax, it is for two people, equity and preference. I will reduce preference dividend. I will arrive at Patesh, profit available to equity shareholders. From that, if I reduce my dividend distributed, I will arrive at the retained earnings. Is this clear, everyone? Perfect. We had pro forma balance sheet and basic ratios not needed at all. Is this clear, everyone? Perfect. This is also over. Then comes variable growth. Very important from an examination perspective. Students think it is very difficult, but trust me, it is one of the simplest things. Now tell me, students, the simple philosophy of constant growth. Yes, it is value of an asset today. It is the next dividend divided by KE minus G. So if in case I want to calculate the value of an asset at 5th year, I am standing at the 5th year, the next dividend, it is D6 divided by KE minus G. Accordingly, for any number of years I can be doing. Perfect. In case of variable growth, what is happening is, for the initial few years, the growth will be different. Question will tell you 10%, 5%, whatever it is, question will specify. After that, my growth will stabilize. So how to do the calculations? We have told 3-step framework. Step 1, I will estimate the dividend for uneven growth. Say for example, question is telling first 5 years growth will be 10%. So first year what is dividend, second year what is dividend, third year what is dividend, fourth year what is dividend, fifth year what is dividend. Yes, I will estimate. Yes, draw a line, D1, D2, D3, D4, D5, estimate. At the end of 5th year, question will tell 6th year onwards growth will be 8% perpetuity. That means tell me 5th year onwards, that is 6th year onwards, every year growth is going to be same. That means can I calculate price at the end of 5th year? Yes boss, it is D6 divided by KE minus G. So step number 1, I will calculate dividend for the uneven growth period. Step number 2, I will calculate price at the end of uneven growth. Yes, so price at the end of uneven growth, it is next year dividend divided by KE minus G. Now I have all the cash flows. I have dividend also, sale price also. What is it I need to do? Bring it to present value. I will arrive at the value of my share. Yes, calculate value of the share. Yes, which is present value of dividend and price. As simple as that. Yes or no, everyone? Yes, additional pointers for us to be kept on the back of our mind. Yes, should we consider D0 or D1? If question specifically tells dividend paid, or if dividend is given in our income statement, we will take it as D0. Otherwise, always we will be taking it as a D1. But still, if you are having too much ambiguity, it is better to take both the assumptions, do the calculations, and accordingly give a note, or take it as a D1 and give a note in the examination. Perfect, everyone. Now, additional pointers which we will have to be keeping on the back of our mind. First is calculation of cost of equity. How do we calculate cost of equity? Either it could be given in question. In that case, no tension. If it is not given in question, there can be 3 different ways. Either if beta is given in the question, I know I will be calculating the required rate using CAPM model. Yes, my required rate of return, it is a risk-free rate plus beta into RM minus RF. Perfect. No, beta is not given. But all other data as per constant growth is given. Price of the asset is given. D1 is given. Growth is given. I can calculate it as a missing figure. I know price of an asset or value of an asset is D1 divided by KE minus G. Only this is missing. Yes, I will keep it as KE. Solve the equation, arrive at cost of equity. Perfect. In all other situations, this comes normally in case of variable growth. That is, there are different dividends. There is a price at the end. Today's value of the share is given. But how much return I am generating, I don't know. Yes, we will be using the concept of IRR, that is interpolation technique. That is, first a random rate I will try pulling, I will see is it the value of the asset, or else I'll change the rate. Accordingly, using interpolation technique, we will arrive at, yes, the cost of equity. Is this clear, everyone? Perfect. So this was our concept number 1, which is a dividend based valuation. Yes, next we are having concept number 2, which is going to be other methods of valuation. There we had altogether 3 points. First is earnings based valuation, next is a relative valuation, next was miscellaneous areas. First, earnings based valuation. In that we have earnings growth model. Instead of dividend, I will be taking earnings. So it is EPS 1 divided by KE minus G. Perfect. Next we had Walters model. Not important at all from an examination perspective, but I had given you guys a beautiful shortcut to build formula. Yes, what was a golden statement that I told? Yes, it is based on earnings. So you have dividend also, retained earnings also. So we have told capitalize dividend plus double capitalize the return that you are getting by reinvesting your retained earnings. Capitalize dividend, that is a D divided by K, plus double capitalize the returns you are getting by reinvesting your retained earnings. Total earnings is E. In that D, if you eliminate, you will arrive at your retained earnings, E minus D. Yes, you are reinvesting, you are getting into R, which is the return on equity. You've got the earnings. Now what we'll have to do? Double capitalize divided by KE square. Is this clear, everyone? Perfect. Next we had a relative valuation, which is PE ratio based method. What on earth is my PE ratio telling? PE ratio is telling, yes, for 1 rupee earning, how much price I am paying. If my PE ratio is 8 times, it means to get 1 rupee EPS, I am paying 8 rupee price. Yes or no, everyone? Perfect. How much price I am paying to get 1 rupee EPS? Two formulas are there. First is a normal formula. PE ratio is P divided by E. P is the price, which is MPS divided by EPS. There is one more formula also, yes, which is PE ratio is equal to 1 divided by KE. In the regular class, I have given you the logic, yes, but it is just inverse of the required rate of return. Is this clear, everyone? Perfect. Yes, or ROE. KE will also be given as ROE sometimes in the question. Yes or no, everyone? Very simple thing. Say, for example, investor's required rate of return is 10%. That means he is telling, if I invest 1 rupee, I want to 0.1 return. Yes, PE ratio is telling for 1 rupee EPS, how much I should be paying. So it is 1 divided by 0.1. As simple as that. Is this clear, everyone? Then we had one final thing, yield based valuation. It had its own set of limitations, but still, because the question is there, it is our duty to simplify, do it logically, so that if a question comes, we crack it. Now, before we go into yield based valuation, to advance the ratios we should be knowing. Yes, what are those two ratios? First is interest and fixed dividend coverage ratio. Perfect. So it is telling, yes, to pay my 1 rupee of fixed financial obligation, how much profit I am having. Tell me what all fixed financial obligation I am having. Yes, financial obligation, yes, I have to pay to 3 people. One is equity holders. Is it fixed? No. Next I am having for debt holders. Next I am having for preference. What all is fixed? I am having for preference shareholders as well as for debenture holders. So what is my fixed financial obligation? It is preference dividend plus interest. Now how much profit we are earning for these people? Tell me, for preference dividend, how much profit we are earning? It is a PAT. But this profit is after paying interest. I want to know how much profit I am earning to pay my preference dividend plus interest. So I will be adding my interest. Is this clear, everyone? So the formula is PAT plus interest divided by preference dividend plus interest. So the higher it is, the better it is. It means that more profit I am earning. Yes or no, everyone? So the higher it is, the better it is going to be. Next is going to be capital gearing ratio. It is telling for 1 rupee of own fund, how much outsiders fund I am having, or how much fund at fixed obligation I am having. Yes or no, everyone? What is my own fund? It is my equity share capital plus reserves and surplus. Yes, how much fund I am having at a fixed rate? I am having preference share capital plus debentures. Yes or no, everyone? Tell me, ideally I should be having more of my fund and less of outsiders funds. So the lower it is, the better it is going to be. Is this clear, everyone? Perfect. Now once this is clear, if we are having a question on yield based valuation, how to do? First, we will prepare income statement. EBIT will be given. From there all the way till retained earnings, we will do the calculation. Chill. Step number 2, we will calculate the actual yield percentage. How to calculate actual yield? Question will specify Actual yield is 50% of income distributed and 5% of undistributed. Question will tell how to calculate actual yield, we will calculate. We always want a return in percentage, so we'll convert it into percentage. So it is actual yield divided by, it is a yield for equity. So technically it should have been equity, but ICA puts equity share capital only. So I will write divided by equity share capital into 100. Perfect. Step number 3, we will calculate the required ratios. That is interest and fixed dividend coverage ratio as well as gearing ratio. I will calculate. Step 4, I will calculate deviation in the ratio. How much is the benchmark? How much is my ratio? What is the deviation? Using that, I will calculate step number 5, required yield. What is the required yield? Yes, it is a return on similar companies plus the risk premium for not meeting the targets. Yes or no, risk premium based on the shortfall. That will be the required yield. Using this, we'll calculate value of a share. Value of a share, it is nothing but face value of a share into actual yield percentage. That gives me the actual return every year. Yes, I will bring it to present value divided by required yield. We will arrive at the value of the share. Is this clear, everyone? Perfect. We have taken 17 minutes, but in a very detailed way, we have tried covering everything. Now, quickly, tricky, important adjustments of the questions also. Let us try doing it quickly, my dear students. Let us also try seeing some tricky adjustments from questions as well. First, coming to question number 2, what is happening in the question? Question is telling me the existing beta, but question is telling we have taken a decision due to which beta is changing. Calculate the existing as well as revised price of the share. Yes, I will write down existing beta, revised beta. Based on the existing beta, I will have the existing required rate. Based on revised beta, I will have the revised required rate. Using that, I will calculate the existing price of share, D1 divided by KA minus G, existing KA. Yes, I will also calculate the revised price of the share. Simple, but may come in your examination. Then we have got question number 4, wherein what is happening is, first one is a simple case. Second, they are telling, calculate the equilibrium price when the inflation premium increases by 2%. Yes, risk-free rate of return in the question given is 7%. And we have told in the class, why on earth, yes, government or securities or bank is giving me risk-free rate, it is to tackle inflation. So if my inflation increases by 2%, that means my risk-free also increases by 2%. My RF becomes 7 plus 2, 9%. Yes, my market was previously giving me 13%, but boss, inflation overall everything has gone up. That means this will also give me 2% more. My RM will become 15%. Accordingly, I will be doing my calculations. Is this clear, everyone? Yes. Then we go to. And how institute does this? There are 3 things. Institute assumes that all 3 are done together in the same situation. That is, my inflation is increasing by 2%. Along with that, growth is increasing by 3%. Along with that, beta becomes 1.3. In that line, yes, institute is solving. Next, we are going to question number 7, my dear students. Yes, again, a beautiful question had come in the examination. Now, what is happening? Here, the most important thing is to draw a line and estimate what is happening. Yes, company is considering to purchase equity shares, market price is given. Company is proposing a dividend of 4 for the next year. What kind of dividend it is? It is a D1, point number 1. Company is expected to grow at 20% per annum for the first 4 years. That means first year, second year, third year, fourth year. Growth is going to be 20%. Is this clear, everyone? The growth will decline linearly to 16% per annum. So what is happening? Look at this, students. First year my growth was 20, second year growth was 20, third year was 20, fourth year was 20. Slowly it will linearly decrease to 16%. That means slowly 1% by 1%. Fifth year will be 19, sixth year will be 18, seventh year will be 17%, then it will be 16%. Is this clear? D1 is given as 4. Accordingly, I will add my growth and arrive at all the dividends. Now, at the end of 7th year, I know that 8th year growth is 16%. From there on, till perpetuity, my growth is 16%. So, I can calculate price at the end of 7th year. P7 is D8 divided by KE minus G. Accordingly, I will get all the values, bring it to present value. Is this clear, everyone? Then we had question number 8. This is also a similar question only, but the only difference here is that, yes, at the end of uneven growth, when we are estimating price, the constant growth rate is not given. We know that when one person goes from our life, other person will be there in our life. Whoever goes will take it as X. Yes, constant growth it is not given. I will take it as X. To compensate for that, we were otherwise calculating price. Here price is given. As simple as that. So look at this, everyone. Proposing a dividend of 6. Proposing means first year dividend. Okay. Grow at 20% for 4 years. Okay. Thereafter, over the next 3 years, it will linearly reduce by 100 basis points. That means 1% it will reduce. Okay. Thereafter, it will stabilize at a certain growth rate. How much it is not given. Okay. Yes. Calculate the stable growth rate at the end of 7 years. So how is it that we are going to do? Yes, we know that. Yes. First 4 years growth is 20 percentage. Okay. First 4 years we will estimate the dividends. Yes. Next 19, 18, 17 it is going to be. Yes. 8th year how much is the price? Yes. Sorry. 8th year how much is the dividend? Yes, at the end of 7th year, what is the price? P7 is a D8 divided by KE minus G. Yes, D8 is nothing but D7 into 1 plus G divided by KE minus G. KE I don't know. Either I'll keep it as KE or I'll keep it as X. Accordingly, I will arrive at P7. Yes, accordingly, I'll try calculating the present value. It will be in terms of X. I will calculate. I will arrive at growth as 16%. Perfect, everyone? Yes. Now we had question number 9. It was a very pretty simple, straightforward question. But beta was not given directly. Now the approach to calculate beta we will be learning in detail in the chapter portfolio management. So temporarily we have one formula which we'll have to be knowing. Don't worry, in the chapter portfolio management in detail we'll be doing beta of security X. It is RXM, that is correlation between security and market, into sigma X, that is standard deviation of security X, divided by sigma M, which is standard deviation of market. If you know that, there is absolutely nothing else in the question. Perfect, everyone. Then comes question number 10, calculation of sustainable growth rate. Simple question it was, all data is given but sales is not given. But to compensate for that, asset turnover ratio is given. Tell me what is the formula of asset turnover ratio? Turnover divided by asset. Yes, it is given as 1.1. Asset is given as 600. That means my turnover is going to be 660. Once I got that, I will arrive at my all calculations all the way from sales till my retained earnings. Once I arrive at that, to calculate my sustainable growth rate, it is my retention ratio into return on equity. We know how to calculate retention ratio, yes or no, everyone? It is retained earnings divided by Patesh. Return on equity, it is return divided by equity. For my equity holders, what I am earning? It is my Patesh. Yes, divided by equity, it is equity share capital plus reserves and surplus. Once I have got that, I will arrive at my sustainable growth rate. Using that, I can be calculating price of the share as well. Perfect, everyone? Yes, everyone, there was one more adjustment which was given in question 12. Question 12 is exactly similar to question 10. Only one adjustment was new. Yes, what was that additional adjustment? Yes, question has asked, when is the 10% bond issued? See the students, there are two, yes, external funds. One, I am having 8% debentures. Okay. Next, there is a 10% bond which is issued in the year. That means somewhere in the middle of the year. Yes or no, everyone? And question is telling me that my effective interest rate is 8% only. There are two ways for me to calculate. Yes, for how many period, yes, this loan was in force. Yes, option number 1 is, I know that my total interest, it is the total loan amount, yes, into 8%, which is 14 lakhs. In that, for the first loan, it is for the full year. That means I will be charging full 8%. For the second loan, yes, it is principal into 10% into how many months it was there. I don't know. I will take it as X divided by 12. Yes, I will solve. I will arrive at the value of X as 9.6. That means I have paid interest for 9.6 months. That means when was the loan taken? Total 12 months in a year. 12 minus 9.6. Yes or no, everyone? This is start of the year. This is end of the year. For 9.6 months, I have paid interest. That means for 2.4 months, I have not paid interest. That means after 2.4 months, I have taken the loan. This way we will be doing it. 1st April means plus 2.4 months. First month is April. Second month is May. Yes, 2.5 months is somewhere in the middle of June. Is this clear? This was a detailed approach. But to calculate this 9.6, I had given you guys a simple shortcut as well. Now this 8%, anyways, it is 8% only. Tell me, total interest is 10%. That means if I am paying interest for 12 months, it will be 10%. But I am paying 8% only. That means what is, yes, what is the period? It is 8 into 12 divided by 10. It is 9.6 months. As simple as that. Is this clear, everyone? Yes. Perfect. This is again a very simple question. We are having question number 14, where question is telling that company just declared a dividend of 2 rupees. Okay, current growth rate is given. Using that current price I can calculate. But board decided that, boss, next 3 dividends now we are retaining and we are taking up a project. We will have to tell how this decision by the board has impacted. How will we tell? By comparing the price. In the first case, is existing position, D naught is given, growth is given, K is given. Accordingly, I will calculate price. Second case, First year, second year, third year, I am not getting any dividend. But fourth year, I will get dividend. And from there on, 7% it will keep growing. Tell me, so can I calculate price at the end of third year? Yes, boss. It is D4 divided by KE minus G. I will arrive at price at the end of third year. But boss, it is at the end of third year. I want today. So I will come back 1, 2, 3. So I will divide by, yes, 1 plus R to the power of 3. It is plus 1.08 to the power of 3. I will accordingly arrive at price after the decision. That was requirement number 1. Then we had a requirement number 2, which said that, boss, there is an investor. He wants at least a cash flow of 2000 per annum. How he can be doing? We told, boss, next 3 years dividend we are not giving. But if he wants cash flow, there is one option. He can sell some shares, yes or no, everyone. So every year, how many shares he should sell? We'll have to be doing the calculation. Yes, we got that price at the end of third year is 250. Using this, I can keep coming back and calculate price at the end of every year. My required rate is 8%. That means divided by 1.08, I will arrive at price at the end of second year. Divided by 1.08, I will arrive at the price at the end of first year. Divided by 1.08, I will arrive at the price today. Is this clear, everyone? So if the investor wants at least 2000 every year, first year the price is going to be 214.33. That means number of shares to be sold. Yes, 2000 he wants, divided by 214.33, it comes to 9.33. If he sells 9 shares, he will not get full 2000. So he has to sell a higher share. It comes to 10 shares. That means balance will be 990 shares. Second year, you will do the calculation. Third year, you will do the calculation. With this, the entire unit, all adjustments of all important questions we have done, students. I hope you guys have thoroughly enjoyed. This way, for the entire subject, we will be doing a quick, rocket, effective revision of concepts as well as questions. Yes, everyone. So hello, hi, namaskaram, and good morning, students. Good morning, everyone. Perfect. Now we are going to have a quick rocket revision of unit 2. We are discussing chapter 1A, equity valuation. In that, unit 1 was valuation of equity shares. Unit 2 is going to be other special areas. We are having altogether 3 different pointers. First is in case of bonus shares. Second is in case of buyback of shares. Third is in case of right shares. Beautiful, simple discussion. Now, in case of bonus shares, what is happening is company is issuing bonus shares based on which number of shares will increase. Say for example, we are telling company has issued a bonus in the ratio of 1:4 in the third year. Then what will happen? We will always be solving question on the assumption that we are originally having 1 share. So first year we had 1 share, second year we had 1 share. Third year bonus will be issued in the ratio of 1:4. That means we'll have our existing 1 share plus extra bonus 0.25 shares. So we'll be having 1.25 shares. Next year as well as fifth year we'll be having 1.25 shares. Perfect. Now when we are calculating dividend for first and second year, we'll be calculating on the assumption that we are having one share. Yes, on the year when bonus share is issued, we will assume that first we got bonus share, then on the increased number of shares we got the dividend. Is this clear? Accordingly for the next year. Perfect, everyone. Last year sale price, question has told me that my sale price is 700, but tell me, when I'm selling, am I having 1 share? No, now I'm having 1.25 shares. Into 1.25 share gives me the total sale value. But wait, boss, I'll have to be paying incidental expenses. Minus incidental expenses gives me the net cash. So I've got all the cash flows. I will bring it to present value. I will arrive at the value of the asset. Is this clear, everyone? So this is going to be the format. Yes, I will draw a line. I will estimate all the cash flows. Year, number of shares, total cash flow. It will be dividend also or sale price also. Present value factor, present value. I will add all of that. I will arrive at the value of the share. First requirement done. Second requirement, question will tell you that suppose price is 500 and incidental expenses is 5%. Is it worth to buy the share? Assume value of the share is 575 randomly. Yes, purchase price. Today to purchase, what all I am paying? I am paying purchase price plus the incidental expense. So it is 500 plus 5%, 525. My value, benefit is 575. I am paying 525. Net benefit is positive, so I will be purchasing. Yes or no? It is present value of cash inflows minus present value of cash outflows. What all I am paying? I am paying purchase price plus incidental expenses. Perfect, everyone. Third requirement could be, what is the maximum amount I can pay? Yes, the maximum amount payable is going to be equal to the value of the share. Yes or no, everyone? Say for example, value of the share is 575. That means I will tell maximum I am willing to pay 575 today. But today what all I should pay? I should pay purchase price also, incidental expenses also. Question is asking me how much should be the purchase price. Whatever I don't know, I'll take it as X. Suppose purchase price is X. Incidental expenses will be given as a percentage of purchase price. Assume 5%. So 0.05x will be equal to 575. Solve. Arrive at the value of X. First requirement, bonus shares is over. Perfect, everyone. Then we had our next concept, which is buyback of shares. Here, yes, mathematically it can get very difficult, but we've cracked it. We've prepared a very simple format in which, in a very easy way, we'll be in a position to solve the question. So we'll quickly look at the example and quickly get to know what exactly we will be doing. Look at this, students. Question is telling me that we are having surplus cash of 60 lakh and I want to distribute 30%. That means 18 lakh I will be distributing. Point number 1. We will opt for buyback. Yes, after buyback, the market price will be 10% more than the buyback price. We will assume buyback price is equal to X. Price after buyback is going to be 1.1x. Currently, my number of shares is equal to 6 lakh and question is telling me that the market capitalization after buyback will be 130 lakhs. Perfect, simple, this is all that we need. Now look at this, everyone. Assume 100 shares were there originally. We purchased back, we bought back 10 shares. What is the revised number of shares? 100 minus 10, 90. So I will write it in this format, particulars, number of shares, price, value. Yes, original number of shares minus buyback gives me the revised number of shares. Original number of shares is 6 lakh. Price and value is not given, it is not needed also. From that, I will reduce the buyback. Tell me total how much amount I can distribute it as buyback? 18 lakh given in the question. Buyback price, I don't know. Whatever I don't know, I will take it as X. I have taken it as X. That means how many number of shares I have bought back. For one share, I am paying X. That means 18 lakh, how many shares I can buy back? It is 18 lakh divided by X. That means, can you guys tell me the revised number of shares? Originally, I had 6 lakh minus buyback gives me revised. It is 6 lakh minus 18 lakh by X. That is the revised number of shares into the revised price. Question told it will increase by 10%. It becomes 1.1x. Will give me the value. Value is given in the question 130 lakh. I will take this equation, I will solve, I will arrive at my buyback price, point number 1, number of shares bought back, point number 2, revised number of shares also I will be calculating, point number 3. Perfect. Question may also ask what is the impact on the buyback on the EPS. Perfect. We will do it. Look at this very simple framework. Again, I will tell current, proposed, revised. Yes, what is the EPS? Number of shares, total earnings. Right now EPS is 4. How many shares are there? 6 lakh. That means total earnings will be 24 lakh. In a revised situation, question is telling me that earnings will be same. That means it will be 24 lakh only. But number of shares have reduced. So that means I can calculate my revised EPS and then tell what is the increase in the EPS. Is this clear, everyone? So look at this. We have got this format. Number of shares, price, value. Existing minus buyback gives me the revised. Yes, I will assume buyback price is equal to X. Yes, I will calculate the revised market value post buyback. It is revised number of shares into the revised price per share. I will solve and calculate the value of X. Is this clear, everyone? Perfect. Then the next situation, we had another beautiful question wherein if buyback is sourced through loan, what is it we have to be doing? That question had come for 10 marks. Simple. Existing situation is there, that is pre-buyback. Post-buyback situation is there. First, I will write down all the basic data, whatever I can calculate. Once that is done, question is asking me that I will be going for buyback by taking a loan. How much loan I can be taking and how much interest I will be paying, it is not given. Assume loan amount was given, say 100 rupees. I can calculate the interest into interest rate. I can tell how much it is post-tax. Loan amount is not given. Whatever is not given, we will take it as X. So what is going to be our approach? We will assume that our loan amount is equal to X. That means based on that, we will calculate the post-tax interest amount. It is X into the interest rate into 1 minus tax. Perfect. Then we will tell the total earnings post-buyback. It is the earnings before buyback minus the post-tax interest cost. Yes or no, everyone? Perfect. Total earnings post-buyback will be given in the form of basic data for us. Yes, total earnings after buyback is also available. Only this is available in the form of X. calculate the value of x. You will get the loan amount, accordingly you will get interest, accordingly everything will be done. If you guys want a reference of the question, I guess from our question bank it was question number, which question it was? 22, is it? 21. I guess it is question number 21. Same question had come in the case scenario booklet and MTP as well. Is this clear, everyone? With this, buyback is also over, my dear students. Yes, everyone, now we are having concept number 3, which is going to be right shares. Right shares is when company needs additional funds and it raises the money from the existing shareholders in the form of right shares. So my number of shares is going to increase. Existing number of shares plus the right shares is going to give me the revised number of shares. What all calculations can be there? Two major calculations would be there. First calculation is going to be to calculate the theoretical ex right price or post right price. Second is going to be to calculate the value of right. Next is going to be to calculate the value of right per share, and then question may ask you to calculate the impact on the wealth of the shareholders. How do we calculate theoretical ex right price? There is a formula, but let us do it without the formula. Very simple, students. Existing, we are having 100 shares at the rate of 100 each. Yes, right, we are issuing 1 share for every 2 shares held. That means for 100 we are issuing 50 shares at the rate of 80. Ex right price, it is nothing but the weighted average price. So simple framework, I will tell number of shares, price gives me the value. Existing, I am having 100 shares. At what price it is available? 100. That means the value is going to be 100 into 100, 10,000. Plus, in case of right issue, how many extra shares we have issued? 50 extra shares. What price we have collected? 80. That means how much extra fund we got? 4,000. That means tell me what is the total value? 10 plus 4, 14,000. What is the total number of shares? 100 plus 50, 150. That means can I calculate the effective price per share? It is 14,000 divided by 150. It is going to be 93.33. This is the theoretical ex right price without any formula. Is this clear? It is the revised value divided by revised number of shares. Point number 1. Point number 2, the theoretical value of a right. I have told you there can be different approaches to calculate value of the right, but we are going to keep it very simple. From our perspective, we will always see from the perspective of new shareholder, how much benefit new shareholder is getting. Suppose new shareholder subscribes for the right and purchases the share. How much he has to be paying? He has to be paying the subscription price. In this example, he should be paying 80 rupees. Yes or no? Yes. Imagine he got the right share. Yes. At what price this right share is trading? It is trading at the theoretical ex right price, which is 93.33. That means how much is the benefit he got? It is going to be 13.33. Yes or no, everyone? It is value to new shareholder minus cost to new shareholder, or it is the ex right price minus subscription price. It is 13.33. Now, yes, this we will be taking ex right price. If actual ex right price is available, we will take that. If that is not available, we will be taking the theoretical ex right price. Is this clear, everyone? And very important, always whenever you calculate value of right, always also calculate the value of right per share. Tell me, we will be getting a benefit of 13.33 when? Yes, I will be having a right to purchase share only when I am having 2 shares. For 2 shares, I will get the right to buy 1 share. That means this benefit of 13.33 is for 2 shares divided by 2. So the value of right per share is going to be 6.66. Is this clear, everyone? So look at this. This is going to be the format. Number of shares, price per share, you will get the value. Existing number of shares into price, you will arrive at the value. New, yes, right issue, number of shares into price will arrive at the value. Yes, total number of shares, total value, accordingly will arrive at the ex right price. Point number 1. Value of the right, it is a benefit to new shareholder. It is value to new shareholder minus cost to new shareholder. It is ex right price minus the subscription price. I will always calculate value of right per share. It is value of right divided by number of shares to get 1 right. And impact of right issue. If a shareholder subscribes to the right or transfers the right, there will be no change in the wealth. But if he ignores the right issue, then his wealth will reduce. Is this clear, everyone? So with this, we have successfully finished a rocket revision of unit number 2. All the concepts, and trust me, all adjustments of question are also done. I hope you guys have thoroughly enjoyed. See you guys in the next video.
Yes, everyone, let's proceed further to rocket revision on the chapter 1B, which is going to be bond valuation. It is relevant for CA as well as for CMA final students. Firstly, what is a bond? It is a debt instrument which is issued. So that means if I am a holder of a bond or a debenture, I will keep on getting periodically interest as well as redemption price at the end. Point number one. Point number two, yes, what is the difference between a bond and a debenture? Both are essentially the same. The only difference is bond is issued by government. Yes, debenture is issued by large corporation. Yes or no, everyone? Okay, let us look at a simple example. Assume we are Majaa Sugarcane. We have issued a 10 percentage debenture having a face value of 100 rupees and tenure of 4 years, which is redeemable at par, and currently it is issued at 90 rupees. Suppose you purchase the bond. Yes, what all you will be getting? Yes, first year you will be getting a interest of 10, second year 10, third year 10, fourth year 10. With that you will be getting the redemption price of 100 rupees. Yes or no, everyone? Basic terms, face value also called as par value, also called as nominal value. It is a value stated on the face of the bond. On that interest will be paid. Coupon, it is the interest payable. Maturity, how much years is the life of the bond. Issue price, at what price bond is initially issued. Market price, subsequently at what price it is trading in the market. Redemption price, on a redemption at what price the bond is redeemable, how much amount we will be getting it back. Yield to maturity we'll be discussing in detail, don't worry about it. Now different types of bonds for AFM purpose. Yes, first one is redeemable bond. Here periodically we will get interest, at the end of it we will be getting redemption price. Irredeemable bond, also called as a perpetual bond. We will keep on getting interest perpetually, we will never get back our principal amount. Third one is a zero coupon bond or deep discount bond. What are these? These are the bonds which are issued at deep discount, redeemed at par. Say for example, there is a bond of face value 10,000 rupees, life of 5 years. Today they are issuing a bond at 5,000. They are telling we will not pay you interest. But was today if you pay 5,000 means at the redemption 5-year end you will be getting 10,000. So the only income for the investor is going to be the capital appreciation. Is this clear, everyone? Then some other different special types of bonds could also be there. Don't worry, in concept number 1 we will be discussing. Important notes for the entire subject: face value is not given, assume face value is equal to 100. Redemption price is not given, assume it is redeemable at par. Interest rate is always assumed as interest rate per annum unless otherwise specified. Yes, coupon, that is interest, is always calculated as a percentage of face value. Is this clear, everyone? With this, unit number 0 is over. Yes, now coming to unit number 1, bond valuation and yield. I'm taking a second because my throat is completely gone. You guys, okay, can have a sip of water, then we'll continue our discussion. Yes, everyone, let's come to unit number 1, bond valuation and yield. In that concept number 1, bond valuation or bond pricing. Look at this, everyone. Directly, let's start with example number 1. Okay. Majaa Limited issued a 10% bond having a face value of 100 rupees. They are redeemable at a premium of 20% at the end of year 4. Calculate value of the bond in the following situation. Situation 1, if the required yield is 8%. Tell me, why are we purchasing a bond? Because we will be getting any asset, we will be getting future cash flows. In case of bond, I will get interest as well as redemption price. What is value of a bond? It is the present value of future cash flows discounted at required rate. Yes or no, everyone? Tell me, in case of bond, what all I will get? I will get interest plus redemption price discounted at required rate, which is going to be KD. Is this clear, everyone? Okay. In this example, face value is 100. Every year 10% I will get. So 4 years is a life. So first year 10, second year 10, third year 10, fourth year 10. With that, yes, it is redeemable at a premium of 20%. 100 is a face value plus 20%, 120. This is what we will be getting. Present value of this discounted at the required rate at 8%. I will arrive at value of the bond. If I want year cash flow present value factor, present value of the bond is going to be 121.32. Is this clear, everyone? Okay. So what is value of a bond? It is a present value of future cash flows. If I buy a bond, what all I will be getting? Interest as well as redemption price discounted at the required rate. What is the required rate? It is cost of debt. How do we calculate cost of debt? It is the yield of similar comparable bond. Say for example, there is a similar comparable bond which gives me 10%. That means this bond also should be giving me 10%. Is this clear, everyone? Point number 1. Point number 2, if KD is not given but yield is given, YTM is given, we will assume both are same. I will discount at YTM. Is this clear, everyone? Okay. It is not given, we will assume YTM itself is going to be the yield. Now how do we take a decision? Yes, boss, what we have calculated is a value of the asset. Obviously, yes, basics we have told. Yes, value I will compare with the price. If value is greater than or equal to price, only then accept the decision. Yes or no, everyone? Okay. Bond, yes, valuation in different situations. First one, in case of redeemable bond, already we've seen this example. What is redeemable bond? Periodically it gives me interest. At the end of it, it gives me redemption price. What is a value? It is a present value of future cash flows. As simple as that. Second one is going to be in case of irredeemable bond. In irredeemable bond, I will only be getting the interest. I will never get back my principal. Look at this example. Face value of a perpetual bond is 100 rupees. Coupon rate is 9%. Calculate the intrinsic value. So if I purchase this bond, first year I will get 9, second year 9, till perpetual I will keep on getting 9. Tell me what is the required rate? 15%. That means tell me if I invest 1 rupee, what is the return that I want? Yes, 0.15. Yes or no? Now tell me every year how much return I am getting? 9. That means how much I should be investing? 9 divided by 0.15 basics. Yes or no, everyone? Yes, it is interest divided by KD, which is going to be 60 rupees. Is this clear, everyone? Okay. Third one is in case of zero coupon bond. Tell me what is a zero coupon bond? Yes, it is issued at deep discount and redeemed at par. There is no coupon payment. Directly, let us come to example number 2 and see. Okay. Majaa Limited issued a zero coupon bond having a face value of 1 lakh and a maturity period of 5 years. Currently, it is trading at 55,000. It is the actual price. Okay. Suggest whether to buy or not if the required rate is 12%. Tell me, students, if I purchase the bond today, yes, first year am I getting anything? No. Second, third, fourth, nothing. I am not getting any interest. Fifth year end, I will get the redemption price, which is the face value of the bond. Yes or no, everyone? Tell me, where am I standing here? I want to know how much I should be paying. If I purchase the bond, I will get 1 lakh. After 5 years, it is the present value discounted at required rate divided by what is the required rate? It is going to be 12%, 1.12 to the power 5. Yes or no? So I can tell, yes, it is a redemption price or face value divided by 1 plus r to the power n. Yes or no, everyone? Formula is not needed. It comes to 56,742. So value of the bond is 56,000 something. It is trading at 55,000. It is cheap, so purchase the bond. Yes or no, everyone? Okay, simple. It is the present value of redemption price. Draw a line easily, you will be getting it. Is this clear, everyone? Okay. Now comes the special cases. In that, first one is in case of semi-annual interest payment. Simple. Just remember the principle. Ensure uniformity of data. Every data will be for 6-month period. Yes, interest rate, it is given as per annum basis. I will convert it into 6 months. Okay, discounting rate, KD or yield, it will be given on a per annum basis. I will convert it into 6 months period. Years, I will convert it into 6-month period. Directly, let us come into example. Pay attention, example number 3. Majaa Limited issued a bond having a face value of 100 rupees. Interest is 10% per annum, which is paid semi-annually. Okay, boss. Bond is redeemable at 120 at the end of year 2. Calculate intrinsic value if the required rate is 12%. Firstly, tell me, how am I paying interest semi-annually? Yes, what is the interest rate? 10% per annum. That means for 6 months it is going to be 5%. Yes or no, everyone? Okay. What is the required rate? 12% per annum. That means for 6 months it is going to be 6%. Tell me what is the life of the bond? 2 years. But tell me, am I getting cash flow every year? No, boss, I'm getting cash flow every 6 months. So 6th month end, I will get 12th month, 18th month, 24th month. So how many periods are there? There are 4 period of 6 months each. Yes or no, everyone? So 2 years, which is equal to 4 period of 6 months each. So now every data is very simple. I will tell in the first period, yes, 100 into 5% coupon, 5 rupees. Second period 5 rupees. Third period 5 rupee. Fourth period 5 rupee. At the end of it, redemption price of 120 I will be getting. I need to discount it at what rate? At required rate, which is 6%. Is this clear, everyone? Just remember, convert every data for 6 months. Year, convert it into 6-month period. Yes or no, everyone? Yes, interest rate as well as discounting rate, it will be given on a per annum basis. Convert it into 6 months. Accordingly, calculate value of the asset. Is this clear, everyone? Okay, fine. Now some special areas are there. Pay attention. Look at this, students. Yes, in case of different coupons for different years. Look at this very simple example. Yes, company has issued a bond having a face value of 100. Maturity is 5 years. Yearly coupon, first 2 years it is 8%. Third and fourth year it is 10%. Fifth year it is 12%. Simple. 100 is a face value. First year and second year I will get 8 rupee interest. Third and fourth year I will get 10 rupee interest. Fifth year I will get 12 rupee interest. I need to bring it to present value. I will arrive at value of the asset. Yes or no, everyone? Okay. Now comes the next one. Beautiful example. Face value is 1000. Life is 4 years. Okay. First 2 years 10% coupon. Next 2 years 13% coupon. But wait. Bond is redeemable at par. Company repays 500 at the end of second year. Oh, this is special here. Tell me, first year I need to pay how much interest? 10%. On what? On the face value of 1000. So 1000 into 10 percentage, 100. Second year also I am paying 10 percentage, 100. At the end of second year, I am repaying 500 principal. Okay. Now tell me, at the end of second year, I paid 500 principal. So how much principal only is pending now with me? 500 rupees. Third year, what is the interest? 13%. But on 500 rupees. So 500 into 13 percentage is 65. Fourth year is 65. At the end of fourth year, I will repay balance 500. Bring it to present value. I will arrive at value of the asset. Is this clear, everyone? Yes or no? Perfect. This is over. Important relationship. There is an inverse relationship between, yes, YTM and price, needless to say. Yes. Next one is the relationship between coupon and YTM. Coupon, it is the return company is giving you. YTM, it is a return investor is expecting. Yes or no, everyone? If you understand this, great. Otherwise, not important anyways. YTM is equal to coupon. That means investor, yes, company is giving 10%. Investor is also expecting 10%. Now, what all return investor will get? Investor will be getting two return. One is interest plus capital gain. Okay. This is what constitutes, yes, yield. Now tell me, company is giving 10% interest. Investor also wants 10%. That means, is there capital gain? There is no capital gain. That means the share, yes, or the bond is trading at par. Yes or no, everyone? Okay. Now, yield is greater than coupon. Company is giving 10%, but investor wants 12%. That means 10% interest anyways he is getting. With that, capital gain is also there for the investor. That means he has purchased the bond cheap and redeeming it at par. That means the bond will be trading at a discount. Yes or no, everyone? If YTM is less than the coupon, that means bond is trading at a premium. Is this clear, everyone? Okay. Now comes Majaa adjustment. Pay attention, everyone. Expected market price of the bond based on intrinsic value. This was one old adjustment from a practice bank. Look at this, everyone. Yes, intrinsic value of the bond is 940 rupees. Question is telling, calculate the expected market price if bond is having a beta of 1.1 due to the popularity, because it is having a lower risk. Now remember, this is not the beta as per CAPM. This is indicating popularity of the bond. Now value of the bond is 940, but boss, it is popular. That means people are willing to pay more price. So how much they are willing to pay? 940 into 1.1. It is going to be, yes, whatever the value. So price of the bond, it is value of the bond into the beta. Is this clear, everyone? So with this, concept number 1 is over. Yes, everyone, now let's come into super 100 question solving series. We are having question 2 as well as 3 from the first concept. Look at question number 2, my dear students. Very simple question it is. What is happening here is face value is 100, 10 years is a life. Now first 4 years 9% coupon they are paying, next 4 years 10% they are paying, next 2 years 14% they are paying. We have already seen that. Yes or no, everyone? Now current market rate on the similar debenture is 15%. Yes, market is giving 15% interest. Yes or no, return. But company proposes to price in such a way that it can give 16%. That means we will discount at 16%. Okay. Then we will be redeeming at 5% premium. Calculate issue price. Yes, first one. Now we will show the, yes, cash flows. Yes or no, everyone? First 4 years, yes, 9%, 9 rupees. Next 4 years 10%, 10. Next 2 years 14%, 14. Yes, redemption at 5% premium means 105. I will discount how much return we want to give. 16% means I will discount it at 16%. Is this clear, everyone? Question is over. Yes, bingo, jingalala. Okay, now coming to question number 3. Pay attention, everyone. Okay, now yes, John has inherited some securities from his uncle who has died. We want to calculate the overall value of the portfolio. Now look at this, students. Bond A, bracket 1000 rupees, face value is given. Number of shares, so total how many bond he has inherited is given. Yes, annual coupon maturity yield is given. Okay, very simple. First we will calculate value of one bond, then into number of bonds we will arrive at the total value. Same is a story for all the cases. Yes or no, everyone? Okay, bond A 1000 is a face value. Tell me, coupon is going to be how much? 9% for 3 years. So first year 9, second year 9, third year 9. With that third year I will also get back my principal, which is going to be 1000. Sorry, 1000 into 9% is 90, 90, 90. With that I will be getting back 1000 rupees. Yes or no, everyone? Tell me, what is the yield required? 12%. Discount it at 12%. I will arrive at the value of the asset. Look at this, everyone. Yes, this is the story. Value of one bond is 928.2. Same is a story with bond B as well. Now comes preference share C. Face value is 100. Okay, total how many preference shares we are having? 100. Annual coupon is 11%. Maturity is star. Maturity is not given. That means it is perpetual. Required rate is 13%. Tell me 100 is a face value 11 percentage coupon. That means every year I'll keep on getting 11, 11, 11, 11 till infinity. I'll keep getting 11. Yes, what is a return that I want? I want 13%. So I'll tell if I invest 1 rupee, I want 13%, 0.13. Every year I'm getting 11. That means how much I'm willing to invest? 11 divided by 0.13, which is going to be 84.62. This way I will calculate the value per unit of all the assets, yes, into number of units. I will arrive at the total value. Is this clear, everyone? So with this, all questions are also over, my dear students. Yes, everyone, concept to yield of a bond. Yield means a return to the investor. How much return investor is getting. There are altogether three things. First one is a current yield. Next one is YTM. Next one is going to be realized yield. Now, what is current yield as well as YTM? Try understanding, students. Yes, if I am purchasing a bond, two return I can be getting. First is every year I will get interest. Second, yes, whenever I'm selling, I will be getting capital gain as well. Yes or no, everyone? In total, return for the investor is interest plus capital gain. Now current yield is telling, yes, how much percent interest I am getting. Yes or no? Current yield is only considering interest. Now YTM is considering interest as well as capital gain. Okay, first one is coming for the current yield. It is telling my interest is how much percentage of the investment. Say for example, I purchased a bond at 120 rupees. Yes, say for example, the coupon is say 10% on the face value. Face value is 100, 100 into 10 percentage, 10 I am getting. I invested 120, on that 10 I am getting. That gives me the current yield. Current yield is nothing but interest divided by current market price into 100. It is telling how much interest I am earning in relation to the current market price. Is this clear, everyone? YTM, if I am holding it till maturity, what all I will get? Look at this example, students. Now, okay, we issued a 10% bond having a face value of 100, maturity is 5 years. We have issued the bond at 90. Yes, it is redeemable at 110. Calculate the YTM. Let us try plotting all the cash flows. Tell me, today at t is equal to 0, I am buying a bond at 90. Yes or no, everyone? Every year I will get 10% interest on the face value. 100 into 10%, 10, 10, 10, 10, 10 I will get. Now at the end of 5 years, how much money I will be getting it back? 110. Is this clear, everyone? Now tell me, every year what all income I am getting? Boss, every year I'm getting interest. With that, boss, 90 rupees I had invested. At the end of it, I am getting 110. Yes, there is a capital gain also. Capital gain is how much? 20 rupees. But boss, the 20 rupees is across 5 years. That means on an average, every year it is going to be 20 divided by 5, 4 rupees. Yes or no, everyone? Okay. YTM, very simple formula I have told. Yes, it is average return divided by average investment. Is this clear, everyone? Average return divided by average investment. Average return, what all I'm getting every year? Firstly, I'm getting interest of 10 rupees interest plus average capital appreciation. How do I get the average capital appreciation? Logically through a line you can get, but or else simple, boss. 90 you put, it became 110. So total capital appreciation is how much? 20. It is for how many years? 5 years. That means every year it is going to be 4 rupees. Or redemption value minus, yes, purchase price divided by n. That is how this is coming. Divided by average investment. Tell me, what is the opening investment value? 90. What is the closing value? 110. So average is going to be, yes, 90 plus 110 divided by 2. It is going to be 100. Is this clear, everyone? So this way we will be getting. Now look at this, students. Based on this, whatever is going to be the YTM that we calculate, it is just the approximate YTM. Then sir, how do we calculate actual YTM, accurate YTM? Boss, I got my approximate YTM. I got a reasonable idea of how my YTM is going to look like. Now I will discount them. I know what is the cash flows I'm going to get. Yes or no, everyone? Simple. Look at this example. Yes, this is going to give me the approximate YTM. If I want to calculate the accurate YTM, I know if I purchase the bond, this is going to be the cash flows I'm going to get every year. 10, 10, 10, 10, 10. At the end of 5th year, 110. Tell me today how much I'm paying to purchase the bond? 90. So at what rate, if I discount these cash flows, I will arrive at 90. That is going to be my accurate YTM. Yes or no, everyone? Perfect. Now, yes, I will be doing the same interpolation technique we have discussed in the basics. So I will discount these cash flows. At what rate it will arrive at 90 rupees? That is going to be my accurate YTM. Okay, boss. Now, if I discount at 13.5%, it is coming to 93.16. 14.5% means it is coming to 89.8. I want 90. Simple. I will draw a line. I will tell boss, if I discount my cash flows at 13.5%, I am getting 93.16. At 14.15%, I am getting 89.8. I want 90. Tell me, I will take one place as a base. Let me assume this one as a base. 13.5% I am getting. In fact, I'm getting slightly more than that, yes or no, everyone? How much more? If I increase 1%, value is decreasing by 3.36. 1% if I increase, value is decreasing by 3.36. Tell me, value I want to reach where? I just want to reduce the value by 3.16, yes or no, everyone? That means how much? Cross multiplication. Yes, I will tell boss 13.5 I'm getting plus how much extra? Yes, it is going to be 3.16 divided by 3.36. It comes to 14.44%. Is this clear, everyone? Okay. Always remember, how do we calculate YTM? Step number 1, calculate approximate YTM. It is average return divided by average investment. What all return I will get? Interest plus average capital appreciation, which is redemption price minus purchase price divided by n, divided by average investment, which is redemption price plus purchase price divided by 2 into 100. Okay. Now remember, we will always be considering cash flows only. Yes, I is the interest. Always, if if tax rate is there, consider the post tax interest income. Interest into 1 minus tax. Redemption price. Suppose question has given capital gain tax. Yes, consider, yes, redemption price minus capital gain tax. Is this clear, everyone? Yes, and net purchase price. Suppose we are having incidental expenses. Yes, add those incidental expenses also. Okay, don't worry, one comprehensive example we will see. That is step number 1. Step number 2, calculate accurate YTM using interpolation technique. Okay, additional notes. Now we will be having marks in our final examination, CA final, CMA final, only for accurate YTM. So calculation of that is going to be compulsory. If 2 discounting rates are already given, we can directly calculate accurate YTM. So step number 1 is not needed. Is this clear, everyone? Okay. In case of irredeemable bond, the only coupon, yes, the only payment I'm going to get is going to be interest. So in that case, yes, my YTM is just interest divided by current market price into 100. In case of semi-annual coupon payment, same story, everything is going to be same. Just ensure uniformity in data. Do all calculation for 6 months. Yes, you calculate approximate YTM for 6 months, accurate YTM for 6 months. You will get accurate YTM for 6 months. Then you convert it into per annum basis. Is this clear, everyone? Okay, fine. Till here the discussion is clear. Let us have a look at one comprehensive example, students. Pay attention. Okay, here with all the adjustments. 4-year 1000 rupee bond offers 10% coupon. It is available in the market at 900 rupees. Incidental expense is 5%. Yes, investors tax rate is 30% on interest and 10% on the capital gain. Calculate the YTM. Okay, fine. Tell me, students, 1000 is a face value. Every year how much coupon they're paying? 10%. So 100 I am getting, yes or no, everyone? No. Why? On that 30% tax is going. So effectively I will get 70 only. So here I will tell that interest I am getting is 70. Okay. Second one, when I'm purchasing the bond, how much I paid? 900? No. 900 is a purchase price with that incidental expense of 5%. 900 plus 5%, it is going to be 945. Third one is going to be, yes, the redemption price. Tell me at the end, yes, at what price it is redeemable. Nothing is given. I will assume 1000 rupees, yes or no, everyone? No. Why? Because on the gain, question is telling capital gain tax is there, 10%. So tell me, when I am selling, I will get redemption price of 1000 rupees. But boss, government will charge capital gain tax. Tell me at what price I had purchased? 945. Now what is the value? 1000. So what is the capital gain? 55. So 55 into 10%, 5.5 I will pay as capital gain tax. 1000 I received, 5.5 I paid, that means it is 994.5. Is this clear, everyone? Yes. Now you follow the same set of steps. Yes or no, everyone? Average income divided by average investment, 70 I am getting, plus 945 is becoming 994.5. So it is 49.5 if I am not wrong, divided by average, sorry, 49.5 across 4 years divided by 4, divided by average investment, which is 945 plus 994.5 divided by 2 into 100, gives you the approximate YTM. Yes, approximate YTM is 8.47%. Using this approximate YTM, it is 8.47. So somewhere in the range of 8 and 9. Discount at 8, discount at 9. Yes, calculate the accurate YTM. Is this clear, everyone? Okay, fine. This is over. Yes, now one more thing. It is calculation of YTM in case of zero coupon bond. Now look at this example, students. There is a zero coupon bond having a face value of 10,000, which is currently trading at 7,000. Calculate, it will mature after 5 years. Calculate the YTM of the bond. Okay. Now either you can do through the long approach, or else in this case, pay attention, students. Simple story it is. Today I am purchasing the bond at 7,000. 5 years later I will get 10,000. Yes, at what rate? I don't know. Yes, present value is 7,000. Let me assume the rate as R into 1 plus R to the power 5. Yes, can I apply my formula? Present value into 1 plus R to the power n is equal to future value. So 7,000 into 1 plus R to the power 5 should be equal to future value 10,000. Yes or no, everyone? Yes, that means 1 plus R to the power 5 should be equal to 10,000 divided by 7,000. Yes or no, everyone? Now, yes, I want to remove the power. When it goes to the other side, it becomes inverse of the power. 1 plus r should be equal to 10,000 divided by 7,000 to the power 1 by 5. Yes or no, everyone? Look at this. Here we have done the calculation. Yes, 1 plus r to the power 5. 10,000 divided by 7,000 is 1.4286. Yes, now I want 1 plus r. Yes, to the power 5 goes to the other side, becomes 1 by 5. Yes or no, everyone? Which is 0.2. Now understand, whenever I am having this, I want to do a power. Remember three things. Yes, normal power. Say for example 2 square. I can do 2 into 2. 2 to the power minus 2. It is 1 divided by 2 square. Yes or no, everyone? Whenever I am having a dirty power, that is my power is in the form of decimal. How do we do that? Very simple. Yes, step number 1, write down the base number. Yes, 1.4286. Press square root 12 times minus 1 into the power 0.2 plus 1 into equal 12 times. You will arrive at the value. Yes, it is coming as 1.07394. I want the value of r minus 1. It is coming to 7.39 percentage. Is this clear, everyone? This is called as the dirty power approach. Okay, boss. This is given here. Yes, YTM in case of a zero coupon bond, we can directly apply the dirty power approach. Present value into 1 plus r to the power n is equal to future value. Yes, present value is given. Price. Future value, it is going to be the face value. Yes, I want to calculate r. N is given. Apply the dirty power approach. Is this clear, everyone? Okay. Now there is one more concept called the realized yield. Okay, very simple concept. Yes, very simple. Take all the cash flows to the last date. As simple as that. Look at this. Face value is 1 lakh. Coupon is 10%. Life is 3 years. Current market price is 1 lakh. Actual reinvestment rate is 7%. Okay, calculate the realized yield. Step number 1. Do a pictorial representation and calculate the total amount at maturity. Remember, take all cash flows to the last period. Tell me 1 lakh is a face value. Every year I will get 10%. So 10,000, 10,000, 10,000. With that I will get, yes, redemption price of 1 lakh. Now I want all cash flows on the last date. Tell me what is the actual reinvestment rate? 7%. So 10,000 I will get in the first year. I'm telling I don't want in the first year, I want in the third year. So I can reinvest for how many years? 2 years. Yes, what is the reinvestment rate? 7%. So into 1.07 whole square. 10,000 I'm getting in the second year. I'm telling I don't want in the second year, I want in the third year. I can reinvest for 1 year. Yes, into 1.07. It is 10,700. Yes, 10,000 and 1 lakh. 1 lakh 10,000 I'm getting in the third year. When do I want? Third year. So is that possible for me to reinvest? No, boss. So at the end of third year, what is the total value I will be getting? 1,32,149. Yes or no, everyone? That is step number 1. Calculate total amount at maturity. Yes, in the form of line I have shown. Now how do we write? Year, cash flow, balance years, and total amount at maturity. 10,000 I receive in the first year. I wanted the third year. That means there are 2 years balance. Accordingly, I will do my calculation. Is this clear, everyone? Okay. Once that is done, yes, step number 2 is calculate realized yield. This is simple using dirty power approach. Tell me, students, I know that today I am investing 1 lakh for the bond. At the end of 3 years, I am getting altogether 1,32,149 we have calculated. At what rate? R is what we want to calculate. I will tell present value into 1 plus R to the power 3 is equal to future value. 1 lakh into 1 plus R to the power 3 is equal to 1,32,149. Yes, simplify. Yes, this comes here divided. This goes to the other side inverse. So it comes 1.32149 to the power 0.3333. Yes, use dirty power approach. Accordingly, calculate the value of R. Is this clear, everyone? Okay. Now, if reinvestment rate is not given in the question, we will assume that reinvestment rate is 0. If reinvestment is not possible, question tells, we will assume that reinvestment rate is 0. Is this clear, everyone? Perfect. So with this, concept 2 is over. Yes, everyone, question number 5. Yes, very simple question. First one is anyways basic. Now, yes, 1 lakh we want to invest. There is a bond having a face value of 100 rupees. Yes, which is giving 8% coupon. Okay, fine, boss. Now, if the bond is available at par, okay, and 1% is a transaction cost, what is the effective yield? Tell me, bond is available at par. That means bond is available at 100. But boss, if I have to purchase, means I have to incur 1% transaction cost. So total how much amount I am incurring? 101. And they are asking what is the effective yield? Yearly how much return I will be getting? 8% on the face value. I will be getting 8 rupees interest. So I will tell I will get 8 rupees by investing 101. 8 divided by 101 into 100 is going to be the effective yield. Is this clear, everyone? Okay. Now next one is calculate the number of days required to break even the transaction cost. If bond is available at par and 2% is the transaction cost. Okay. They are telling bond is available at par 100 rupees. 2% is a transaction cost. Tell me, that means transaction cost is how much? 2 rupees. Now if I am purchasing a bond in a year, how much return I am getting? 8%, 8 rupees. So they're asking to recover my transaction cost, how much period I should be holding. Okay boss, yes, have they done in the form of months or days? We don't know. Okay, they've done in the form of days. So what we are telling, okay boss, simple, if I'm purchasing the bond, holding it for 1 year, that is 365 days, I will get 8 rupees. I want to recover 2 rupees. Yes, to recover 2 rupees, how much? It is 2 into 365 divided by 8. It is going to be somewhere around 90 or 91 days. Is this clear, everyone? Okay, perfect. Then comes question number 6. Simple question they have given. Okay, yes, half yearly they are paying the coupon. So all calculations we will be doing it for half year. Based on that, calculate current yield as well as YTM. Current yield, okay, yes, simple. Yes, face value is 100, 14% per annum. Currently it is at 90 rupees. Okay, every 6 months they are paying interest. Okay, all those things are okay. Calculate the current yield. Okay, it is interest divided by current market price, but boss, I am getting it for 6 months. Accordingly I will be doing the calculation. Tell me, every 6 months, yearly I am getting 14%. That means for 6 months I will get 7 rupees. Yes or no, everyone? 7 I am getting by investing 90. It is 7.77% for 6 months. That is 15.55% per annum. Okay, YTM, it is average investment divided by average, average income divided by average investment. Accordingly you will arrive at the approximate YTM. It is 8.42% for 6 months. Now yes, in the meantime, calculate your accurate YTM also. Your accurate YTM comes for 8.54% for 6 months. First do all the calculation for 6 months. Once you have calculated the accurate YTM for 6 months, convert it into per annum basis. It is 17.085% per annum. Third one is going to be calculate a realized yield, assuming that intermediate coupon is not available for reinvestment. That means my reinvestment rate is going to be 0%. Yes or no, everyone? Tell me, total 5 years are there. That means there are 10 periods of 6 months each. Every period I'm getting 7, 7, 7, 7, 7, 7. At the end of it I'm getting 100. Tell me, in the first period I got 7. Can I reinvest? No boss, reinvestment rate is 0. That means at the end of it I'm getting 7 only. This way, calculate the total amount at maturity. Based on that, we will be calculating the realized YTM. Is this clear, everyone? So with this concept is also over, my dear students. Yes, everyone, now we are having concept number 3, which is going to be term structure theories, or spot rate versus forward rate. Spot interest rate. Today, what is the interest rate prevailing? Now look at this, students. Yes, we will be having spot 1, spot 2, spot 3, forward rate. Spot rate means today if I am investing for 1 year, what is the rate? S1. Today if I am investing for 2 years, what is the rate? Today if I am investing for 3 years, what is the rate? S3. Yes, forward rate F1, it is the interest rate for the first year. F2, it is the interest rate for the second year. That means at the end of first year, look at this, 0, 1, 2. If I'm telling F2 is equal to 10%, that means at the end of first year, if I'm investing for second year, that is, it is 10%. Is this clear, everyone? Okay. First one comes, how do we calculate the forward interest rate? Look at this, everyone. S1, first, yes, 1 year's interest is 10%. Today, if I'm investing for 2 years, it is 9.5%. Today, if I'm investing for 3 years, it is going to be 9.8%. Second year's interest rate, F2 is equal to 9%. Calculate F3. How do I calculate? Simple, draw a line. Remember the concept of equilibrium. Whenever you are taking interest, always assume a principle of 1 rupee. Now, yes, spot, yes, two different approaches are there. First one is using the individual forward rate. Tell me, students, today if you are investing for 3 years, how much you are going to get? 9.8%. So if you invest 1 rupee, means you will be getting 1.098 to the power 3. Yes or no, everyone? Okay. Today if you invest for first year, how much you are going to get? 10%. So if you are putting 1 rupee, means it becomes 1.10. Yes, if you are investing for the second year, how much you are going to get? F2 for the second year, 9%. That means 1.09. That means for the third year, how much you should be getting? I don't know. Let me assume it as R into 1 plus R. Now both should be on equilibrium, the above as well as below. Above I am having 1.098 to the power 3. So 1.098 to the power 3 should be equal to 1.1 into 1.09 into 1 plus R. Simplify this, I will arrive at the F3 value. Is this clear, everyone? Okay, simple. Again I am repeating, yes, the world runs on the principle of equilibrium. Whether you invest directly for 3 years or you invest year, yes, the total value should be same. Take a principle of 1 rupee. I am assuming today itself 1 rupee I am investing for 3 years. How much it will give me? 9.8. So 1.098 to the power 3. Or if you are investing every year First year you're investing, how much you're getting? 10 percentage on 1, so it becomes 1.10. Second year you're investing forward 2 for the second year 9% into 1.09. I want to know for the third year into 1 plus r, calculate the value of r. Is this clear? This is one approach. Or second approach is by using the spot rate till the last year. Tell me students, if I'm investing for 3 years, how much I'm getting? 9.8%. So if I'm investing 1 rupee means 1.098 to the power 3. If I'm investing for 2 years, today itself if I'm investing for 2 years, it is 9.5 percentage. So it is 1.095 whole square. So that means what should be the interest rate for third year? 1 plus r. Both should be same. So 1.098 to the power 3 should be equal to 1.095 whole square is into 1 plus r. Simplify, I will arrive at the value. Both are going to give me the same values. Is this clear, everyone? Okay. Second type of calculation that can be coming is, how do I calculate the bond value? Remember, I have to discount it to the present value. If spot interest rates are given means, I will directly discount from the year end to the 0th year. Simple example, first year cash flow is 1000, second year cash flow is 11,000. Yes, S1, first year's interest spot rate is 10%, second year's is 9.5%, F2 is 9%. Okay, calculate the value of the bond. Okay, simple. Either I am going to discount using the individual forward rate. Remember, forward rate is for that year. Is this clear, everyone? Okay. First year I'm going to get 1000, second year I'm going to get 11,000. Okay. What is the spot rate for the first year? 10%. That means the forward rate for the first year the interest rate is 10%. For the second year the interest rate is 9%. So either I can do it this way. Tell me 1000 I have to bring it back 1 year, divided by 1.1. Okay, 11,000 I have to bring it back 2 years. Yes, second year the return is 9%, divide by 1.09. First year the return is 10%, divided by 1.10. Accordingly I can calculate the value. Yes or no, everyone? Or else by using the spot rate. Tell me 1000 I'm going to get, 11,000 I'm going to get. Spot rate, if I'm investing for 1 year, the return needed is 10%. So 1000 divided by 1.1. If I'm investing today for 2 years, the return needed is 9.5%. So it is 11,000 divided by 1.095 whole square. Is this clear, everyone? Accordingly, we can calculate. Now, if I'm using the forward rate means individually, one year I will be coming back. Spot rate means directly to the 0th year I will be coming back. Is this clear, everyone? Okay. Now comes Majaa adjustment. Yes, how do I calculate the spot rate if forward rate is given? Look at this, students. First year's forward rate is 10%, second year's forward rate is 10.5%, third year's forward rate is 11%. I have to calculate S3, that is today if I am investing for 3 years, what is the return? Okay. Tell me both the returns. Yes, both the approach should be giving me same return. Yes, S3 I don't know. So let me assume 1 plus S3 to the power 3. Yes, below what is there? First year 10%, 1.1, second year 10.5%, 1.105, third year 11%, 1.11. Both should be same. 1 plus S3 to the power 3 should be equal to 1.1 into 1.105 into 1.11. Accordingly, I will solve and finish off my story. Is this clear, everyone? Yes or no? Okay. Now, if you are coming to the question bank, yes, majorly everything we have discussed. We are having, yes, question number 9 as well as 10. If you come to question number 9, there is nothing great. Look at this, everyone. Yes, spot yield rate is given. We have to calculate the implied 1 year forward rate. Yes, based on that we'll have to calculate the value of the bond. Okay, very simple it is. Now comes question number 10. Yes, here some adjustments are there. Pay attention. Spot yield curve is given. Yes, 1, 2, 3, 5, 7, 10, 15, 30 years. Okay, based on that some theory pointers that we should be knowing. Main characteristic of a normal yield curve. Okay, normally in a yield curve, yes, long term yield should be greater than the short term yield. Is this clear, everyone? Yes, short term yield is going to be lower than a long term yield. This is the point. Okay. Now, inverted yield curve. What is inverted yield curve typically indicating? Yes, where short term, yes, I'm getting more, long term I'm getting less. It is indicating that, boss, market is going to recession. It is indicating an upcoming recession. Is this clear, everyone? Okay. Yes, what is a yield spread between 10-year bond and the 1-year bond? Now understand what is a spread in yield. It is a difference in the yield. Simple, boss. Market's comparable bond is giving a yield of 10%, but our bond is giving a yield of 12%. That means what is a spread of yield? It is going to be 2%. Is this clear, everyone? Okay. Spread between the 10-year bond and the 1-year bond. Tell me 10-year bond is giving how much? 7. 1 year is giving how much? 3%. So the spread difference is going to be 4%. Is this clear, everyone? Okay. Next two questions are same only. If investor is looking to invest for 2 years, starting 3 years from now, tell me he wants to invest for 2 years, starting 3 years, after 3 year for 2 year, 5 year, yes or no everyone? Tell me directly, if you are investing for 5 years, how much we are going to get? 6%. So that means it is going to be 1.06 to the power 5. Today if I am investing for 3 years, how much I am going to get? 3 years means 5% only. That means it is 1.05 to the power 3. That means fourth and fifth year, how much I should be getting? 1 plus r whole square. Simple. 1.06 to the power 5 should be equal to, yes, 1.05 to the power 3 into 1 plus r whole square. Calculate the value of r. Yes, same is a situation for the fifth one as well. Is this clear everyone? So with this, concept number 3 is over, unit number 1 is also over, my dear students. Yes everyone, let's proceed to unit number 2, which is duration and its related concept. Here we are having altogether 3 concepts. Concept number 1 is duration and volatility. Concept 2 is convexity. Concept number 3 is bond immunization. Now for CMA final students, convexity and bond immunization is not a part of your syllabus. Yes, duration and volatility is there, it has come in the examination also. Study material you may not be seeing, but in the workbook questions are there. Okay. Now concept number 1 is duration and volatility. What is the duration of a bond? Also called as Macaulay's duration. It is the average time in which my investment is recovered. Now ideally, the lower the duration, the better it is going to be. Okay, yes, using a very simple example. Look at this everyone. RCB has invested 1000 in a bond having a coupon of 10% and maturity of 3 years. YTM is also 10%. Calculate the following: current market price. Tell me, if investor purchases the bond, every year he'll get 10% coupon on 1000 rupees. So 100, 100, 100. At the end of 3 years, 1000. Bring it to present value by discounting it at 10%. We will arrive at value of the asset as 1000 rupees. Is this clear everyone? Okay. Now comes calculation of duration of the bond. Okay, pay attention students. Let me again calculate. Okay, yes, so how do we calculate duration? Yes, first I will write year. Okay, every year I will write every year's cash flow. Yes, multiplied by the present value factor, I will arrive at the present value. Is this clear everyone? Okay, value of the asset is 1000. Now tell me students, total value of the asset is 1000. In that, 90.9 of your investment, yes, you will be recovering in the first year, yes or no everyone? So I will calculate the weights. Yes, proportion. Yes, that is what is the present value divided by total of the present value. Is this clear everyone? What is the interpretation? Yes, if I have to purchase a bond, I have to pay 1000. In this 1000, 90.9 out of 1000 I am recovering in the first year. That is 0.0909 or 9.09%. Yes, 82.6 out of 1000 I am recovering in the second year. 826.5 out of 1000 I am recovering in the third year. So I will calculate the weight. Yes or no everyone? Yes, weight I will multiply with the duration. Yes, 0.0909 I am recovering in the first year into 1. 0.02826, yes, I am recovering in the second year. 0.8265 I am recovering in the third year. So weight into duration gives me the weighted average duration, which is 2.74 years. It means on an average our entire investment is recovered in 2.74 years. Now some money is recovered before, some money is recovered later, but on an average my investment is recovered in 2.74 years. This is how do we calculate duration. Is this clear everyone? Year, cash flow, present value factor, present value. Now based on that I will calculate the weight. Yes, weight I will write down duration. Weight into duration gives me the weighted average duration. Is this clear everyone? Okay, fine. Now look at this students. How did I arrive at the weight? Yes, 0.0909, it was 90.9 divided by 1000 into 1. Yes, 82.6 divided by 1000 into 2. 826.5 divided by 1000 into 3. If I want, if you guys see, everywhere it is getting divided by 1000. Yes or no everyone? So instead of individually doing, yes, divided by 1000 I can do in the end. So what I can also do is, first 90.9 into 1, 82.6 into 2, 826.5 into 3. This also can be done. Yes, that is basically I will do present value into the duration. This one I will call it as the product. Is this clear everyone? Divided by price. That also gives me the duration. Look at this everyone. Yes, year, cash flow, present value factor, present value. Yes, present value directly. Yes, I will multiply by the duration. That gives me the product. Okay, this product I will divide by the price. This also gives me the duration. Is this clear everyone? Yes, first one is a logical approach. This one is faster for calculation. And in case of missing figure, through this easily we can be getting our answers. Is this clear everyone? Okay, fine. So how do we calculate duration? Okay, better one is using the products. Year, cash flow, present value factor, present value. Yes, present value into the duration gives you the product. Product divided by price gives you the duration. Is this clear everyone? Okay, fine. Next one is calculation of volatility. It is also called as a modified duration. How do I calculate volatility? Yes, we have explained the logical approach, all those things in the regular batch, fast track, revision also it is available. But simple, how do I calculate volatility? It is a duration divided by 1 plus YT. Yes or no, everyone? Look at this. In this particular example, we have calculated duration. We got our duration as 2.74 years. Volatility is going to be duration divided by 1 plus YT. It is 2.74 divided by 1.1. It is going to be volatility. Yes, volatility is going to be in this example 2.49. Now, what is the interpretation of volatility? Yes, I know that if YTM increases, price decreases. Yes, volatility tells approximately how much. Now, interpretation volatility is 2.49. It means if my YTM increases 1%, price will decrease by approximately 2.49%. If my YTM decreases 1%, price will increase by approximately 2.49%. Is this clear, everyone? Okay. Now, using volatility, we can be calculating the expected market price as well. Now, how do we do the calculation? Suppose situation number 1, question is telling that assume your YTM increases by 125 basis points. Remember, 100 basis points means 1%. Okay. What are the steps? Step number 1, we calculate volatility. Volatility is 2.49. Step number 2, ascertain if the market price will increase or decrease. Tell me, students, YTM is increasing. That means what will happen to price? Price will decrease, so price should decrease. Third, understand by how much percent price will decrease. Tell me volatility is 2.49. What does it mean? It means that, boss, if YTM changes by 1%, price changes by 2.49. Here YTM is changing by how much? 125 basis points. That means 1.25 percentage. So price will be changing by how much? 1.25 into 2.49. It is going to be 3.1125 percentage. Okay. Now using this, calculate the revised price of the bond. Yes, tell me it is existing price of the bond plus or minus change. Tell me existing price of the bond was 1000. Now we have told that price will decrease minus how much percent it will decrease? 3.1125%. That gives me the revised price of the bond, which is 968.88. Is this clear, everyone? Okay. Now if YTM decreases by 200 basis points, okay, calculate volatility. We have calculated 2.49. If YTM decreases, price increases. How much? Tell me for 1%. Yes, YTM changes by 2.49. That means for 2%, 200 basis points means 2%. How much? 2.49 into 2, 4.98%. So it is 1000 plus 4.98%. It is 1049.8. Is this clear, everyone? Yes or no? Yes, this is going to be calculation of volatility. Based on volatility, calculation of revised price of the bond. Is this clear, everyone? Okay. Now, based on this, there is one more adjustment which is important. Now, if I am having a portfolio, how do I calculate duration of a portfolio? It is just weighted average duration. Based on this, we have one beautiful question which had come in the examination also. Look at this, everyone. Question number 13 as well as question number 14. Now look at this, everyone. Question number 13. Yes, look at this. It has come in the examination for 8 marks. Now, following information is available for bond 1 as well as bond 2. Bond 1 as well as B, face value is given. Okay, coupon is given. Time to maturity is given. Investor has created a portfolio consisting 75% in bond 1 and 25% in bond 2. Yes, YTM is 10%. Okay, boss. Yes, 10% discounting factor is given. Okay. Now, new price of the portfolio, if YTM changes based on duration, that means I need to calculate duration. Understand the steps. Step number 1, for bond 1, I will calculate the price as well as duration. For bond 2 also, I will calculate the price as well as duration. Look at this, everyone. Bond 1, yes, every year I will get 60. At the end of 5th year, I will get 1000. Yes, calculate the, yes, price as well as duration. Price of the bond is 848. Duration is 4.43 years. Similarly, do it for bond 2 as well. Okay. Now, duration of the portfolio, it is nothing but weighted average of the duration. Tell me how much we are investing in bond 1, 75%, bond 2 is 25%. So 0.75, 0.25 duration I have calculated, gives me the weighted average duration. Okay, boss, I got the weighted average duration. Volatility, it is a duration divided by 1 plus YTM divided by 1.1. I will arrive at volatility. Is this clear, everyone? Okay, fine. Now question is asking me, this was the most important thing. Yes, price and duration of bond 2 we know. Price and duration of bond 1, that also we know. Price sensitivity of the portfolio. Yes, it is nothing but the, yes, volatility of the portfolio. It is how much we got. We got it as 3.6 something. Yes or no, everyone? Yes, 3.64. It is going to be 3.64. Option number C. Now here they are asking what is the new price of portfolio if YTM changes. Okay. Now understand how do we do the calculation. First we will calculate the existing price of the portfolio. Tell me, do I know the price of each of the bond? Yes. Bond 1 price is 848. Bond 2 1000. I know how much percentage I'm investing, 75%, 25%. So do I know the value of the portfolio? 886. Now revise the price of the portfolio. Tell me what is happening. YTM has increased by 0.5%. So what will happen to the price? Yes, price will decrease. How much it will decrease? Tell me, volatility is 3.64. So if YTM would have changed by 1%, na, 3.64 it would have changed, but here only 0.5 percentage it has changed now. So how much it will be changing? 3.64 into 0.5, it is 1.82%. Okay, YTM has increased, that means price will decrease. Yes, 886 minus 1.82 percentage gives me 870. That is the new price of the bond, 870. Is this clear, everyone? Perfect. Yes, now with this concept number 1, duration and volatility, is over. Then we are having concept number 2, which is going to be convexity adjustment. Not very important from the examination perspective. Last day revision, I am not going to discuss it. You guys try it by yourselves. Yes, concept 2, convexity, if you are having time. Yes, with that question number 14 also, you guys can see it once by yourselves, my dear students. Is this clear, everyone? Okay, now convexity is not there for CMA final. Next concept is going to be concept number 3, which is going to be bond immunization. This is also not there for CMA final, students. Bond immunization, remember the golden principle, students. We will invest in bond in such a way that the weighted average duration of the bond should be equal to the investment period. Just remember this point. So how do we solve a question? Step number 1, calculate the duration of every bond. Step number 2 is calculation of weight of each bonds. Now understand, altogether 2 types of questions could be there. Type 1 when only 2 bonds are there. Type 2 when 3 bonds are there. Each of that we will see. Now look at this in case of 2 bond. Yes, Thala will need 7 lakh after 2 years for his daughter's education, for which he decided to make a one-time investment today. Yes, Thala, for a reason, he wants 7 lakh after 2 years. For that he wants to invest today. How much he will invest today? Present value of that. Okay, fine, boss. He is having 2 different types of bond. Current YTM is 7%. Okay, bond A, bond B, price is given, years to maturity is given, duration is given. In this example, I have given the duration. In the examination, duration will not be given. We should be calculating it. How to calculate duration? We know. Okay, fine. Now, should he invest all his money in one type of bond, or should he buy both bond? If so, how much is the quantity? Step number 1, calculate duration of each bond. Here it is given. In the exam, we should be calculating it. Duration of bond A is 1.5, bond B is 2.5. Okay. Now tell me, we will invest in bond, calculation of weight, in such a way that the weighted average duration should be equal to the investment period. Tell me, I want to invest for how much period? For 2 years, yes or no, everyone? So the weighted average duration should be equal to 2 years. Tell me, bond A is there, bond B is there. How much percent should we invest in bond A and bond B? I don't know. Let me assume bond A is equal to X. Summation of the weight will be equal to 1. That means how much percent should you invest in bond B? 1 minus X, yes or no, everyone? Okay. Let us assume weight of bond A is equal to X, bond B is equal to 1 minus X. We will invest in such a way that the weighted average duration should be equal to the investment period. Tell me, bond A, how much I am investing? X into what is the duration? 1.5. So it is 1.5 into X. Yes, bond B, 1 minus X into 2.5, so it is 2.5 into 1 minus X should be equal to the investment duration, which is 2 years. Simplify, I will arrive at the value of X as 0.5. Yes, what is X? Yes, it is the weight of bond A, 0.5. That means weight of bond B is also equal to be 0.5. Is this clear, everyone? Okay. Yes, step number 1, calculate duration for each bond. Step number 2, calculate weight of each bond. Yes, we will calculate the weight of bond in such a way that the weighted average duration should be equal to my investment period. Yes or no, everyone? It is summation of weight into duration should be equal to the investment period. Now, in case of 2 bond, I will assume weight of first bond as X, second bond as 1 minus X. Is this clear, everyone? Okay. Now comes third step. Yes, calculate the total investment amount in the bond. Tell me, students, yes, our Thala, yes, needs how much amount? 7 lakh. When? After 2 years. When is he investing? Today. How much he should invest? Tell me. Yes, after 2 years he wants 7 lakh. For that he is investing today. Tell me what is the yield we are going to get? 7%. So I want 7 lakh after 2 years. Yes, I am investing today divided by 1.07 whole square gives me the total investment value. Yes or no, everyone? Step number 3, 7 lakh divided by 1.07 whole square, it is 6 lakh 11,407. Yes or no, everyone? Now all the students are watching it on YouTube, remember this is a rocket revision. Yes, I'm not here to explain each and everything. I can explain each and everything, but it will take time. This is best for your one day before examination, and I cannot shout. This is the maximum. Okay, doctor has told me not to speak beyond 10 minutes, but because you guys are having examination, I'm still coming, still trying to do this for you guys. Yes, I really can't tell you how much straining it is. Every 5 minutes I'll have to stop, because after that the words are not coming out. Okay. Fine. Now tell me, total 6,11,407 I have to invest. Then comes step number 4, calculate investment in each bonds. I'm having bond A as well as bond B. How much percentage we are putting? 50%, 50%. Total investment is 6,11,407. So that means it is 3,05,700, 3.5. Accordingly, so on. Now tell me, do I know the price of each bond? Yes, boss, we have calculated. Tell me, bond A, one bond is 980 rupees. If I have to invest 3,05,703 means how many bond I should be purchasing? Cross multiplication, I can calculate the number of bond as well. Is this clear, everyone? This is a type 1 question in case of 2 bond. Now comes type 2 question in case of 3 bond. Same set of steps, students. In case of 3 bond, yes, it is also very simple only. Just remember, if there are 3 bond, yes, I have to calculate weight of all the 3 bond. Now weight of one of the bond will be given. The weight of other bond, I will assume it as x. Third bond, I will calculate in such a way that summation of the weight should be equal to 1. Yes, now look at this, everyone. Yes, weight of one of the bond will always be given in the question. Assume, question is telling, invest in bond A, B, C to immunize the portfolio. If 45% is invested in A, that means weight of A is how much? 0.45. Let us assume weight of B is equal to x. I know that summation of the weight should be equal to 1. Therefore, weight of A plus weight of B plus weight of C should be equal to 1. Weight of A is 0.45. Weight of B is x. Weight of C is how much? It is 1 minus 0.45. Yes, which is 0.55 minus x. Is this clear, everyone? Based on this, do the same set of steps. Look at this, everyone. We are having the next example. Rocky Bhai will need 10 lakh after 3 years for making improvement in KGF. Yes, current yield is going to be 10%. Bond is given, price is given, years is given, duration is given. Okay. Calculate the investment to be made in each bond if he has to invest 40% in A. Okay, fine, boss. Tell me, yes, what are the steps? Step number 1, calculate duration. Because these are example questions, duration I have only given. In the exam, we have to calculate duration. Okay, boss. Now, then comes step number 2. Is calculate duration of each of the bonds. Step number 2, calculate weight. Let us assume weight of A is given 0.4. Weight of B is equal to x. Yes, weight of C I should calculate. Summation of the weight should be equal to 1. 0.4 plus x plus weight of C should be equal to 1. Therefore, weight of C is 0.6 minus x. Yes or no, everyone? Okay. Now, he wants money when after 3 years. So, he is investing for 3 years. So, yes, we will invest in such a way that the weighted average duration is equal to the investment period, which is 3 years. Weighted average duration. Weight of A is equal to 0.4 into duration of A2. 0.4 into 2. Plus weight of B, it is x into 3.5. Weight of C, it is 0.6 minus x into 4 should be equal to 3. Calculate the value of x. Now, value of x is weight of B is 0.4. Therefore, weight of C is 0.6 minus x, which is going to be 0.2. Is this clear, everyone? Okay. Now, once we have done same set of steps, yes, calculate total investment in bonds. Tell me, he wants 10 lakh after 3 years. For that, he is investing today. It is present value. Yes, 10% is a return divided by 1.1 to the power 3. Is this clear, everyone? We will arrive at the total investment. Yes, if we split in the ratio, we will arrive at the individual investment. If I divide by the price, I will arrive at the number of bonds to be purchased. Is this clear, everyone? Now, in case of 3 bond, now question will ask one more requirement. If it comes for 8 marks, it has come also. They will ask, boss, if YTM changes, whether the bond is still immunized. Now, know that, students, if my YTM changes, my individual duration also changes. That means weighted average duration also changes. So, bond is no longer immunized. I need to calculate the revised weight. What I need to do? Look at this, students. Question is asking, yes, after portfolio is formulated, yield changes to 12%. Revised duration is as follows. Okay, is the portfolio still immunized? Why or why not? Tell me, revised duration is given. I know the weight. Using the weight, can I calculate the weighted average duration of the portfolio? Yes, boss. I will calculate the weighted average duration of the portfolio. It is coming to 3.2. But boss, I want to invest for 3 years. So, yes, my weighted average duration is not equal to the investment period. So, I will tell bond is not immunized. Then how do I immunize? Recalculate the weight. Let me assume, yes, weight of bond A is given in the question, 0.4. Weight of B is equal to X. Weight of bond C is equal to 0.6 minus X. Accordingly, calculate the values. Is this clear, everyone? Perfect. Yes, on this we are having two questions, which is question 15 and 16, exact replica of the examples we have solved. The only difference is that in the example, yes, duration I have only given. Why? So that we need not spend much time. We focus on the concept. In the question, duration also we should be calculating. Is this clear, everyone? Perfect. So with this, unit number 2 is done and done over, my dear students. Yes, everyone, let us proceed further to unit number 3, which is going to be special areas. Here we are having 3 different concepts. Concept 1 is convertible bond, concept 2 is bond refunding, concept 3 is money market instruments. For CMA final students, only convertible bond is there, 2 and 3 is not there. Okay, convertible bond, what is it? It is a bond which gives an option to the bondholder to convert into fixed number of equity shares. Yes or no, everyone? It is also called as OCD, optionally convertible debentures. Some 10-15 calculations are there, different formulas are there, students confuse it. We will always do the calculations in 3 different buckets. First one is a conversion related calculations, that is a equity related calculation. Next one is a straight value related calculation, which is the bond related calculation. Next one is favorable income differential and its related calculation. Okay, directly through an example, let us try understanding. Example number 20. Majaa Limited issued 8% convertible bond having a face value of 1000. Okay, market price of the bond is 1250. Okay, at what price? It is trading 1250. Other information is given as follows. The number of shares per bond. It is a convertible bond. Yes, this convertible bond can be converted into how many shares? It can be converted into 20 shares. This is called as a conversion ratio. What is conversion ratio? One convertible bond can be converted into how many equity shares? Okay, fine. Current market price of the share is 55. Okay, what is conversion ratio in this example? One bond can be converted into how many shares? 20 shares. Therefore, conversion ratio is equal to 20. Okay, point number 1 is bingo over. Second one is conversion value. Yes, if I convert what? The bond into the shares, what is the value today? Tell me, students, one bond can be converted into how many shares? 20 shares. What is the price of one share? 55. So what is the conversion value? It is 55 per share into 20 shares. It is going to be 1100. Simple, yes or no, everyone? It is a market price per share into the conversion ratio. Yes or no, everyone? Okay. Then comes the third one, which is the conversion premium in rupees. Tell me, students, ultimately, if I wanted those equivalent 20 shares only, I could have directly gone to the market and paid 1100 and got the shares. But boss, I purchased the convertible bond. For that, how much I have paid? 1250. So how much extra, how much premium I have paid? Yes, for getting the conversion option, I have paid a premium of 150 rupees. Yes or no, everyone? Okay. Conversion premium in the form of rupees is going to be 150. Now, always remember, whenever question asks you conversion premium, it is compulsory that we calculate in the form of a ratio. Now, remember one very simple point, students. Whenever I tell increase is always from a small value. Simple. The value was 100. Now it has increased to 150. Can I tell from 150 it has increased to 100? No, it doesn't make sense. From 100 it has increased to 150. So if I want to calculate the percentage increase, I will tell how much it has increased. 50. From where? From the lower value it will increase. 100. So 50 divided by 100 into 100. Yes or no, everyone? Always remember, percentage increase is always from a lower value. Percentage decrease, from where it will fall? From a higher value. Yes or no, everyone? Suppose I am telling from 150. Yes, I was selling it at 150. Now I am selling it at 130. So my price has reduced by 20. From where? 150. If I'll have to calculate the percentage, it is 20 divided by 150. Always premium is from a smaller value. Yes, discount is from a higher value. Remember this. If you know this, yes, we will never ever commit a mistake. Tell me, question is asking me the ratio of conversion premium. How much extra percentage I've paid? Tell me, students, if I wanted 20 shares only, directly I could have gone to the market and paid 1100, which is a conversion value, and got the shares. But boss, I purchased the optionally convertible debenture. How much I have paid? 1250. That means how much extra I have paid, how much premium I have paid. I have paid extra 150, yes or no everyone. If I want in the form of a ratio, 150 extra I have paid. From where? Increase is always from the lower value, from 1100 into 100. So it is 150 divided by 1100 into 100, which is 13.64 percentage. If you want it in the form of a formula, yes, it is conversion premium in rupees divided by conversion value into 100. But why on earth do you want the formula? Simple halwa, yes or no everyone. Okay, fine. Next one is the conversion premium per share. Tell me total how much premium I have paid. 150. This 150 premium is for total how many shares? It is for 20 shares. That means what is the conversion premium per share? Sorry students, 150 is for 20 shares. That means it is 7.5 per share. Yes or no everyone. Now one thing, yes, I'm extremely sorry for you guys. Now I myself know that the output that I'm giving it to you guys is not to the level that I can give it to you guys, because trust me, I'm having a very heavy head. So at times I'm myself blanking out with the lights and other things and having a heavy head. Yes, literally every 10 minutes I'm taking a break, I'm coughing. Yes, I'm having betadine, which is, gargling thing. I'm drinking, sipping hot water, again coming back and doing the thing. Okay, it's difficult, but okay, for you guys, anything. So if you guys are loving it, boss, it is going to be your duty that you like, you put forward your comments, you give your examination, you do crazy amazing in your examination, come back and tell, boss, crazy revision it is. Yes, do recommend to your friends, juniors also for CA final, CMA final. Is this clear everyone? Okay. Then comes conversion parity price. Yes, it is the effective price of one share. Tell me students, how much did I pay to purchase a convertible bond? 1250. Now if I purchase this and convert, how many, yes, shares I will be getting? 20. That means effectively for one share how much I'm paying? Tell me, for 20 shares I'm paying 1250. That means for one share how much? It is 1250 divided by 20. Yes or no everyone? Perfect. It is market price of optionally convertible debenture divided by conversion ratio. 1250 divided by 20, it is going to be 62.5. Yes or no? It is the effective price per share we are paying on a optionally convertible debenture. Is this clear everyone? First bucket of calculations are over. Conversion ratio, if I convert one bond, how many shares I'm getting? Conversion value, also called as the stock value, if I convert, what is the value? It is a market price per share into the conversion ratio. Third one is a conversion premium, also called as conversion premium ratio. Okay, how much premium I have paid? Yes, boss, ideally, if I wanted to purchase shares only, I would have paid conversion value, but I have paid the market price. The difference is going to be the premium. It is the market price minus the conversion value. Yes or no, everyone? If you want it as a percentage, it is a conversion premium from where? Divided by conversion value into 100. Yes or no, everyone? Okay, fine. Conversion premium per share, you've got the conversion premium divided by conversion ratio. Next one is going to be the conversion parity price, effectively for one share how much I'm paying. It is a market price divided by conversion ratio. Next is going to be second bucket of calculation, which is a straight value and its related calculation. Boss, your convertible bond is having bond feature. Yes, for that related some calculations. Okay, look at this everyone. Company has issued a convertible bond with the following features. Just a second students. Face value is 1000, coupon is 6%, maturity is 3 years, market price is going to be 1150. Now market required return on similar non-convertible bond is 8%. If it was a non-convertible bond, investor would be happy with 8%. Okay, calculate straight value of the bond. What is a straight value? Straight value, it is the value of the bond if it was a normal bond, that is non-convertible. There is no option to convert. Normal bond means how much is the value of this bond. Simple, boss. Assume this is a normal bond. Suppose there is no wording of convertible on it. It is a normal bond. Tell me 1000 is a face value. Every year 6% coupon it is paying for 3 years. That means every year 60, 60, 60 it will give. At the end of 3 years I will redeem at 1000. Yes or no, everyone? If it was a normal bond, how much I would have paid? Tell me, for a normal bond, how much return investor wants? 8%. So I will discount these cash flows at 8%. That is going to be the straight value of the bond. Yes or no, everyone? Yes, I will arrive at straight value of the bond as 948.62. Is this clear, everyone? Okay. That means ideally, if it was just a bond, I should have paid only 948.62. But boss, I am paying how much? I am paying 1150. Yes, that means how much premium I am paying over the straight value. Yes, how much premium I am paying over the straight value? It is 1150 minus 948.62, 201.38. Yes or no, everyone? If question asks you premium over straight value, we will calculate in rupees also, percentage also. How much extra I am paying? 201.38. From where? Always remember students, premium increase always from the lower value, yes or no everyone? Simple. Straight value is 948.62. Ideally I should have paid that much only, but boss, because there is a conversion option, how much I'm paying? 1150. So how much extra I'm paying? 201.3. From where? From 948.62, convert it into percentage. 201.38 divided by 948.62, it is 21.23 percentage. Is this clear everyone? Okay, it is a premium divided by straight value into 100. Next one comes the percentage of downside risk. How much will the value fall? Tell me students, now if it was purely a bond, how much only I would have paid? 948.62. But now how much am I paying? 1150. Why? Because with the bond there is a equity option as well, yes or no everyone? But equity option, if company performs well, that option is of value. If company is not performing well, yes, nobody wants to convert into equity, that yes, option is of no value, yes or no everyone? Okay, so there is a risk. So question is asking how much will the yes value of the bond fall, maximum percentage of downside risk. Right now the value of the convertible bond is 1150, maximum till where it will fall. We will tell that, boss, right now the bond value is 1150, max to max, assume company is not performing well, equity value will become 0, but the bond value will still be there, so it will fall and maximum reach 948.62. That means maximum how much it can fall? 201.38. From where? From 1150. So it is 201.38 divided by 1150 into 100, it is 17.51 percentage. Simple. Yes, percentage of downside risk. Yes, we will calculate the downside risk, how much it can fall from market price to straight value, divided by, from where falling is always from the higher value, divide by market price into 100. Yes or no everyone? Perfect. This calculation is also over, my dear students. Is this clear everyone? Okay, then comes the third bucket of calculation, which is a favorable income differential and its related calculation. Look at this everyone. Example 22, convertible bond is there, face value is 1000, coupon is 8%, can be converted into 20 shares. Okay, market price is 55, dividend per share is 2 rupees, market price of the convertible bond is 1200. Calculate the favorable income differential per share. Now understand students, assume ultimately I want the share only, that is, tell me ultimately what is the conversion ratio? 20. So ultimately I want to share 20 shares only. What all options are available with me? Option number 1, I purchase directly from the market 20 shares, yes or no everyone? Or option number 2, I purchase an optionally convertible debenture. In future whenever I want, I convert into share. Okay, now tell me students, if I am directly purchasing 20 shares, how much I have to be paying? 55 per share into 20 shares, 1100 only. But if I am purchasing an optionally convertible debenture, 1200 I have to be paying. That means how much premium I should be paying? 100 rupees extra I should be paying, yes or no everyone? Okay, why am I willing to pay this 100 rupees? Because if I purchase a bond, it gives me a higher interest. That is what we are going to calculate here. Look at this everyone. Tell me, if I directly purchase 20 shares, how much dividend I will get on every share? 2 rupees. That means on 20 shares, how much only I will be getting? 40 rupees, yes or no everyone? But if I purchase a bond, okay, tell me how much income it is giving me? 8% coupon, 1000 into 8% means 80 rupees it is giving me, yes or no everyone? That means if I purchase a convertible bond, how much extra income I am getting? 80 minus 40, 40 rupees, yes or no everyone? That is the favorable income differential. It is the interest on the bond minus dividend on equivalent shares. Is this clear everyone? If question asks you the favorable income differential per share, tell me for one share how much it is. Tell me 40 rupees is extra income for 20 shares. For one share it is 40 divided by 20, it is going to be 2 rupees per share. Is this clear everyone? Okay, fine, that calculation is over. Favorable income differential per share. Okay, then if question asks you the premium payback period, tell me students, to purchase the optionally convertible debenture, have I paid a premium? Yes boss. If I am directly purchasing 20 shares, na 1100 would be sufficient, but boss, I paid 1200. That means how much extra I paid? 100 extra I paid. Why did I pay 100 extra? Because boss, every year 40 rupees extra income I am getting, yes or no? So this premium of 100 that I have paid, in how many years I can recover? Tell me students, first year I will recover 40, second year I will recover 40, in the next half year I will recover 20. That way I have recovered. Simple. Yes, in 1 year I am recovering 40 rupees. I want to recover 100. That means how many years? It is 100 divided by 40, 2.5. Yes or no? Or else it is the conversion premium, how much extra I have paid, divided by favorable income differential. Is this clear everyone? This calculation is not very important, but still I have explained to you guys. Is this clear everyone? Now if you are coming to our super 100 questions, yes, there is example 23 from our workbook, which is comprehensive. Yes, we have seen example 20, 21, 22 individually we have done. Example 23 includes everything. I'm not going to solve it again. And then there is question number 22, which is a beautiful question on a reverse calculation. Look at this, students. It has come in the MTP. Information is given for 7.5 percentage convertible bond, which is currently priced at 5,300 per bond. Okay, conversion parity price. Okay, effectively for one share, how much is the price? 265. Tell me total how much I am paying? 5,300. So can I calculate? Yes, how many shares I'll be getting? Yes, boss. For one share, effectively I'm paying 265. So if I've paid 5,300 means, yes, cross multiplication 5,300 divided by 265. I guess the conversion ratio is going to be 20. Yes or no, everyone? Okay. Conversion ratio, I can be converting it into 20 shares. Okay, fine, boss. Calculate the number of shares on conversion. Okay. Conversion premium based on market price is 10.4167 percentage. Conversion premium, we have told always will be calculating as a percentage. Okay. Tell me, how do I calculate conversion premium? Yes, boss. I know the market price of the bond. If I know the conversion value, from conversion value, how much extra? Yes or no, everyone? In the example, conversion value is 1100, but boss, market price is 1250. That means 150 extra I paid. 150 divided by 1000 I did. Now here in this question, do I know the conversion value? I don't know the conversion value. Whatever we don't know in life, we will assume it as X. Let us assume conversion value is X. Market price is 5,300. Yes or no, everyone? That means what is a conversion premium? Yes, boss. Assume this is randomly 4,000. That means how much premium? 1,300. How did I get? Market price minus conversion value. So it is 5,300 minus X. It is a conversion premium in rupees. I want in percentage. 5,300 minus X divided by, from where it is increasing, from the conversion value. Yes, divided by X. Yes, gives you the ratio. How much is the ratio? 10.41667 percentage. Either you do into 100, you write it as a number, or you write it as a decimal point. 10416667. Simplify. We will arrive at the value of X, which is the conversion value 4,800. Tell me it is a total value of shares. Tell me if I'm converting, if I'm opting for equity, how many shares I will get? 20 shares. So the value of 20 shares is 4,800. So for one share, how much? 4,800 divided by 20, it is going to be 240. Is this clear, everyone? Okay. Now the next calculation is current the market price. Okay. Percentage of downside risk based on the straight value of the bond is 12.766 percentage. Now remember, students, logically, whatever we have discussed above is the perfect thing, but sometimes institute commits blunders whenever they are calculating percentage of downside risk. Yes, what makes sense? From 150 it fall to 100, or from 100 it fell to 150, from 150 it fell to 100. Okay, but here percentage of downside risk I am calculating based on straight value. Now previously how I used to do, boss, I am having the market price of the bond 1200, it will fall to the straight value, say for example 900. So it fell by 300. From where? From 1200. I used to do 300 divided by 1200 into 100. But here, because they have told based on straight value, I will be doing 300 divided by 900 into 100. Is this clear, everyone? Okay. Only if institute specifically tells. Okay. It is a percentage of downside risk based on the straight value of the bond, 12.766 percentage. Okay. Now I don't know the straight value. Let me assume it as X. Market price is 5,300. Straight value is X. So downside risk is 5,300 minus X. Yes, I want it based on the straight value. Yes, divided by X. Yes or no, everyone? Yes, which is 0.12766. Simplify. We will arrive at the straight value as 4,700. Is this clear, everyone? Yes, based on that, yes, all the calculations are over, my dear students. Is this clear? With this concept number 1, which is going to be convertible bond, is over. Yes, so many times questions have come based on this, my dear students. Okay. Yes, one more small adjustment is there. Yes, premium we should always calculate on lower value, discount we will always calculate on higher value. Okay. Now decision making, when should we convert into shares? Okay, pay attention, students. I am having an optionally convertible debenture which can be converted into 20 shares. Is this clear, everyone? Okay, fine. Now yes, assume today the market price of the share is 50. Is this clear, everyone? Okay, fine. Now look at this. There are two options available with me. Either I can convert into share or I can retain it as bond. Yes, if I convert into share, what will I get? I will get the conversion value. Yes or no? If I retain it as share, yes, sorry, if I retain it as a bond, what only I'll be getting? I'll be getting the straight value. Now when will I opt for conversion. I will opt for conversion if the conversion value is greater than the straight value of the bond. Is this clear, everyone? Only then it is beneficial. Okay, look at this, everyone. Situation 1. Yes, conversion value is 950. If I convert into share, benefit is 950. But if I hold it as bond, the benefit is 1000. What will I do? Hold it as bond, don't convert. Yes, if I convert into share, the benefit is 1050. But if I hold it as bond, the value is 1000 only. Boss, here convert it. Is this clear, everyone? We will convert only if the conversion value is greater than the straight value of the bond. Is this clear, everyone? With this, concept number 1 is over. Yes, everyone, let us proceed further to concept number 2, which is going to be bond refunding, also called as callable bond. Imagine we have raised 1000 rupees by issuing a 10% bond. That means, tell me, every year how much interest we should be paying? Yes, 100 rupees interest we should be paying. Yes, this was the interest rate prevailing when the bond was issued. Now 5 years later, the interest rates have fallen. Now bond can be issued at, say for example, 6%. So if I issue at 6%, how much interest only I'll be paying? 60 rupees. Now the question is, should I cancel, refund the existing bond and issue a new bond? That is what we are going to discuss here. Sir, we should go ahead, sir. Sir, previously we were paying 100 rupees interest. Now it is 60 rupees interest only. Every year, yes, we are going to save 40 rupees in the form of interest. Yes, it is the same decision we are going to do. Now, if we go for a bond refunding decision, what will happen? Every year we will save interest cost. Yes or no, everyone? This is going to be the benefit I will be getting every year. But wait, boss, it is not that simple. Yes, initially when I'm taking a bond refunding decision, I will have to return the money to the existing, yes, bond holders. I'll have to be paying them some premium, some to issue the new bond, some extra cost they should be incurring. All those things will be there. This becomes like a typical advanced capital budgeting decision wherein I have to calculate NPV. There is an initial cash outflow. If I decide that I'm going to refund the bond today, there will be some cash outflows. Then throughout the period there will be cash inflows. Yes, I will bring all the cash flows to the present period. Yes, calculate NPV. If NPV is positive, go ahead with the bond refunding decision. Otherwise, don't go ahead. That is what this is. Not very important from the examination perspective, but a beautiful concept, my dear students. Now, yes, concept number 2 as well as concept number 3 is not there for CMA final students. Needless to say, I have told it already. Okay, now, pay attention. How do we solve a question? Yes, it's going to be a 3-step framework. Step number 1, calculate initial cash outflow. Now in the regular batch, yes, we've explained it detailedly. Here quickly I'm only going to tell you the steps. The day I'm going to take a bond refunding decision, initially total 4 cash flows will be there. 3 outflow, 1 inflow. Okay, what are the cash outflows? First one is the call premium post tax. For my existing bond holders, when I'm returning their money, they will ask for a premium. It is called as call premium. That is going to be cash outflow for me. Is this clear, everyone? Okay, call premium, but I will be considering it post tax. Sir, why sir post tax? It is for my existing bond. So if I pay today means that story is over. Yes, I will be putting it in the P&L, so I'll be getting the tax benefit. Is this clear, everyone? I will calculate call premium post tax. Okay, next one is going to be flotation cost on issue of new bond. To issue a new bond, I will be incurring some flotation cost. That also I am incurring today as cash outflow. That also I will be considering. Remember, on the flotation cost, I will not be showing the tax adjustment. Why? Because even though the flotation cost is incurred today, it will give me benefit for the future. So every year I will put some amount to the P&L. Is this clear, everyone? So here I am only going to show the cash outflow. Okay. Third one is going to be the overlapping interest on old bond post tax. Now, when I'm cancelling the existing bond and issuing a new bond, there will be a period wherein old bond is also there, new bond is also there. Because first I should issue new bond, raise money, only then I can return the old bond. Yes or no, everyone? So for this period, there will be overlapping interest. I am paying interest on the new bond, but boss, I am paying interest on the old bond as well. So I need to consider the overlapping interest. That also I am incurring because of this bond refunding decision. Overlapping interest on the old bond. Yes, but I will be considering it post tax because I will be getting a tax benefit on this. Is this clear, everyone? Okay. Then we will be having a cash inflow. Yes, what is a cash inflow? It is a tax saving on unamortized discount and issue cost of old bond. Now, originally when I had issued the old bond, I would have issued it at a discount, could be possible, or I will be having flotation cost. Suppose I issued my old bond 5 years back, I incurred a flotation cost of, say for example, 10 lakh rupees. I thought this bond will be there for 10 years, so I will not be directly dumping the entire amount to P&L. Every year 1 lakh, 1 lakh, 1 lakh, 1 lakh, 1 lakh, I will be dumping. Is this clear, everyone? Assume 5 years are over. So in 10 lakh, yes, 5 lakh I have already transferred to P&L. So what is the unamortized cost? 5 lakh is still pending. Yes, what I was previously thinking, every year 1 lakh, 1 lakh I will put it to P&L, thereby get a tax benefit. But boss, now old bond itself is cancelled. So there is no point in keeping this balance, yes or no everyone. So this entire amount will go to P&L right away, yes or no everyone. So this 5 lakh will go to P&L. Yes, once it goes to P&L, it will be shown as an expense. Based on that, I will be getting tax benefit, yes or no everyone. So I will calculate, yes, the unamortized discount and issue cost. Yes, how do I calculate that? Yes, I will look at the, yes, discount and issue cost into remaining years divided by total years. In our example, total 10 lakh was amount. In that 5 years are over, 5 years is spending out of 10, so that means 5 lakh amount is spending. This will go to the P&L. Because of that, I will get tax benefit into the tax rate. Is this clear everyone? These three are outflows. Call premium I am paying, issue cost of new bond I am paying, overlapping interest I am paying, but tax saving I am getting. Yes, so that is why it is shown as a reduction. Yes, that gives me my initial cash outflow. Is this clear everyone? Step number 1 is over. Then comes step number 2. Yes, so why am I incurring cash outflow? Because every year there will be a saving in cost, yes or no everyone. Now how do we do that? A beautiful framework we have done. Trust me, yes, this question students consider to be the most difficult, but we made it very simple using a simple beautiful framework, my dear students. Trust me, it cannot get simpler than this. Yes, this framework we are giving it to all of you guys. Okay, now look at this everyone. I will calculate the annual saving in cost. How do I see? Suppose I have already told previously my interest cost is 100. Now my interest cost is 60. That means what is the saving in cost? 40. Same story I will be doing. Yes, I will show old bond, I will show new bond. The difference is going to be the cost savings. Is this clear everyone? Okay. Old bond, what do I show? Firstly, I will show the post tax interest cost. Say for example 1000 rupees I had raised, 10% is interest. That means 1000 into 10% is going to be 100. But tell me whether full 100 is going to be my cost? No boss. When it is going to P&L, I will be getting tax benefit. Assume 30% is the tax rate. That means into 70%, 70 rupees was a post tax interest cost there. Is this clear? Similarly, I will be doing for the new bond. Okay, wait. Now if old bond were continuing, then what would have happened? Yes, on the old bond I had incurred flotation and discount cost. That would have gone to P&L every year, because of which I would have got some tax saving, yes or no everyone. That also should be adjusted. So post tax interest cost minus the tax benefit on the flotation cost. Suppose randomly I'm telling, okay, if old bond was there, every year effectively 70 rupees would be my cash outflow. 100 is my interest, on that 30% tax benefit 70 rupees. Now if old bond was there, on the old bond whatever flotation cost was there, that will be going to P&L. Because of that I will be getting some tax benefit. Assume the tax benefit would be 10 rupees. That means on the old bond effectively cost was how much? 60. Assume on the new bond effectively cost is 40. That means what is the saving in the cost? 20 rupees. Is this clear everyone? Here I'm not going to explain much. Very simple framework we have built. Old bond, new bond. I will show the post tax interest cost minus the tax saving on flotation cost gives me the net cash outflow. Is this clear? And the difference between old bond and new bond is going to be the annual cost saving. Is this clear everyone? Okay. Now it comes like an NPV decision. Today I am incurring initial cash outflow. Step number 1. Every year from here to nth year I will be incurring cash inflow, which is a savings in cost. Yes, what I will do, I will calculate present value of cash inflows minus initial cash outflow gives me the NPV. If NPV is a positive, that means bond refunding should be accepted. NPV is a negative, that means bond refunding should be rejected. As simple as that. Is this clear everyone? Okay. Now very important thing is the discounting rate to be used. If discounting rate is given in the question, bingo, absolutely no tension. If discounting rate is not given in the question, in that case, yes, what is the interest rate prevailing right now? The interest rate on the new bond is prevailing right now, yes or no everyone? So I will be considering the post tax interest cost on the new bond, post tax interest rate on the new bond. Is this clear everyone? This is the point we should be knowing. Is this clear everyone? Okay. Based on that we are having questions. Now I will not be going into questions, but in the workbook now what I have done is, yes, I have created, yes, Majaa adjustments, that is from the questions where all will be having problems that I have created as small adjustments. We will see that. Pay attention students. First one is calculation of call premium post tax. All adjustments we have put here. We are contemplating calling means refunding 3 crore of 30 years 1000 rupee bond. Total 3 crore is a face value. Yes, 30 years is a total life. 1000 rupees is the face value of one bond. Okay, having a call price of 1140, tax rate is 40%. Calculate the post tax call premium. Okay, fine. Tell me students, what is the total value of bond? 3 crore. What is the face value of one bond? 1000. Can I calculate the number of bonds? Yes, boss. Number of bonds is 3 crore divided by 1000. 30,000 bond. Is this clear, everyone? Okay. Tell me, face value of a bond is how much? 1000 rupees. But if I have to return the bond midway, whether investors are accepting if I return to them 100,000 rupees? No, they're telling, boss, you pay 1140. That means tell me how much premium I have to pay to them for one bond. 140 is a premium, yes or no, everyone? That means what is the total premium I should be paying? 140 per bond into 30,000 bonds gives me the total premium that I'm paying, yes or no, everyone? But boss, when I'm paying, I will be getting tax benefit. Yes, tax rate is going to be 40%. That means effectively my cost is how much? Only 60% only. So into 60% gives me 25,20,000. It is a call premium post tax. Is this clear, everyone? Okay. One more adjustment is there. Look at this, everyone. We are contemplating calling 3 crore bond of 30 years. Call premium is 4% and the tax rate is 40%. Calculate the post tax call premium. Okay, simple. Total 3 crore bond we are refunding, yes or no, everyone? Okay. How much premium when I'm returning? How much premium I should be paying? 4% into 4%. This is what I'm paying. But because of that, I'll be getting tax benefit. How much is the tax benefit? 40%. That means effectively my cost is how much? Only 60% only. Is this clear, everyone? 7,20,000. Is this clear, everyone? Okay. Next one is calculation of tax saving on unamortized discount and issue cost of old bond. Pay attention, beautiful. We are contemplating calling 3 crore of 30 years 1000 rupees bond. Okay, fine. Which was issued 5 years ago. When was it issued? 5 years ago. Total 30 years, 5 years are over. 25 years is pending. Okay, fine. We had initially collected proceeds of 2.91 crore due to a discount of 30 per bond. Tell me what is the total face value? 3 crore. How much only we collected? 2.91 crore. That means how much discount was there? 9 lakh discount was there. Tell me, students, in accounting, yes, when we issued the bond, yes, 9 lakh discount was there. This entire 9 lakh discount, will we be, yes, dumping it to the P&L, transferring it to the P&L in the very first year only? No. We will tell, boss, this bond, this money was raised for 30 years. So across 30 years, we'll be dumping it to P&L. Yes or no, everyone? Okay. 9 lakh is a discount cost. Okay, fine. Now, initial flotation cost was 3,60,000. Initial flotation cost is 3,60,000. That means tell me what is the total value of a discount and initial flotation cost? 9 plus 360, 12,60,000. Yes or no, everyone? Now this 12,60,000 every year, yes, one portion I was dumping it to P&L. I thought 30 years was there, so 12,60,000 divided by 30 every year I was dumping. This way, for how many years I have transferred to P&L? 5 years I have transferred. That means how much value is pending? 25 years value is pending. So the value pending is 12,60,000 into 25 divided by 30, which is 10,50,000. Yes or no, everyone? Okay, fine. Now, right now what is happening? Old bond is gone. We are issuing a new bond. So if we are issuing a new bond, this value, discount and flotation cost is no longer giving me benefit in the future. So this value right away I will dump it into P&L. Yes, tell me how much value I will dump it into P&L? 10,50,000. When I'm dumping it into P&L, yes, my cost gets my cost increases accordingly. My tax gets saved. How much is a tax rate? 40%. So 10,50,000 into 40%, 4,20,000 is a saving in the cost. Is this clear, everyone? Yes or no? So this one we have seen. Based on this adjustments also we have seen. Yes, in the super 100 questions, I guess we are having question number 23 and 24. You guys try it once by yourselves. Is this clear, everyone? Okay. Now we are having the final concept, which is concept number 3, money market instruments. Here we are raising money for short term, effectively for a period less than 1 year. Is this clear, everyone? Now, yes, it's again a small concept, but the time we have allocated for equity, what is it? Bond valuation chapter has exceeded. That is why I will not be discussing this. Some small 2-3 different types of questions are there. Calculation of yield, return percentage calculation. Yes, then yes, calculation of total cost on issuing a commercial paper. Then yes, there is a question on calculation of break even, for how much period I should be holding. Then there is repo, reverse repo. Please once see it by yourself, because we are lacking time and we have to do revision of other chapters. Right now I am not doing it. Is this clear, everyone? Yes, I know I could not give the 120% which I otherwise give in the revision because of this voice problem. Literally, you guys would not believe. Yes, every 15 minutes I'm recording, I'm taking, yes, I'm going, I'm gargling, yes, again 15-20 minutes I'm taking a break, drinking hot water, again coming back, trying to somehow put in 15 more minutes. Again the head is heavy, but still, yes, we guys are doing it for you. If you guys are loving it, means I want you guys to freaking put your heart out in the comments, share it to all your friends, tell crazy revision is happening.
Yes, everyone. So, hello, hi, namaskaram, and good morning, students.
Good morning, sir.
I hope you guys are having a crazy day. If not, let's make this a crazy day for you guys. Yes, everyone, this is going to be a quick rocket revision for the chapter mergers, acquisitions, and corporate restructuring. The entire chapter we are having two units, unit 1, unit 2, but before that, unit 0, let's quickly have a look at the basics. Corporate restructuring, change, reorganizing. We are reorganizing the business operations. Why? In order to improve the performance. We are changing the operations, yes, or the capital structure or the business strategy. Why? To improve the performance. Now, how all corporate restructuring can happen? It can either be internal restructuring, it is happening within the company, or it could be external restructuring. It is including external companies or parties. Say internal restructuring, you decide to come up with a new product, you raise more equity. Yes, all these things are going to be examples of internal restructuring. You come up with a demerger, you split your shares. External restructuring, it includes external parties. Example is going to be mergers and acquisitions. Yes or no? Yes, 95% of the chapter is mergers and acquisition. What is mergers and acquisition? There is one company which purchases the other company. The company that is purchasing is called acquirer company. The company which is selling is called a target company. Yes, whether target company will sell itself for free? No, it wants a purchase consideration. Purchase consideration may be discharged either in the form of shares offer, or in the form of cash offer. Yes or no, everyone? Perfect. And we'll always be assuming that target company will cease to exist after the merger. Is this clear, everyone? Some basic formulas. Total number of shares is equal to shares held by promoters plus shares held by non-promoters. So based on that, promoter holding percentage, it is the shares held by promoters divided by total number of shares into 100. Assume total 100 shares are there, 60 shares are held by promoters, that means 40 will be held by non-promoters. Promoters holding percentage, shares held by promoters 60 divided by total number of shares 100 into 100, 60%. Non-promoters holding percentage, it is shares held by non-promoters 40 divided by total number of shares into 100, it is going to be 40%. Yes or no, everyone? Then comes market capitalization. We have a total market capitalization, we have promoters market capitalization, we have free float market capitalization. Total market capitalization, it is a value of all the shares. It is market price per share into total number of shares. Promoters market capitalization, it is a market value of shares held by promoters. So it is market price per share into number of shares held by promoters. Free float market capitalization, it is a market value of shares which is freely floating in the market. Yes or no, everyone? That is basically held by non-promoters. So it is market price per share into number of shares held by non-promoters. Is this clear, everyone? Other basic formula, EPS, earning per share. It is a total profit to equity holders divided by number of equity shares, which is basically your Patesh divided by number of equity shares. Market price per share, it is EPS into P ratio. I know P ratio is equal to MPS divided by EPS. Using this, my MPS is equal to EPS into P ratio. Book value, yes, prepare your balance sheet. It is equity holders fund. Yes or no, everyone? You can either tell it is equity share capital plus reserves and surplus, or total assets minus my total liabilities. Is this clear, everyone? So with this, we have successfully finished unit number 0, which is going to be the basics. Now it is time for us to take our discussion forward to unit number 1, which is mergers and acquisition. 95% of the chapter is going to be mergers and acquisition. In that also, shares offer is going to be the predominant thing. Is this clear, everyone? Perfect. So all the calculations when it comes to shares offer, we have bifurcated into 4 different buckets. Is this clear, everyone? First is a calculation of exchange ratio. Second is going to be the post-merger values. Third is going to be impact of merger on shareholders. Fourth is going to be the calculation of minimum maximum exchange ratio. Perfect, everyone. First calculation is calculation of exchange ratio. What on earth is exchange ratio? Yes, boss, there is an acquirer company, there is a target company. In our example, yes, we are MFC, Majaa Flying Cars. There is a Tesla. Tesla wants to purchase MFC company. Yes or no, everyone? So we are asking, how will you make payment, boss? He told, we will issue shares of Tesla. In exchange of that, you transfer the company. Is this clear? Yes. What is exchange ratio telling? It is answering the question, how many shares of new company will be issued for every 1 share of the target company? Say for example, we are MFC, we are the target company. I am a shareholder who is holding 1 share. In exchange of 1 share, how much new share I am going to get, that is going to be the exchange ratio. Say for example, exchange ratio is equal to 0.5. It means that if I am holding one share pre-merger, post-merger, in exchange of that, I will be getting 0.5 shares of the new company. Is this clear, everyone? Okay. Now we have a 3-step golden framework to solve any questions wherein exchange ratio we will be calculating, and every question on shares offer we will be following these 3 steps. Yes or no, everyone? What are the 3 steps? Step 1 is calculate exchange ratio. Now how do we calculate exchange ratio? We've told firstly, in case of positive factor, exchange ratio is T divided by A, target divided by acquirer. Simple, I've told Tabish, TA, T divided by A. Yes or no? Logically also I have told, say for example, we are having Tesla, we are having MFC, Majaa Flying Cars. Assume I am calculating based on MPS. Tesla is there, MFC is there. Market price of Tesla say is 200 rupees, but market price of MFC is say 100 rupees. And Tesla is issuing me shares. Tell me students, I am a shareholder of MFC holding one share. What is the worth of one share? 100 rupees only. But Tesla company, they are giving me their shares. Their share is worth how much? 200. So if I am holding one share, will they give me full one share? No boss, they'll tell boss, your worth is 100 only now. I will give you equivalent shares worth 100 rupees. So they'll tell my one share is worth 200. You want 100 only now boss? I'll be giving you 100 divided by 200, which is going to be 0.5. 100, it is the target divided by, yes, 200, which is the acquirer. Is this clear, everyone? Yes, examples of positive factors: EPS, MPS, BVPS, book value per share, capital adequacy ratio, all these are positive factors. But there is going to be one negative factor as well, which is going to be gross NPA. Tell me students, NPA percentage, the higher it is, the better it is, or the lower it is, the better? The lower it is, the better it is going to be. So in case of NPA, how do we calculate? We will be reversing it. So we will tell it is going to be acquirer divided by target. Is this clear, everyone? Perfect. Next is, if in case we are having more than one factors, question tells, okay boss, you assign a weight of 40%, 30%, 30% to MPS, EPS and BVPS. In that case, what we will do? Step 1, I will calculate exchange ratio as per all of that. Yes, I will be writing factor, exchange ratio, I will write down the weights. Yes, I will do weight into exchange ratio. I will calculate the weighted average. That is going to be my exchange ratio. Is this clear, everyone? Perfect. So step number 1, we will be calculating our exchange ratio, my dear students. Is this clear, everyone? Yes. Technically, the answer is over here, but we are building a beautiful framework end to end so that there is no loops left, so that anyhow the question comes, we are in a position to tackle it. So with that, what we will also be doing is, say for example, my exchange ratio is 0.5. It means for one share of target, fresh 0.5 shares we are getting. Yes or no, everyone? So step 1, we will calculate exchange ratio. With that, step 2, we will calculate the number of shares to be issued to target company. Assume we are MFC, Majaa Flying Cars. We had 100 shares originally. Assume the exchange ratio is 0.5. So what I'll tell? 100 shares are there, boss. For every one share, I am getting 0.5 shares. That means fresh, how many shares will be issued to target? 100 into 0.5. That is number of shares held by target into the exchange ratio will be the number of shares issued to target. Then step number 3, we will tell the total number of shares in the merged entity, which is nothing but number of shares held by acquirer plus fresh number of shares issued to target. Assume acquirer Tesla is having 1000 shares. Okay, so 1000 shares anyways will be there with Tesla. Now during acquisition, how many shares did we issue to MFC? They had 100. For every share we issued 0.5, so we issued 50 shares. So in the merged entity, we will be having 1000 plus 50, 1050 shares. Yes or no, everyone? It is number of shares held by acquirer plus fresh number of shares issued to target. Is this clear, everyone? Perfect. So any given question, first step is we will calculate exchange ratio. In 3-step framework we will be doing. Step 1, calculate exchange ratio. Step 2, calculate number of shares to be issued to target. And step 3 is calculate the number of shares in the merged entity. Is this clear, everyone? Perfect. If basis for calculation of exchange ratio is not given in the question, we will be doing the calculation based on MPS. Throughout the chapter, if nothing is given, our main focus is going to be MPS. Is this clear, everyone? Okay. Next important thing, yes, Majaa adjustment. Calculation of exchange ratio if total consideration to target company is given. Say for example, question is telling we are MFC, Majaa Flying Cars. Yes, question told me that total consideration payable to Majaa Flying Cars is 50,000 rupees. Great, boss. Yes, we will issue shares of Tesla company which is having a market price of 100 rupees. Okay, great boss. This data is given. Using this data, can I calculate the number of shares to be issued to target? Tell me, I am giving, yes, Elon Musk is telling, boss, I am giving you my share. One share is worth how much? 100 rupees. Total, how much I should be paying? 50,000. So, can I calculate the number of shares? Yes, boss, 50,000 divided by 100. Yes, I guess it is coming to 500 shares. Yes or no, everyone? So, step 1, we will calculate the number of shares issued to target. It is total consideration divided by market price per share of acquirer. Once I know the number of shares issued to target, I can calculate number of shares in the merged entity also. Okay. Now, exchange ratio. How do I calculate exchange ratio? Assume. Originally, we are MFC. We had originally 100 shares. That is pre-merger, we had 100 shares. In exchange of that, now, fresh, how many shares we got? In this example, after merger, we got 500 shares. Yes or no? Assume it is 500. So, I will tell, yes, pre-merger, post-merger. Pre-merger I had 100 shares, post-merger I am having 500 shares. What is exchange ratio telling me? It is telling me if I had one share before merger, after merger how much did I get? So it is going to be 500 divided by 100, it is going to be 5. Yes or no, everyone? So I can tell, yes, number of shares, yes, issued to target, fresh shares issued to target divided by original number of shares in the target company. It is going to give me my exchange ratio. Is this clear, everyone? With this, the first point, exchange ratio, most important point, is done, my dear students. Yes, everyone. Now the next calculation is going to be the post-merger values, my dear students. Okay, post-merger EPS, post-merger MPS, preparation of balance sheet post-merger as well as post-merger book value per share will have to be calculating. Post-merger EPS, earning per share. If I can calculate the total earnings divided by number of shares, I will arrive at the EPS. Tell me, after merger, total how much earnings will be getting. I will first take the total earnings of acquirer before merger, Tesla. Yes, I will also take the total earnings of target before merger. This anyways will be earning. But sometimes when both the companies are coming together, there will be synergy in earnings. If question tells you synergy in earnings, I will add the synergy in earnings. So it is earnings of acquirer plus earnings of target plus synergy in earnings. That gives me the total earnings of the merged entity. Yes, divided by number of shares in the merged entity, I will arrive at the post-merger EPS. Yes or no? Yes, number of shares in the merged entity we have already calculated in, yes, phase 1. Yes or no, everyone? Perfect. Then comes calculation of post-merger MPS, market price per share. It depends on whether PE ratio is given or not. If PE ratio is available, question tells, okay, take acquirer's PE ratio or post-merger PE ratio is going to be this much. I know PE ratio is going to be MPS divided by EPS. Therefore, your MPS is going to be EPS into PE ratio. I would have calculated EPS of the merged entity into PE ratio of the merged entity. I will accordingly arrive at my MPS. Perfect, everyone. But if PE ratio is not available and cannot be calculated, then what I will do? Yes, I will assume that, yes, before merger, there was a market value of acquirer. There was market value of target. I will assume the market value of acquirer after merger also will be there, plus market value of target again after merger also will be there, plus when both of them are coming together, sometimes there could be some synergy in market value. Add synergy in market value, we will arrive at the total market value post merger divided by number of shares in the merged entity. You will arrive at the post-merger MPS. Yes or no, everyone? Market value of acquirer plus market value of target plus synergy in market value gives you the combined market value divided by number of shares in the merged entity. Yes, post-merger MPS. Is this clear, everyone? Next, if question asks you to prepare a balance sheet of the merged entity, it will only come in case of banking question. Yes, we have told you simple how to do. Assets and liabilities both are coming together. Do acquirer plus target. Perfect. Equity share capital. We have already calculated number of shares in the merged entity into face value per share. Perfect. Reserves and surplus. After merger, only acquirer is continuing. Only consider acquirer's reserves. Okay. Balancing figure, take it as capital reserve. Story over. Is this clear, everyone? Next is a calculation of post-merger BVPS, book value per share. In the regular class, I have told you detailed way of doing calculation of capital reserve. All those things I have told. But here it is going to be very simple. Before merger, acquirer was there, Tesla. We know the book value of acquirer. Total asset minus total liability or equity share capital plus reserves and surplus. I know the book value of acquirer. I know the book value of target. When both are coming together, the merged book value, it is book value of acquirer plus book value of target, yes, divided by number of shares in the merged entity, I will arrive at the book value per share. Is this clear? So with this, the second point, post-merger values is also over, my dear students. Yes, everyone. So the next calculation is impact of merger on the wealth of shareholders. What will happen to the wealth of shareholders because of merger? Okay, yes, calculation can be done based on EPS, based on MPS. Different calculation is there for acquirer, target, but boss, we've brought all of them into one single simple beautiful Majaa framework. Yes or no, everyone? How is it that we are going to calculate? Calculation of gain or loss to shareholders. We will write acquirer, we will write target. First thing we'll be writing is number of equivalent shares in the merged entity. Tell me students, acquirer is there, Tesla is there. Yes, Elon Musk was holding one share before merger. After merger, how many shares only he'll be holding? One share only, because he's the acquirer boss. His company will continue as it is. Yes or no? I am there. I am MFC, Majaa Flying Cars. Yes, I have got, say for example, 0.5 shares. My exchange ratio is 0.5. That means if I was holding one share before, after merger I am getting only 0.5. So I will write down my exchange ratio. Yes or no, everyone? Perfect. Now what I will be writing? How do I arrive at my gain or loss? It is a post-merger value minus the pre-merger value. Yes or no, everyone? But in case of post-merger, I will calculate the post-merger equivalent value. Is this clear, everyone? I will write down the post-merger value into number of equivalent shares. Is this clear, everyone? I will compare it with the pre-merger value. I will arrive at the gain or loss per share, because all these calculations is for one share, into number of shares. When I am multiplying by number of shares, I should multiply by the number of shares originally held. Yes, I will arrive at the total gain or loss, my dear students. Look at this quickly. I will show it to you guys using an example as well. Look at example number 5 from our workbook, my dear students. Yes, Tesla is a acquirer, MFC is a target. Originally 1000 shares were being held by Tesla. Originally 100 shares were held by, yes, MFC. Is this clear, everyone? Yes, we have calculated our exchange ratio. I guess exchange ratio is 0.5. Okay. Post merger EPS MPS we have calculated. Post merger EPS is 14.28. Post merger MPS is 285.71. Okay. Yes. Now we will arrive at the post merger gain or loss based on MPS. Let me try doing. Simple. I am telling Tesla is there. Tesla's shareholders. Yes, assume he was holding one share before merger. After merger, in the merged entity also they will be holding one share only. Yes, before merger, the market price of the share was 200 rupees. After merger, yes, what is the market price of the share? 285 point something. Yes, 285 point something is going to be the market price. Somewhere it is there here. Okay, some 285 point something is going to be the market price. So I will tell, look at this. Where is it? Okay. Yes, 285.71. So assume, yes, Elon Musk, he is a shareholder of Tesla. His market price of one share before was 200. After merger, it is going to be 285. So what is the gain or loss for one share? 85 point something into number of shares. Tesla was having 1000 shares. So the total gain is going to be 85,000, whatever it is. Is this clear? Now coming to MFC. I am a shareholder of MFC. Before merger, tell me how many shares I had? Yes, one share I had. If I had one share before merger, after merger, I will be getting how many shares? 0.5 shares only. Yes or no, everyone? Yes, pre-merger MPS of MFC was 100 rupees. Before merger, I had one share. I was selling crazy. 100 rupees is the market price. Tell me after merger, yes, market price of one share is how much? 285. But tell me, did I get full one share? No, I got only 0.5 share. So what is the equivalent value of my share? It is 285 into 0.5 comes to 142 rupees. So I will tell boss, before merger the value was 100. After merger the value is 142 point something. So the gain or loss is 42 point something. Into total how many shares are there? 100 shares were originally there. Yes or no? For one original share I got 0.5 shares. So for this 0.5 equivalent share, yes, this is the gain or loss 40 rupees. Like this, how many shares I was holding originally? 100 shares. So into 100 gives me the total gain or loss. Is this clear, everyone? Perfect. Yes, now this calculation of gain or loss we can be doing in terms of EPS also, MPS also. Point number 1. Point number 2, question asks, calculate the total gain or loss due to merger. I will calculate the gain to acquirer plus the gain to target. Is this clear, everyone? And different terminologies which can be used in the question. Question can ask you, calculate the impact or effect of merger on the wealth of shareholders. Question can ask you, gain or loss to shareholders. Question can ask you, benefit to shareholders. Question can ask you, are shareholders better off or worse off than before merger? Question can ask you, accretion or dilution due to merger. All these means one and the same. I am going to calculate gain or loss due to merger. Is this clear? If question asks you specifically, calculate as per EPS or MPS, accordingly I will do. If nothing is given, I will always be calculating in terms of MPS, my dear students. Is this clear, everyone? With this, the third point is also done, my dear students. Yes, everyone, now we have the final point, fourth point, Majaa point, crazy point, which is calculation of minimum and maximum exchange ratio. Before that, we told, in terms of any negotiation, the seller will always have on the back of the mind the minimum amount he should be getting. At least this much I should get, otherwise it is not worth it for me. Yes, the buyer will always have the maximum amount that he will be willing to pay. Maximum this much I can pay, beyond that I will not be paying. Yes or no, everyone? So always minimum value, it is for the seller. Minimum exchange ratio, it is for the selling company, target company. Maximum exchange ratio, it is for the buying company, acquirer company. Now, how to do the calculation? Simple framework we have built. So many complicated formulas are there, but boss, we have made it jujube for you guys. Simple. First, I will write down the framework. Acquirer is there, target is there. I will write down the number of equivalent shares. Acquirer, post merger also, he will be having one share only. Yes, the question is how many shares we should be issuing to target. Exchange ratio we want to calculate. We don't know to calculate. Yes or no? We don't know what is exchange ratio. Whatever we don't know in life. Tell me, students, what do we take it as? X. We will take it as X. So let us assume that my exchange ratio is equal to X. Is this clear, everyone? Then I will write down the pre-merger values. It could be pre-merger EPS or MPS. I will write down the values and keep it here. This is my simple framework. Now, 5-step framework it is going to be. Step number 1, let us assume exchange ratio is equal to X. Now, once you have assumed exchange ratio is equal to X, I can calculate number of shares issued to target as well as number of shares in the merged entity. Yes or no, everyone? Step number 2, calculate the number of shares in the merged entity in terms of X. Step number 3, yes, calculate the post-merger values in terms of X. You can be calculating, question can ask you post-merger EPS, post-merger MPS. You will accordingly calculate in terms of X. Step number 4, calculate the post-merger equivalent value. That is the post-merger value into number of equivalent shares. Yes or no, everyone? And finally, calculate the value of X in such a way that the post-merger equivalent value is equal to the pre-merger value. Is this clear, everyone? Perfect. So let us try understanding it quickly using a simple example only. Look at this, students. We are telling minimum and maximum exchange ratio based on MPS. Same example we are taking. Tesla is there. Originally 1000 shares are there. MFC, Majaa Flying Cars, is a target company. Originally 100 shares are there. Is this clear, everyone? Yes, I have to calculate minimum exchange ratio acceptable to MFC based on market price per share, MPS. I don't know the exchange ratio. I will assume it as X. Yes or no, everyone? So I will assume exchange ratio is equal to X. So first I will tell exchange ratio is equal to X. So number of shares to be issued to MFC. Originally they are having 100 shares. For every share I am giving X. So the number of shares issued is going to be 100X. Perfect. Third one is number of shares in the merged entity. Acquirer had 1000 shares. Fresh 100X I have issued. So it is going to be 1000 plus 100X. Perfect. Now I will calculate the post-merger values. Post-merger EPS. I will take total earnings of acquirer plus total earnings of target plus synergy in earnings if any. I will arrive at the total earnings of the merged entity. I will be getting it as 15,000. Divided by number of shares of the merged entity. I have taken it as 1000 plus 100X. So your post-merger EPS is 15,000 divided by 1000 plus 100X. Let it be as it is. Now, say for example, you want to calculate your post-merger MPS. Tell me, how do we calculate post-merger MPS if P ratio is given? It is going to be post-merger EPS into P ratio. Yes, post-merger EPS I have calculated. Yes, into P ratio is 20 times. So 15,000 into 20, it is going to be 3 lakh divided by 1000 plus 100X. I have got the post-merger MPS. Perfect, boss. Now I have calculated the post-merger MPS. I want the post-merger equivalent value. So I want the post-merger equivalent of MPS. It is post-merger MPS into the number of equivalent shares. So post-merger MPS is 3 lakh divided by 1000 plus 100X. Tell me, assume I am the target company. I am getting how many shares only? X shares only. So what is the equivalent value for me? It is going to be 3 lakh divided by 1000 plus 100x into x. So it is 3 lakh x divided by 1000 plus 100x. Yes or no, everyone? And tell me students. Imagine, yes, you are MFC. You are MFC. Before merger, you had a market price of 100. That means after merger, bare minimum, at least how much market price should be there? At least 100 you should be getting on an equivalent basis. Yes or no? So I will tell all this entire calculation. 3 lakh x divided by 1000 plus 100x should be equal to 100. Simplify, you will arrive at the value of x as 0.3448. Accordingly, you can calculate minimum, maximum. You can be calculating for acquirer, target. You can be doing the calculation based on EPS, MPS, all of that in a simple framework, my dear warriors. Is this clear, everyone? So the fourth point is also over. Additional notes: minimum exchange ratio always for the seller, target, maximum always for the buyer, that is acquirer. And one additional beautiful point we had told, my dear students: assume question is asking you to calculate minimum maximum exchange ratio based on EPS plus there is no synergy. Two conditions together: minimum maximum exchange ratio based on EPS plus there is no synergy. That means directly I can use my original formula of exchange ratio, target divided by acquirer. Using that only I can be getting my exchange ratio. Is this clear, everyone? Perfect. So with this we have successfully completed, yes, concept number 1, which is going to be share offer, my dear warriors. Now what we will do is quickly important tricky adjustments of the questions. Also, let us quickly finish it off, my dear warriors. Yes, everyone, now we are going ahead into a crazy area, which is a quick discussion of all adjustments of the question, my dear warriors. Are we ready for the crazy, Majaa? Yes. Perfect, everyone. Question number 1. Look at the second requirement. B Limited wants to be sure that its earnings per share is not diminished by merger. What exchange ratio is relevant to achieve the objective? They are telling my EPS should not diminish. That means my exchange ratio will be based on EPS. Story over, done, not done. Now we are going ahead to question number 6, my dear students. Yes, which is going to be swap ratio is based on multiple factors. Look at this, everyone. Acquirer is efficient, target is healthy. What all data is available? Our framework is first step 0. We'll calculate all basic data. Everything else will keep following, my dear students. Look at this, students. Number of shares is given. Face value is 10. So that means from this what all data I can get? Firstly, I know the number of shares. Yes, number of shares into face value. I will also arrive at the equity share capital. Perfect. Market capitalization, total market value is given. Using it, what more I can calculate? Market value is given, number of shares is given. So I can arrive at the market price per share. Great, boss. PE ratio is given. Market price is given, PE ratio is given. PE ratio is MPS divided by EPS. Using that I can calculate the EPS. EPS I have calculated, number of shares is there. I can also calculate the total earnings. Great, boss. Reserves and surplus is given. That means look at this, number of shares into face value gives me the equity share capital. Reserves and surplus, if you add, you will arrive at the book value of each of the companies. Great, boss. Promoters holding, number of shares is given. So can you calculate the percentage of holding by promoters? 4.75 lakh divided by 10 lakh accordingly. Yes or no, everyone? So tell me what all we calculated. Did I calculate market price per share? Yes, boss. Did I calculate EPS? Yes, boss. Book value I have calculated, divided by number of shares. Can I also calculate book value per share? Great, boss. Now look at this. They are going to give a weight of 40, 25, 35% for earnings, book value and MPS of a company. Accordingly, I can calculate, yes, the exchange ratio. Yes or no, everyone? Look at this, everyone. All these calculations we have done, step 0 basic calculations. Using that, calculation of swap ratio is the simplest thing. I will write down the factor. Yes, question has told me the weights. I will calculate exchange ratio. All these are positive factors. So it is target by acquirer. I have got the exchange ratio. Exchange ratio into weight gives me the weighted average exchange ratio of 2.5. Yes or no, everyone? Once this is calculated, everything becomes simple. Calculate swap ratio. Yes, also calculate promoters holding percentage after acquisition. Very simple, my dear students. Now look at this. Come back here. Exchange ratio is 2.5. Now look at this, my dear students. Yes, there is a target company. Total 10 lakh shares were there. Promoters were holding 4,75,000. Tell me, after merger also, these promoters will be holding 4,75,000 only, because it is acquirer company. Target company was there. Promoters were holding 5 lakh shares. Tell me what is the exchange ratio we got 2.5. That means for every 1 share they will be getting 2.5 shares. That means for 5 lakh shares they will be getting 5 lakh into 2.5. It is going to be 12.5 lakh. So total shares held by promoters. It is the shares held by promoters of acquirer plus fresh shares issued to promoters of target. That is shares held by promoters of target into the exchange ratio gives me total shares held by promoters in the merged entity divided by total number of shares in the merged entity comes to 17,25,000 divided by 28,75,000. That gives me the promoter holding percentage. Yes, based on that I can also calculate the non-promoter holding percentage. Yes or no, everyone? Look at this. This also comes as a miscellaneous point here. We have already written here. Yes, promoters holding percentage. Shares held by promoters of acquirer plus fresh shares issued to promoters of target gives me the number of shares held by promoters in the merged entity divided by total number of shares in the merged entity. We will arrive at the promoter holding percentage. Perfect, everyone? Okay, this we have done. Calculate EPS after merger. Simple, boss. What is the MPS and market capitalization after merger? Great, boss. Calculate the free float market capitalization. Tell me, students, we have done our calculation and we got to know that total 28,75,000 shares are there. In that 17,25,000 shares will be held by promoters. That means balance shares will be held by non-promoters. So number of shares held by non-promoters in the merged entity into market price per share we would have calculated of the merged entity. That gives you the free float market capitalization. Is this clear, everyone? Question 6 is done. If it comes in the examination, 8 to 10 marks. Yes or no, everyone? Now going ahead to question number 7, 10 marks question. Beautifully, let us try doing. Pay attention, everyone. Promoters holding percentage is given. Great, boss. So if I know total number of shares, I can see how many shares promoters have held, non-promoters have. Great. Share capital is given. Okay, boss. Great. Free reserves and surplus is also given. Great. So tell me share capital plus reserves and surplus. I can calculate the total book value. If I get number of shares, book value per share also I can calculate. Great. Paid up value per share. It is the face value of 1 share is given. Tell me equity share capital is 100 lakh. Yes, face value of 1 share is 100. That means can I calculate number of shares? 100 lakh divided by 100, 1 lakh shares. Yes or no? So accordingly face value I got. Yes or no? Sorry, number of shares I got. Yes, total book value was available. Book value per share also I got. Great. Number of shares if I get. Promoters, shares held by promoters, shares held by non-promoters also I can calculate. Great, boss. Free float market capitalization is given. It is the market value of shares held by non-promoters. Now look at this, students. Market value of shares held by non-promoters is 200 lakh. Tell me how much percentage of shares are held by promoters? 50%. That means how much percentage shares are held by non-promoters? 50%. I will tell, boss, total value of shares held by non-promoters is 200 lakh. It is 50% of the total market value. So divided by 50% gives you the total market capitalization of 400 lakh. Total market capitalization I got. I have calculated the number of shares. Divided by number of shares, I will arrive at the market price per share. Yes or no, everyone? Market price per share I got. PE ratio is available to me. That means I can also calculate my EPS. Once this is done, the question is going to be very simple. I will assign the weights, calculate swap ratio, do all the calculations. Question is done. Is this clear, everyone? Next we are going ahead to question number 9. Yes, here again it's going to be a simple question only. Now look at this. What has happened is one extra adjustment is there. While calculating swap ratio, EPS we know. Share price as per dividend growth model I should be doing, which is basically D1 divided by KE minus G. Yes or no? This is also a positive factor. So accordingly data will be given. Dividend would be given to me. Yes, as per the current balance sheet. This is as per the current year data. Yes, all these information is given. Dividend is given. That is the total dividend. Divided by number of shares, I will arrive at the dividend per share, D0. Growth rate will be given, yes, into 1 plus G, divided by cost of equity will be given, KE minus G. I will arrive at price as per dividend growth model. Positive factor, I will be doing T divided by A, target divided by acquired. Perfect. Now comes net worth per share. Tell me what is net worth? It is nothing but shareholders fund, nothing but book value. But they have given me a star and they have told after doing an adjustment. If you see the question, question is telling book values are given. But in case of land and building is not revalued. Its value is 3 years back. So what I will do? Firstly, I will take the book value as per the books plus I will show the adjustment for land and building. That is how much is the revised value minus how much was the original value, gives me the increase. Say for example, original value of land and building is 100. But after revaluation, 10% for 3 years had to revalue and assume the revised value is 133. That means 33 rupees has to be increased. Yes or no? Yes. Value of asset is increasing. Shareholders are happy or sad? Happy. So my book value is going to increase. Yes or no, everyone? That adjustment I will be doing. Using that, I will arrive at the adjusted net worth. Accordingly, I will be doing the calculation. Look at this, everyone. Yes, equity share capital plus reserves and surplus gives me the book value before any adjustment plus increase in the value of land and building. Yes, that gives me, yes, the book value after adjustment divided by number of shares, that gives me the net worth per share or book value per share. Using that, the story continues. Everything else is going to be the same only. Is this clear, everyone? Perfect. Now question number 9 is over. Now we are going ahead to question number 13, my dear students. Question number 13, we have one final adjustment which is new. Yes, all other calculation is same. They are telling you are a shareholder of Beta Limited holding 100 shares. I am target company. I was having 100 shares before merger. Are you interested to sell your stake or will you be interested to hold? Now what is happening? Simple numbers, random numbers I am giving. Assume the pre-merger market price is 100. Post-merger equivalent market price is 120. Post-merger equivalent market price. So right now the price is 100. So if you sell right now before merger, how much I will get? 100. But after merger, the market price, equivalent market price, MPS into equivalent shares is 120. That is, if you hold, you will be getting 120. So tell me, are you interested to sell? You will tell no, boss. If I hold, I will be getting a higher return. Yes or no? Same calculation is done here. Yes. Then comes 14th question. Yes, third requirement. What is the expected market price per share of Money Limited after acquisition, assuming PE ratio is adversely affected by 10%. Right now the PE ratio is 10. If it is adversely affected by 10%, so 10 minus 10%, PE ratio is going to be 9 times. Accordingly, I will be doing my calculation. Is this clear, everyone? Perfect. Question number 14 is also over. Now, question number 15. This line is new. Okay, there are two companies, C Limited, P Limited. Who is acquirer, who is target? We can't understand just by plain reading. This line will have to focus. The merger will be affected by stock swap, stock exchange of 3 shares of C Limited for every 1 share of P Limited. That means I am going to give 3 shares of C Limited. Who is giving shares? Acquirer is giving shares. That means C Limited is acquirer for every 1 share of P Limited. That means if P Limited was having 1 share, in exchange of that I am giving 3 shares. So it gives me two information. Firstly, exchange ratio is 3. Second, acquirer is C Limited because he is issuing shares. Yes, target is P Limited. Is this clear, everyone? Question number 15 is also over, my dear students. Then we are having question number 18, wherein question has asked value of original shareholder. So nonsense adjustment, absolutely no logic, but it has come once in the examination. So let us try understand. Simple, what we are going to do. We will calculate the market value of acquirer before merger, market value of target before merger. You add the two, you will arrive at the total market value before merger. Step number 1, total market value before merger. Then you will calculate the ratio of number of shares of acquirer and target post merger. Yes, calculate number of shares held by acquirer and target post merger. Then what we will do, this total market capitalization pre-merger, I will distribute in the ratio of number of shares held by acquirer and target post merger. Does not make any sense. This is pre, this is post, but still you want marks in the examination. This is what we will be doing, a 3-step framework. Distribute total market cap pre-merger in the ratio of number of shares held by acquirer and target post merger. Is this clear, everyone? So question number 18 is also over. Now we are going ahead to question number 21. In case of banks, beautiful question, my dear warriors. Look at this, everyone. Yes, there is a strong bank acquirer, there is a weak bank target. What all data is given? Yes, gross NPA percentage is given, capital adequacy ratio is given. Yes, market price per share, book value per share is given. Okay, now all other information is given for us. Okay, great. Preliminary expenses is given when I am calculating equity's value, equity share capital plus reserves and surplus minus my preliminary expenses. Is this clear, everyone? Calculate swap ratio based on the weights. Question has given me the weight. Based on that, I should be calculating swap ratio. Firstly, NPA, is it a positive parameter? Negative. Negative parameter. So, acquirer divided by target. Yes, capital adequacy ratio, market price, book value. All of these are positive parameter, means target divided by acquirer. Perfect. Additional calculation I can be doing. Tell me NPA, non-performing asset. On the advance that I am giving, say for example 100 rupee loan I have given, in that 5 rupee I am not getting back. That means my NPA is going to be 5%. Yes or no, everyone? NPA percentage, it is NPA in terms of rupees divided by advances. Yes or no, everyone? NPA percentage is given. Advances below, it is available. Advances given. That means can I be calculating the NPA in terms of rupees? Yes or no, everyone? Perfect. So let us quickly try calculating that. Yes, everyone. So NPA in terms of rupees I will be calculating, because NPA percentage is given, advances is also given. Using that NPA in rupees I will calculate. Now, yes, capital adequacy ratio. Question itself is telling you that it is a capital divided by risk weighted assets. It is telling how adequate is our capital, our own capital, which is basically equity divided by risk weighted assets. Equity value we would have calculated, equity share capital plus reserves and surplus minus preliminary expenses. Capital adequacy ratio is given. Yes, equity value I know, so I can be calculating my risk weighted assets. These two are going to be new adjustments in the question. Is this clear, everyone? Using that I will calculate my exchange ratio, number of shares issued to target, number of shares in the merged entity, and whatever question asks us to do, I will be calculating. Question is asking a swap ratio, number of shares issued, balance sheet after merger, we have already told, yes or no. Assets and liabilities, I will add acquirer target. Yes, equity share capital, I will see number of shares in the merged entity into face value per share. Reserves, I will only consider of the acquirer. Remember one point, I have preliminary expenses, it will not come after merger. It is adjusted in equity. Balancing figure, take it as capital reserve. Is this clear, everyone? And then they are asking, calculate capital adequacy ratio and gross NPA after the merger. For that, yes, it is going to be a very simple calculation. Look at this, students. Capital adequacy and NPA after merger. Capital adequacy ratio, formula I know, it is equity divided by risk weighted assets. Equity value I know of acquirer as well as target. Yes, risk weighted assets also I have calculated for acquirer and target. That means if you add the two, you will get for the merged entity. Add the two, you will get for the merged entity. I can calculate capital adequacy ratio for the merged entity. Is this clear, everyone? Gross NPA ratio, it is NPA divided by advance. Yes, I know for acquirer and target. Add the two, you will arrive at it for the merged entity. Accordingly, calculate the NPA percentage. Is this clear, everyone? Question number 21 is also over, my dear students. Then comes question number 22. Yes, simple but beautiful question. Pay attention, everyone. Everything is very simple. Share capital is given, reserves and surplus is given. That means I can arrive at the total book value. Paid up value per share is given. Tell me share capital, total equity share capital divided by face value per share. I can also calculate number of shares. So accordingly, book value per share I will get. Great, boss. Free float market capitalization is given. Here promoter holding percentage is given. So that means I can calculate non-promoter holding percentage. Yes, free float market capitalization divided by, this is how much percent, non-promoter holding percentage. I will arrive at total market capitalization, already done in question 7, I guess. Yes or no? Total market capitalization I got, divided by number of shares, I will arrive at MPS. Yes, I know PE ratio, I can calculate EPS. Simple, Jujibi, Halwa, yes or no, everyone? This I will do. Simple, next one I will do. Everything I will do. Promoters, revise, all these things I will do. In the end, this point is new here. Also calculate the number of shares, EPS and book value if after acquisition of Abhishek Limited, Abhiman Limited decided to issue bonus shares in the ratio 1:2 and split the share as 5 rupees fully paid up. Now look at this. For that, how we have done the calculation. Pay attention, everyone. Yes, simple. I have calculated number of shares in the merged entity. I am having 3,50,000 shares having a face value of 100, 350 lakh. One by one, let us do the calculation. First, they told I have issued bonus shares in the ratio 1:2. Tell me currently how many shares I am having? 3,50,000. Fresh 1:2 I have issued bonus shares. So 3,50,000 into 1/2, 1,75,000. So number of shares is going to be 5,25,000 into face value. I will arrive at the total value. Great. Okay. Now after this happened, one more adjustment I did. I decided to split my stock into 5 rupee face value. Tell me, original face value was 100. Now face value is 5 only. That means for one share, how much shares I will be getting? 20 shares I will be getting. That means for 5 lakh 25 shares, 5 lakh 25,000 into 20 will be 105 lakh. Face value of 5, accordingly it is going to be 525 lakh. All the calculations will go further. Is this clear, everyone? Question number 21 is also over, my dear warriors. Is this clear? Yes, everyone, we are having question number 25 as well. Simple question. So much data is given. What all they are asking us? They are telling, boss, decompose the share price into EPS and PE ratio. Okay, fine. Also segregate EPS into return on equity and book value per share. Great, boss. Let us try seeing what all is given. If you see the income statement, calculation till PAT is given. PAT minus preference dividend gives me Patesh. Preference dividend is not there. That only will be Patesh. Minus the dividend paid, I will arrive at the retained earnings. Dividend paid is given in terms of percentage. I will arrive at the retained earnings. Yes or no, everyone? So I will do that calculation. Yes, PAT minus preference dividend gives me Patesh. Yes, minus dividend gives me my retained earnings. Is this clear, everyone? EPS, I know how to calculate EPS. It is the profit to equity shareholders divided by number of equity shares. Yes, which is Patesh divided by number of shares. I will arrive at the EPS. Tell me, EPS I have calculated, market price I know. So can I calculate the PE ratio? Yes, boss. MPS divided by EPS. Yes or no, everyone? Accordingly, I will calculate the PE ratio. Great, boss. Now then comes calculation of book value per share. Equity share capital is given, reserves and surplus is given, gives me the total book value divided by number of shares. I will arrive at the book value per share. Great. Now, one calculation was over. Decompose the price into EPS and PE ratio. One more calculation is there. They are telling, boss, EPS now you bifurcate it as book value per share and the return on equity. Did we calculate book value per share? Yes, boss. Now I'll have to calculate return on equity. How much return I am generating for the equity holders? How much profit I am generating for equity holders? What is it called? It is the Patesh. What is the total value of investment by equity? It is the equity value. Yes or no? Or the book value. Perfect. So I can write it as Patesh divided by equity. That gives me the return on equity. Yes or no, everyone? Perfect. Now using that, if I'll have to calculate sustainable growth rate, security valuation, yes, it is retention ratio into return on equity. Dividend payout ratio is given. 1 minus dividend payout ratio is going to be the retention ratio. Sustainable growth rate, it is nothing but, yes, retention ratio into return on equity. I will arrive at the sustainable growth rate. All subsequent calculations are very simple, GGB. With this concept 1 we have completed. All adjustments of questions also we have done. Done, my dear students. I hope you guys have thoroughly enjoyed this. Yes, everyone. Now we are proceeding further to concept number 2, which is going to be cash offer. Now all changes, we know how exactly calculations are happening for share offer. More or less same principle, just slight tweakings are needed. So we will be discussing in the form of 7 golden principles. We remember the 7 golden principles. All calculations will be in a position to easily do it. First principle is total cash payable to shareholders of target. Assume there are 100 shares. And I promise that for every share I will pay you 130. So what is the total cash payable? 130 per share into 100 shares. It is cash per share into number of shares of target company. Is this clear, everyone? Next comes number of shares post merger. Tell me, Tesla is the acquirer, MFC Majaa Flying Cars is the target. Tell me whether Tesla is issuing any shares. No, boss, it is paying cash. That means after merger, will there be increase in shares? No, boss. That means number of shares in the merged entity, it is nothing but number of shares of acquirer. Perfect, everyone. Third principle is post-merger EPS, earning per share. Very simple principle is, yes, I am paying cash to acquire the target. Yes, so I am paying cash. If I am not having money means I would have borrowed that money. So I should adjust the post-tax interest cost. Sir, but I am having money. This you could have invested somewhere. Because you have paid, you are not in a position to get that earnings. So in any case, I will be adjusting the post-tax interest cost. Simple. I will take earnings of acquirer. I will take earnings of target. I will consider the synergy in earnings, if any. Till here we were doing previously also. But with that, we should be doing one more adjustment. Minus the post-tax interest cost. Yes or no? Which is going to be total cash paid into the interest rate into 1 minus tax. That gives me the total earnings of the merged entity. divided by number of shares of the merged entity, I will arrive at the post-merger EPS, my dear warriors. Is this clear, everyone? Perfect. Then comes fourth point, which is post-merger MPS, market price per share. If P ratio is given, means simple, it is EPS into P ratio, but majorly in case of cash offer, we'll be going for the second route, which is P ratio is not available. Now, two adjustments I should be doing, my dear students. Now, I have paid cash to acquire target, that means acquirer's cash has reduced, net asset has reduced, that means market value will also reduce, that is one adjustment. Second adjustment is, yes, I am getting a benefit, that is currently for the target company, we were paying higher salary to management. Post acquisition will be paying a lower salary. So question will give me present value of savings. That is a benefit for me. We are happy our market value is going to increase because of that. So see how we are going to do the calculation. I will consider market value of acquirer plus market value of target plus synergy in market value, if any. 3 are over, 2 adjustments. Cash I am paying, it will reduce assets, we are sad, minus the cash paid. Yes, for target company in future we are paying less salary. Yes, because of that we are getting a benefit. I have present value of savings, we are happy, add the present value of savings. I will arrive at the total market value of the merged entity divided by number of shares in the merged entity. I will arrive at the post merger MPS. Perfect, everyone? Yes, 4 principles are over. 5th principle is impact of merger on the shareholder. Simple, for acquirer as well as target, I will see post merger value minus the pre merger value. I will arrive at gain or loss per share into number of shares. I will arrive at the total gain or loss. But boss, wait, for acquirer I can be doing it that way. In case of target, post merger they are not getting anything, we are just paying them cash. Suppose we are MFC, Tesla told for every 1 share I will pay you 130. Is this clear? So after merger, am I getting any share? No. Am I having any post merger value? But I got cash. Assume my pre merger MPS was 100. I got 130. What I will tell? Yes, cash I got is 130 minus the pre merger MPS was 100. That means 30 rupees is a gain per share into number of shares gives me the total gain. So cash paid per share minus the pre merger value gives me the gain or loss per share into number of share gives me the total gain or loss. Perfect, everyone. Next comes maximum cash payable per share. Acquirer wants to acquire, Tesla wants to purchase my company. They will decide maximum how much they can pay. Maximum they will pay to an extent that their pre-merger EPS or MPS is not diminished. Yes or no, everyone? How to do? Same philosophy. Let us assume cash per share is X. So that means what is the total cash payable? Number of shares into X. Yes or no, everyone? Perfect. Then we will calculate the post-merger value in terms of X. Post-merger EPS or post-merger MPS. Perfect. Then we will calculate the post-merger equivalent value. Post-merger value into the number of equivalent shares. Now tell me, suppose randomly acquirer Tesla, they had a pre-merger MPS of 100. What they'll tell? After merger also, at least 100 they should be having. So calculate the value of X in such a way that the post-merger equivalent value is equal to the pre-merger value. Is this clear, everyone? Yes, that is the 6th principle. 7th and the final principle, it is the minimum cash per share for the target company. We are MFC, we are the target company. Right now I am having a share which is having a market price of 100 rupees. Tell me, suppose Tesla is planning to purchase. Bare minimum for 1 share, how much I want? Minimum I want the market price per share. Yes or no, everyone? So for normal shareholders, it is going to be the pre-merger MPS. But boss, in case of promoters, we have seen a question wherein what is happening is their future salary will be reduced. So that also they are losing. What promoters are telling? Boss, if I agree for cash offer, right now I am having the market price, that I will not be getting. In future, I will be getting lower salary. That means there is a loss there. So present value of that loss also I want. So how I will be doing? A simple framework. Per share total I will write. I will write down the pre-merger MPS as well as this I am sacrificing as well as the present value of loss of remuneration. Yes, I will add, I will arrive at the minimum cash per share. Is this clear, everyone? We are having questions, but there is no great adjustments in the questions. So you guys can try it by yourselves, my dear students. Then we have concept number 3, which is going to be the miscellaneous areas. In that first point we have already discussed, which is promoters holding in merged entity. Second point is going to be true cost of merger. Say we are MFC, that is the target company, Majaa Flying Cars. The market price of the share is 100 rupees. Tesla acquirer told, boss, I will pay you 100 per share. I want to acquire your company. I told, not interested. Why? 100 I can sell in the open market. So in order to convince me for the merger, he paid me 130 per share. That means tell me what is the true cost, net cost to purchase my company. 100 rupee anyways is the value of the company. 30 is what he has paid extra. Yes or no everyone? True cost of merger, it is the extra amount over the target's market value which we are paying to acquire the company. How do we calculate it? Simple students, it is total consideration paid to target minus the pre-merger market value. That is the extra amount we paid. That only is the true cost of merger or net cost of acquisition. Is this clear everyone? In case of cash offer means we will say total cash paid minus pre-merger market value. Yes, in case of share offer, I will tell the total value of target post-merger, that is the total equivalent value of their shares post-merger minus the pre-merger market value. Yes or no everyone? Now one more additional point I had told. From acquirer's perspective, if you see, it is how much extra I am paying. But if you see from target's perspective, it is how much extra I am getting. Yes, we had done the calculation of gain or loss for the target in terms of MPS. Whatever is a gain, that itself is going to be the true cost of merger. Is this clear everyone? And then we have the final point which is going to be the financial feasibility of acquisition, which is NPV of acquisition. Now today in order to acquire a target company, I'll have to be incurring a cost. Yes or no everyone? But if I purchase the target company, in future I will keep getting benefits. So I want to see what is the net present value, what is the net benefit of purchasing the target company. Is this clear? It is going to be present value of cash inflows minus my initial cash outflow. Now how do I calculate my initial cash outflow, my dear students? Today to purchase target company, what all I should pay? Firstly, yes, enterprise value, yes, business valuation. It is value of equity plus value of debt minus surplus cash and cash equivalents. So firstly, I'll have to pay for equity holders value of equity, that is value of shares issued, plus value of debt. Yes, there will be some debt which I will be issuing, some liabilities which I will be settling. Okay, boss. Minus surplus cash and cash equivalents. Here, question will give you cash. Question will also tell that I can sell my debtors and inventory and realize this amount. That also I will be considering. That will give me the initial net cash outflow. Then I will calculate present value of cash inflows minus initial investment or initial cash outflow. I will arrive at NPV. If NPV is positive, it means that the acquisition is beneficial for us. Is this clear everyone? So we can have a look at that question also quickly. Yes, it's a very simple question. I guess it is going to be question number 34 if I am not wrong. Question number 34, where is it? Okay, question number 34. Look at this everyone. Yes, Tiger Limited wants to acquire Leopard Limited. I am telling if I acquire what all I will have to be paying. Firstly, shareholders will get 1 share in Tiger for every 2 shares. Yes, the current price is 15. So tell me how many shares are there for Leopard Limited? 70,000. Yes, I'll be issuing 0.5, 1 for every 2.5. So we will issue 35,000 shares. Yes, market price is 15. So 35,000 into 15 is the value of equity. Perfect. With that, what we will be doing? Yes, debenture holders will be getting 13% new debentures. So again, 3 lakh is going to be value of debt. And yes, we are also having, where is it given? External liabilities will be settled at 5 lakh. So that also is going to be value of debt. Great boss. Minus surplus cash and cash equivalent. Cash is 50,000. I am having debtors and inventories. Question is telling debtors and inventory will realize 2 lakh. So I will reduce it 2 lakh. Is this clear everyone? So accordingly, I will be doing that calculation. Yes everyone, so look at this. This is what we'll be doing. Yes, firstly, I will be issuing shares of 5,25,000. I will settle liabilities of 5 lakh. I will issue debentures of 3 lakh. All these I am paying, but boss, I am getting also. Yes, hot cash is there in the company that I am receiving 50,000. Debtors and inventory I can sell and I can realize 2 lakh. That gives me my initial net cash outflow. Then question is telling me that boss, every year I will be getting cash inflow of 5 lakh. And at the end of 6th year, I can sell and get 2 lakh rupees. Calculate NPV. Yes, NPV is positive. So we'll tell boss, yes, acquiring, yes, Leopard Limited is beneficial for the company. Is this clear everyone? So with this, we have successfully completed unit 1 of the revision. We have taken almost 59 minutes, my dear students, but trust me, everything end to end we have done. And we'll be having a unit 2 revision, but trust me, that is going to be maximum for 10 minutes. So every time you feel like you're forgetting the chapter, you want to revise, you know where exactly to come for. And if you have loved this means, once it is on YouTube, it is on different platforms. Chumma, you take benefit, no use. Please do share it to all your friends. A lot of efforts has gone in the background. So see you guys for the revision of next unit. Take care. Bye. Yes everyone, so it is time for us to revise unit 2 of the chapter mergers, unit 2, which is going to be other forms of corporate restructuring. We are only having two forms, one is a demerger, one more is financial restructuring. Some more were there that we have already covered in security valuation. Demerger, what is happening? Imagine we are a company called MFC, Majaa Flying Cars. Before demerger, there were two different divisions. One was the flying car division, one is the flying bus division. We thought we are not in a position to focus on both the companies, boss. So we will split them into two separate companies. Flying car division will continue as it is. For the flying bus division, we will create a new company called MFB, Majaa Flying Bus Limited. So after demerger, flying bus division is transferred to a new company. So understand what is going to happen. We are going to create a new company, Majaa Flying Bus. Yes or no, which includes the flying bus division. That means tell me Majaa Flying Cars. Flying bus will no longer be there. We will only be having the flying car division. Is this clear everyone? Okay. So MFC will only be having the flying car division. Okay. Now MFC Limited is called the demerged company. Yes or no everyone? From here one unit has gone. It is the demerged company. MFB, it is a new company. It is called the resulting company. Is this clear everyone? And we will be transferring all assets from the demerged company to the resulting company. Of that division, whatever assets and liabilities are there, will be transferring to the resulting company. Yes, assets and liabilities of resulting company will be transferred to the resulting company. Point number one. Yes, a demerged company, that is MFC, will only have assets and liabilities of the unsold division, that is a flying car division. Perfect. And final point is resulting company, that is MFB Limited. They will be issuing shares directly to the shareholders of the company. They will not be giving it here. Directly to the shareholder they will be getting. Is this clear everyone? Suppose I was a shareholder holding one share of MFC Limited. Yes, after demerger what will happen? Yes, I will be having one share of MFC anyways and I will be getting some shares of my MFB Limited as well. Is this clear everyone? Okay. Now what calculation will have to be doing? Let us directly have a look at the workbook. We are having a very simple example. Yes, this is the balance sheet immediately before demerger. Yes, assets are given, liabilities, all those things are given. Yes, MFC Limited, it is having both flying car as well as flying bus. Immediately after demerger, that is on 1st of April, on 31st of March, yes, demerger is happening. So on 1st of April, MFB Limited, which is the flying bus division, values are given. So that means tell me balance, look at this fixed assets. Total before demerger 40,000 was there. After demerger 10,000 is transferred to flying bus. That means 30,000 is still there with the flying car division. Yes or no everyone? So I will do it this way. Before demerger both the units are there. After demerger for the resulting company value is given. Balance is going to be the value for the demerged company. Accordingly, I can calculate the total book value divided by number of shares. I will also arrive at the book value per share. Is this clear everyone? Now using that we are having a question. Yes, if I am not wrong, question number 35. Now all these data was given. Yes, using that we have told what all going to happen. Okay, I can calculate the book value per share. Perfect. But how many shares are issued by the resulting company was not given to me in the question. But sir, some hint was given. What was given? Profit after tax immediately for the next year is given. Perfect. PE ratio was given. Dividend payout was given. And total market capitalization was given. Something of that sort was available to us. Look at this everyone. Yes, for the next year immediately after demerger, profit was given. Market price per share was given. PE ratio is given. Tell me students, market price is given, PE ratio is given. Can I calculate EPS? Yes boss, EPS I can be calculating. Profit after tax is given. There is no preference dividend. I will arrive at the total Patesh. Total profit I know. I know the profit for one share. That means can I calculate the number of shares? Accordingly number of shares will be calculating. Yes, I guess I am getting my number of shares as 1500. Originally 3000 shares are there. In exchange of that 1500 new shares we got. That means I got 0.5 share for every one share held. Is this clear? That was a tricky adjustment in this particular question, my dear students. Concept 1 is done. Is this clear? Next one is financial restructuring or internal reconstruction. Here what is happening? There is a weak or non-performing company. It will go and cry in front of every stakeholder. Shareholders, debenture holders, creditors, please do something. Yes, only then we will be in a position to continue. Question will ask you what is the benefit out of financial restructuring. That is a net benefit I will do, also which is transferred to capital reserve. Question will also ask you to prepare a balance sheet post financial restructuring. Yes or no, everyone? Directly let us try doing through the workbook. Look at this, everyone. Yes, where is it? Okay, fine. Look at the students. Example. Yes, assume this is the balance sheet of MFC Limited. Equity share capital, preference share capital, debentures is given. Debenture interest is accrued and still we have not paid. Oh my god, boss. Creditors is given. Non-current current asset is given. P&L debit balance and preliminary expenses. Boss, bad company it is. Yes or no, everyone? Yes, we have come up into an arrangement for financial restructuring. What is it we are telling? Equity shareholders will sacrifice 50% amount. Now, whatever is a benefit, we'll prepare a benefit cost statement. Whatever is a benefit, we'll write down the benefit. Yes, whatever is the application of benefit or cost, we'll write it down. Net benefit we'll be calculating. Net benefit will be transferred to capital reserve. How do we see? We'll see the balance sheet. If there is a vacuum getting created in the balance sheet, that means there is a benefit or application. Yes or no? What is a benefit? Asset value is increasing, means I'm happy, benefit. Or my liability or equity is decreasing, means I'm happy. Yes or no, everyone? Now tell me, equity shareholders are sacrificing 50%. Now it is 1000, after it will be 500 only. That means there is a difference of 500 in the balance sheet. Yes or no? Yes, equity is decreasing. Payable to equity shareholders is decreasing. I am happy. Yes or no, everyone? So I will be showing it here, benefit reduction in equity share capital. Similarly, there is reduction in preference share capital also, that is also my benefit. Third, debt holders forego their outstanding interest. So whatever this outstanding interest is there, they will tell boss not needed. Again, it is going to be a benefit for me. And question is telling, we will also reduce the interest rate to 8%. Tell me, yes, instead of 10%, they are telling will you pay 8%. Today, is there any benefit out of that? No. That means will it make an impact? It will not be making an impact. Change in interest rate or preference dividend rate will not be making an impact on the calculation of capital reserve. Okay, boss. Next point that we had is creditors agree to convert 50% of their dues into equity share capital. Tell me right now, creditors, how much they are having? 900. They are telling boss, 450 you pay in future. Balance 450, na? Let us convert it into equity shares. Is this clear, everyone? Now tell me. Is it a benefit or just a transfer from one heading to other heading? Yes, it is just a transfer. They are telling boss, you will have to still be paying, but it is not a fixed liability. We will treat it as a part of equity. So is it a benefit for me? It is not a benefit for me. So transfer from creditors to equity share capital, it is not going to be a benefit for me. It will not be coming in my statement showing capital reserve. Is this clear, everyone? Great. Yes. Next, upward revaluation of non-current assets. Yes, we are happy. Yes, will come as a benefit. Yes, we are creating a provision for bad debts. We are sad. We'll show it as application of benefits. Then we are having P&L debit balance as well as preliminary expenses. We'll have to write it off. We'll show it as application. Accordingly, we'll show the net benefit from internal reconstruction. We'll calculate, yes, the capital reserve and accordingly prepare the balance sheet. Simple trick, do both the calculations together. Is this clear, everyone? And accordingly do the solution, my dear students. Look at this, I've shown you guys, yes, net benefit. What all benefits will be there? Either your equity or liability is reducing. Yes, reduction in equity. Yes, equity or preference. Yes, waiver of liability. Or your asset is increasing. These are going to be the benefits. Then we have application of benefits. Where all will apply? Firstly, we will write off fictitious asset. Example, preliminary expenses. We will write off debit balance of P&L. Great, boss. Yes, we might have to create some provisions. Again, we are sad. Yes or no? And there could be decrease in the value of assets. That gives me the net benefit which will be transferred to capital reserve. Perfect. Additional pointers we've discussed is change in interest rate for the future period. It will not impact. And if creditors convert their claim into equity, just heading is changing. So it will not be coming in the benefit statement. Is this clear, everyone? With this, unit number 2 is done. A very small unit, but still if a question comes in the examination, boss, we should be in a position to score this. With this, the chapter mergers and acquisition is over, my dear warriors. See you guys for the next revision video. Take care. Bye.
Yes, everyone, now let's have a quick rocket revision of the chapter portfolio management. Point number 1, this chapter is relevant for CA final as well as for CMA final students. Point number 2, this is a rocket revision. The entire subject, students feel, is very difficult. Trust me, it is the simplest chapter. The entire subject without having the need to touch a single formula we have understood in the regular batch. But boss, this is a rocket revision. Here, yes, when we are putting it on YouTube, intention is not to teach, it is to quickly revise because you guys are having examination in next 1 or 2 days. So 3, 2, 1. Let the Majaa begin. Yes, everyone. Now understand what is portfolio management telling. It is telling don't invest in a single security. Invest in a portfolio of securities, group of securities. Why? Because when you're investing in a group of securities, because of diversification, your risk will reduce. Okay. The extent of risk reduction, it depends on the correlation between the securities, how they are moving. Ideally, if you are having negative correlation, means we will be having maximum risk reduction. Okay, fine. Now let us start with unit number 1, which is modern portfolio theory by Harry Markowitz. Okay. Firstly, we have to understand how do we calculate average. We have simple average as well as weighted average. Simple, boss. Yes, past data is given. Suppose the returns of a security for the last 3 years are as follows: 10%, 12%, 14%. What is the average return? Tell me, how do I calculate the average return? These are the individual return X. Yes, I will do the total of the return, summation of X, sigma X. That is the total. I want the average divided by number of years. Divided by N gives me the average return. Yes or no, everyone? Okay, fine. So in case of past data, yes, question is telling what is the expected return, how much return we are expecting in the future. In the past, whatever we got, average of that is what we are expecting in the future. Is this clear, everyone? So know that, yes, the entire chapter, the only thing we are doing is average. Was 6 standard we have learned. Now in case of past data, simple average, how do we do the average? We take the data, yes, do a summation of the data, we do a divided by N. Yes or no, everyone? So if I have to calculate the expected returns, okay, individual returns are given for me X. I will do a summation of that, gives me the total return. I want average divided by N. Is this clear, everyone? Okay, look at this data. Yes, last 5 years, yes, returns is given 10%, 20 minus 5, 30 as well as 5. I will do a summation of that. Total return is going to be 60%. I want average divided by 5, gives me 12%. Is this clear, everyone? Okay. Now in case of future data, or where weights are given, probabilities are given, tell me, yes, question is telling that my return could be 10% also, 12% also, 14% also. Yes, can I directly do a summation divided by N? No, boss. Wait, probabilities are given. There is a 20% chance that my return can be 10%. There is a 50% chance that my return can be 12%. There is a 30% chance that my return can be, yes, 14%. Now how do I calculate the return? I will be doing a weighted average. I'll tell my return can be 10 also, the probability is 20%. Return can be 12 also, probability is 50%. Return can be 14 also, probability is 30%. Is this clear, everyone? Here what we will be doing, always remember, whenever future data is there, yes, I will take the individual return X, multiply with the probabilities. Yes or no, everyone? And then do a summation. It gives me the weighted average of the return. Is this clear, everyone? Okay. Remember that in case of future data, I will always multiply it with the probabilities. Is this clear, everyone? Yes or no? Yes, this is the returns. Now know that in the entire chapter of portfolio management, always the return calculation we will be doing in the form of percentage. Return will always be in the form of percentage. Is this clear, everyone? So my expected return will also be in the form of percentage. Is this clear, everyone? Okay, point number 1 is over. Okay, boss. Now coming to point number 2, is there a risk? Yes, boss, there is a risk. Risk is always measured in the form of variance. Yes, one simple pointer we have told, risk means variance. Okay, what is a risk? Tell me, students, in this example, yes, we are expecting that, okay, yes, on an average 12% return should be there. But in reality, is it necessary 12% only is there? No, boss, it is not necessary. Yes, it could be 10 also, 20 also. So I will calculate the deviation x minus x bar. Yes or no, everyone? Now, yes, I will consider x minus x bar. These are deviation. Some deviation will be on the left hand side, some deviation will be on the right hand side. Yes. Now I want the average risk. Yes or no, everyone? Okay. If you do a summation divided by n, if you do, yes, you will be getting it as 0 because you have taken deviation from the center figure. So what Harry Markowitz told? Harry Markowitz told us, yes, remember this principle always. Yes, we will always do a square of the deviation, because if I directly take the deviation, because yes, some figures are on the left, some figures on the right, if you do the average of that, it becomes 0. Okay, Harry Markowitz told, simple principle for us, we will always square our deviation. So I did x minus x bar the whole square. So look at this, 12 I'm expecting, I got 10 only, so I got 2% less, but Harry Markowitz told always do square of the deviation. 2 square is 4% square. Is this clear? Similarly, I do for each of the things. Now tell me, risk is variance. I have calculated the individual variance. What all my risk can be? My risk can either be 4% square, or it can be 64% square, or it can be 289, or it can be 324, or it can be 49. So which one should I take? Boss, take the average of this. Yes or no, everyone? Okay. So simple. Yes, I know my average return. From that, I will calculate the deviation x minus x bar. From here, if I calculate the average, because positive and negative becomes 0, what I did, I do a square of that. Yes or no, everyone? This gives me the individual variances. The way I had individual returns, I wanted one average return. Now I have individual variances, I want one, yes, average variance. I will do a summation of that. Yes, divided by n gives me the variance of a security. Is this clear, everyone? Okay, in the shortest possible time I'm trying to tell. So what we will do, yes, I will first calculate the deviation, which is x minus x bar. Based on this, I cannot do. So what I will do, Harry Markowitz told, always boss, square your deviation, x minus x bar, the whole square. This is the individual variances. Every individual variance is there. Now I want one single figure, yes or no, everyone? So I will do the average. So I will do a summation divided by n. Is this clear, everyone? Okay. Now remember one simple point. My return is in the form of percentage, yes or no, everyone? So this x minus x bar is in the form of percentage. Simple, look at this, everyone. Yes, return is 10%. I'm expecting 12%. So it is 2% less. When I'm doing a square, yes, minus 2 into minus 2 becomes 4. Percentage into percentage becomes a percentage square. So when I'm doing the average of this, it will also be in percentage square terms. Remember, variance will always be in percentage square terms, my dear students. Is this clear, everyone? Okay, this is in case of past data. In case of future data, what I should do, same story. Now I will take the deviation x minus x bar. But Harry Markowitz told, boss, don't take the deviation, do a square of the deviation x minus x bar, the whole square. I got the individual variance, but boss, I want a single figure. Now here, in case of future data or where probabilities are given, I have to do a weighted average, multiply by the weights, yes, and do a summation. I will arrive at the variance. Is this clear, everyone? Simple. Yes, in case of past data, always you do divided by n. In case of future data, always you multiply by p. Is this clear, everyone? Okay. Till here the discussion is clear, yes or no, everyone? Okay. Now comes the concept of covariance. Covariance, which is joint deviation. When there are two securities, x and y, I want to know, yes, how x is moving from its average and how y is moving from its average. Simple. Yes. Tell me how x is moving from its average, x minus x bar, and into how y is moving from its average, y minus y bar. This gives me the covariance, individual covariance. Yes, I will show you guys one data wherein we can try seeing the covariance. Pay attention, students. Yes, where do we come for that? Which question can we see? I guess we're having a comprehensive example number 10. There we can see in just a second. Okay, look at this, everyone. Example number 10. Yes, return for x as well as y is given for 5 years. Look at this, everyone. So x's return I know. Based on that, I will do a summation. I will calculate the average return. I will do x minus x bar, the whole square. Based on that, I will calculate variance of x. Okay. Yes, y I know. Yes, y minus y bar, the whole square. Now, yes, tell me, I want to calculate how x is moving from its average, x minus x bar, and into how y is moving from its average, y minus y bar. Is this clear, everyone? Yes, this gives me the covariance, also called as the joint deviation. Is this clear, everyone? Okay. Now I got my individual covariance. Now remember, students, x minus x bar, x is in the form of percentage. Yes or no, everyone? 10% minus 12%, it is minus 2%. Yes, y minus y bar, this is, say for example, randomly 4%. Yes, when I'm doing x minus x bar into y minus y bar, okay, minus 2 into 4 becomes minus 8%, into percentage becomes percentage square. So it is going to be, yes, 4 minus 8% square. Is this clear? Covariance is always going to be in the form of percentage square. Now I have my individual covariances. I want one single figure. So what I will do? I will do the average. Yes or no, everyone? Yes. How x is moving from its average and how y is moving from its average. It is the joint deviation. Is this clear, everyone? Individual covariances I got. Now I will do a summation divided by n. I will arrive at the joint, yes or no, average covariance. Okay. Now covariance will always be in the form of percentage square. Is this clear, everyone? Okay, boss. In case future data is given, same thing. Yes, how x is moving from its average and how y is moving from its average. I will arrive at the individual covariances. Now, boss, the probability of occurrence is given, multiplied by p. Take a summation. I will arrive at the covariance. Is this clear, everyone? Okay. Till here the discussion is okay. Okay, boss. Now additional things. Now remember, students, Harry Markowitz has told that risk of a security is always the variance. Okay, but variance doesn't have interpretation. Okay, because variance is in the form of percentage square. Look at this example number 1 that we have done. Okay, look at this, everyone. Okay, yes, returns for 5 years is given. So based on that, I got the average return 12%. We are expecting 12% return. I calculated my variance. Variance is coming as 146% square. Tell me, what does it mean? Okay, I'm investing in a security. Yes, I'm expecting a return of 12%. But is there a risk? There is a risk. What is the risk? The risk is 146% square. Are we in a position to get a feel of it? No, boss. So to get a feel, yes, to interpret the risk, only for the sake of interpretation, we calculate standard deviation. How do we calculate standard deviation? It is a square root of variance. Now the biggest problem students commit throughout is that they directly calculate formula for standard deviation. Boss, there is no concept of standard deviation. Risk is variance. But because I cannot interpret variance, now after I've calculated variance, I will calculate standard deviation. Standard deviation formula throughout is simple. It is just square root of variance. Is this clear, everyone? Yes, this is for our students who have not listened to my classes. Is this clear? Variance is in the form of percentage square. Yes or no, everyone? So when you are taking a square root, it becomes in the form of percent. Is this clear, everyone? Okay. Now additional things. If the annual return X is not given, if the annual return is given, directly I can apply. But boss, the annual return is not given. In that case, how do I calculate the annual return? Simple. It is a dividend plus P1 minus P0 divided by P0 into 100. Simple. Assume there is a share of 100 rupees. Okay, yes. In the first year, it has given a dividend of, say, for example, 10 rupees. At the end of the year, I'm having a closing price of 105. So what all return I've earned? Okay, was 10 rupee return. Yes, dividend also I got. Yes, 100 has become 105. That means 5 rupees capital appreciation I got. So total 15 rupees I got. On what value? On my P0, which is 100. So it gives me 15%. Is this clear, everyone? Basic formula, D plus P1 minus P0. Yes, divided by P0 into 100. Is this clear, everyone? Okay. Yes. Now comes return of a portfolio. I am not investing in a single security. I am investing in a portfolio group of securities. What is a return? Simple, was it is a weighted average return. Yes, which is nothing but summation of weight into the expected return. Suppose there are two securities, A and B. So it is going to be weight of A into expected return of A plus weight of B into expected return of B. Is this clear, everyone? Tell me, do we know how to calculate the expected return of individual securities? Yes, boss, we know. Sir, yes, what is going to be the weight? Yes, either weight will be given in the question. Bingo. Or if weight is not given in the question, we will be taking weight based on the investment value. Is this clear, everyone? Okay. Now comes a very important trick. Whenever question has given us data for 2 or more years, every year my investment value will change. Yes or no, everyone? So I will be considering the opening market value. Say for example, yes, 2-year data is given 0, 1, 2. Yes, for the first year when I'm calculating the return, this is the opening investment value. Based on this, I will be calculating. For the second year when I'm calculating the return of the portfolio, this is the opening investment value. Based on this, I'll be calculating the return. Is this clear, everyone? Till here the discussion is clear, yes or no, everyone? Some important points quickly let us try seeing. Look at this, everyone. Expected return of a security. Okay, we've seen. Yes. Then variance, okay, we've seen. Standard deviation, we've seen. Based on future data, we've seen. Yes, annual return of security is not given. D plus P1 minus P0 divided by P0, we've seen. Common points, okay. Return calculation is always done in percentage terms. Okay, for a risk-free security, risk-free, there is no risk. That means the variance is also 0, standard deviation is also 0. Okay. Now, whatever we have calculated here, variance as well as standard deviation, it is the total risk of the security. It can further be bifurcated into systematic and unsystematic. Don't worry, in unit number 2 we will be discussing. Okay. Risk is always the variance. Is this clear, everyone? Okay. Return of a portfolio, we have told it is a weighted average, where yes, W, it is the weight of the securities. How do we calculate the weight? It is based on the investment value or the opening market value. Is this clear, everyone? Okay. Now, yes, one beautiful adjustment which was there in one of the questions. Okay. Now, question has told that existing price of equity share is 106, which is come 10% bonus debenture of 6 rupees. Based on that, they told first year and this all could be the prices. Calculate the return. Tell me, students, I want to calculate the return. For that, I want to know the opening price of the share. Yes or no, everyone? Tell me, what is the price of the share? 106. But tell me, is it just the price of the share? No, boss. it is come 10% bonus debenture of 6 rupees. Yes or no, everyone? I am telling, yes, say for example, pen plus pencil is equal to 20 rupees. Pencil is 5 rupees. That means what is the price of pen? 15 rupees. Same story. Okay. Yes, right now the price is 106. But boss, in this, there is a, yes, 10% bonus debenture whose value is 6. That means what is the value of share? It is going to be 100 rupees. Is this clear, everyone? This was one adjustment of the question. Okay, fine, boss. Now look at this. Some example, important example questions. Quickly, let us try seeing. Pay attention, everyone. Example number 2. Okay, fine. Look at this here. When annual returns are not given, X, it is not given, but we have to be calculating. Remember, yes, if data is given for 6 years, we can calculate the returns for 6 minus 1, 5 years only. Okay, look at this, students. Now here, how do we do the calculation? I always prefer drawing a line, writing down the data, accordingly doing it. Pay attention, students. First year, what is the market price at the end of the year? 100. So first year end, the price was 100 rupees. And in first year, how much dividend was declared? 10 rupees. Okay, fine. Second year end, what is the price? 120. Yes, second year, how much is the dividend? 10 rupees. Okay. Now tell me, students, can I calculate the return for the first year? No, boss. Why? If I have to calculate, I should be knowing the opening market price, given is the closing market price. Yes or no, everyone? I don't know. Yes, at what price I have purchased. So, yes, at the end of the year, I know the price is 100. I know 10 rupees dividend I have received, but I don't know the opening market price. So, for the first year, I cannot calculate the return. But for the second year, can I calculate? Yes, boss. Here the price was 100. This price became 120, so I got a capital gain of 20 rupees. With that, I got a dividend of 10, so total I got 30 rupees. Yes, upon 100, which is 30%. Next year 120 was there, 120 became 130, 10 rupees capital gain plus 14, so it is 24. Upon 120, it is going to be 20%, so on and so forth. Is this clear, everyone? Okay, simple. When annual return X is not given, we should be calculating. Simple. Draw a line. Yes, every year you write down the price. Okay, in the middle, whatever is the dividend for the year, you write down, and accordingly you calculate the return. And remember, if the data is given for n years, I can calculate the return only for n minus 1 year. Is this clear, everyone? Okay, this was important in this particular question. Next, coming to question number 4, example 4. Look at this, students. Current market price of the share is 500 today. Market condition could be as follows by end of the year. Yes, if economy is bad, by end of the year, market price will be 480 and dividend will be 10. What is the probability? 20%. If market is normal, 40% chance. 520, 20. Market is good, market is best. So tell me today, what is the price of the share? 500. Year end, what all could be possible? Market is bad, yes, normal, good, best. Yes or no? In each of the cases, I will calculate the return. Tell me, students, if market is bad, what will be the closing market price? 480. Yes, what is the dividend? 10 rupees. So how much return I am getting? 10 rupees dividend I got. 500 has become 480. That means capital gain is minus 20. So net, I am having a 10 rupee loss upon 500. 10 upon 500, I will be having minus 2%. Is this clear? If market is normal, 500 will become 520. That means 20 rupees capital gain plus 20 dividend, 440 upon 500, which is 8%. So on and so forth. Yes, once I have calculated the return, accordingly all calculations I will do it. Is this clear, everyone? Okay. Fourth one is over. Next comes question number 6. Okay, here. Calculate expected return of portfolio for 2 years. Look at this, students. Security A, B, C is there. Number of shares, market price at the time of investment, market price at the end of first year, market price at the end of second year. Okay. With that, what is also given? Dividend is also given. Pay attention. Very simple. Yes, I have to calculate the return of the portfolio for 2 years. Okay. For the first year, when I'm calculating the return of the portfolio, how do I calculate return of the portfolio? It is going to be weighted average. Yes or no, everyone? Yes. Weight into expected return. First, I want the weight. Tell me, students, where I am standing here at the 0th year. Weight, it is based on the investment value. Tell me today, what is the market price of the share? Do I know? Yes, boss. Do I know the number of shares? Yes, boss. If I multiply, can I arrive at the investment value? Yes, boss. Based on that, can I calculate the weight? Yes, simple. That is going to be the weight for the first year. Is this clear, everyone? Yes, I want to calculate return for the first year. When am I investing? 0th year. On that day, whatever is the investment value, based on that I will calculate. Is this clear, everyone? Okay. Look at this. Yes, expected return for the first year, number of shares, market price at the start gives me the investment value, gives me the weights. Is this clear? Now based on this, I will calculate the return. Tell me, students, in case of security A, first year, what was the opening price? 100. it became how much? 120. So 20 rupees capital gain was there. With that 10 rupees dividend was there. So total 30 rupee gain on 100 rupees. It is going to be 30 percentage. Yes or no, everyone? Similarly, I will do for all the securities. I got the weight return. I can arrive at the weighted average return. Is this clear, everyone? Okay. Now coming to calculation of return for the second year. Calculation of return for the second year. Tell me, students, when I'm investing for the second year, yes, on what value I am getting return for the second year? Based on the value which is lying on the first year. Yes or no, everyone? So when I want the expected return of the portfolio, it is weight into expected return. Weight, what is going to be the weight? It is the investment value on first year. Yes or no, everyone? So I will consider the number of shares, market price at the end of first year. I will multiply, I will arrive at the investment value. Based on that, I will calculate the weight. Look at this, students. Second year, yes, number of shares, yes, market price at the end of first year gives me the, yes, investment value at the end of first year. Based on that, I will arrive at the weights, and then I will calculate the expected returns. Expected returns is same only. Look at this, everyone. Yes, first year and it was 120, it became 160. That means 40 rupees capital gain, as well as 30, 40, 30, 70. I got upon 120. 70 upon 120 is going to be somewhere around 58.33%. Accordingly, I will do a weighted average. Is this clear, everyone? Okay. Till here the discussion is over. I think here, yes, one point we had left out when we have discussed this. Okay, fine. Yes, which is calculation of correlation coefficient. Calculation of correlation coefficient. Yes, correlation coefficient. Yes, also called as R. Now, yes, we have logically explained that in our regular batch, but right now quickly I'm going to tell. Yes, I will call it as net deviation divided by total deviation. Yes, if I create a portfolio, yes, correlation R, it is just going to tell me my net deviation is how much percentage of the total deviation. Okay, net deviation is the covariance xy, divided by total deviation. Yes, suppose there is no risk cutting, how much the risk would have been? The risk would have been sigma x and sigma y. Is this clear, everyone? This is the formula for correlation. I am not here to explain. This is going to be a quick rocket revision. Yes, it is net deviation divided by total deviation. Net deviation is covariance xy divided by sigma x into sigma y. Is this clear, everyone? Okay, fine. Now coming to the workbook. Yes, 2, 4, 6 we have done. Now we are going to example number 10. Yes, before we go to example number 10, covariance correlation coefficient. Okay, look at this, everyone. Yes, 5-year data is given for security X as well as Y. Okay, fine, boss. What all we have to calculate? We have to calculate return of securities, risk of the security. Okay, covariance and correlation coefficient. Other things are also there. How do we do? Firstly, for security X, I will write down the return, individual return. I will do a summation. I will arrive at the total. Just a second. What has happened? Yes, I will do the total of this divided by n. I will arrive at the average return. Okay, then I will do x minus x bar the whole square. Yes, individual variance is available. Total divided by n gives me the variance. Yes or no? Similarly, I will do it for y. Yes or no? Then I will calculate the joint deviation. X minus x bar, y minus y bar. Individual covariance I got. Yes, divided by n, I will arrive at the covariance. Now I'll have to calculate the correlation. Correlation is nothing but covariance xy divided by sigma x, sigma y. Is this clear? These many calculations in a single stretch we can do and finish it off. Okay, my dear students. Now going ahead, yes, let us try discussing risk of a portfolio. Okay. Now risk of a portfolio including of two securities. Yes, this is how we have done. Suppose there are two securities xy. Yes, whose respective weight is weight of x, weight of y. Yes, individual risk is sigma x, sigma y. How do we calculate? Yes, always remember this a plus b whole square formula. A plus b whole square is equal to a square plus b square plus 2ab. Yes or no, everyone? So similarly, weight of x sigma x plus weight of y sigma y the whole square. We have always promised risk we will always be calculating in the form of variance only. Yes, it is a square weight of x sigma x the whole square plus b square weight of y sigma y the whole square plus 2ab plus 2 into weight of x weight of y sigma x sigma y. And when two securities are coming together, there will be a risk cutting because of correlation effect. Yes, into correlation. Yes, r xy. Is this clear, everyone? Yes, this is going to be the formula for calculation of variance of a portfolio. Is this clear, everyone? Okay. Now there is another way of writing it as well. Tell me, students, rxy, it is a covariance xy divided by sigma x sigma y. So can I also write covariance xy, covariance xy, it is rxy, yes, into sigma x into sigma y. Yes, here if you guys see, yes, I'm having sigma x into sigma y into rxy. So instead of this I can also write it as covariance xy. Yes or no everyone? So look at this, this is going to be my formula. Yes, alternate formula, it is weight x sigma x the whole square plus weight y sigma y the whole square plus 2 into weight x weight y into covariance xy. This way also I can be telling. Okay, always remember, first we will always be calculating the variance, then if I just do a square root I will arrive at the standard deviation. Is this clear everyone? Okay. Even if I have three securities, same story only, it is going to be a plus b plus c whole square. It is a square plus b square plus c square plus 2ab plus 2bc plus 2ac. Yes or no? Accordingly we can do and finish it off. Is this clear everyone? Okay, fine. Now covariance, understanding covariance is over. Yes, additional point, covariance of a stock with itself, covariance of x with x, it is nothing but variance of x. Tell me students, how do I write covariance? Yes, how x is moving with from its average and how y is moving from its average. Yes, take an average, this was covariance of x with y. If I have to calculate covariance of x with x, how x is moving from its average and how x is moving from its average, do the average of that. Yes or no everyone? Summation, it is sigma x minus x bar the whole square divided by n. What is it? It is nothing but the variance. Is this clear everyone? Covariance is denoted as percentage square. Is understanding correlation coefficient? Okay, not very important. Yes, positive correlation means securities are moving in the same direction, negative means they are moving in the opposite direction. Yes, zero means okay, there is no relationship at all. Is this clear everyone? Ideally if I am having negative correlation means there is a maximum risk reduction. Okay, not very important because we are having calculation. Okay, how do I calculate correlation? It is covariance xy divided by sigma x sigma y. Okay boss. Now yes, Majaa adjustment. Yes, if correlation between two securities is given, yes, two securities with the market is given, then how do I calculate? Yes, suppose correlation of x with market is given, correlation of y with market is given. How do I calculate correlation of x and y? Yes, correlation of x and y, it is correlation of x with market into correlation of y with market. Is this clear everyone? Okay, fine. Okay, now yes, this is one single format to solve all the questions for students who are by hearting. Till now logically I have told, but for students who are by hearting, if you just want to by heart, simple. Now what all columns should be there? Okay, first step is going to be calculation of probabilities. If you are doing logically you can do it, but for students who want to by heart, just they want a format. Okay, calculation of probability or weight. If probability is given in the question, bingo. If probability is not given in the question, we will assign equal probability. Yes, wherein we will do 1 divided by n. Suppose 5-year data is there, means everything is equally likely probable, 20% chance is there, 1 divided by 5.2. Is this clear? Based on that, what all columns will be there? First we will write down p probability. X, p into x gives me the expected return of x. I will calculate deviation x minus x bar. Then I will calculate variance x minus x bar the whole square multiply by p into x minus x bar the whole square. This gives me variance of x. Same story I will do for y. Then I want to calculate the joint deviation x minus x bar into y minus y bar into the probability. Yes, gives me the covariance. Is this clear everyone? Yes, still here we have done the calculations. Yes or no everyone? Give me a confirmation students. Yes everyone, let us go ahead and discuss shortcut formulas for calculation of variance. Now in case of a portfolio, we know we will be calculating portfolio variance. How do we do? Weight of x sigma x the whole square plus weight of y sigma y the whole square plus 2 into weight of x y sigma y into rxy. Now in some cases this equation can be simplified. Suppose r is equal to plus 1. Okay. Yes, it is going to be, yes, a case of perfectly dependent. Yes, r is equal to plus 1. So this goes off, yes or no, into 1. Yes, it's the same thing. So what is left is a square plus b square plus 2ab. Yes or no everyone? Can I write it as a plus b the whole square? Can I also write it as a, which is weight of x sigma x, plus b weight of y sigma y the whole square? Yes boss, variance of a portfolio is equal to weight of x sigma x plus weight of y sigma y the whole square. If I want it as a shortcut, I can directly tell, okay, standard deviation of portfolio, it is weight of x sigma x plus weight of y sigma y. Yes or no? It is nothing but the weighted average. Directly you calculate the standard deviation. Is this clear everyone? Okay, now one more situation. If r is equal to minus 1, same equation is there. R is equal to minus 1, it is getting multiplied by minus 1. So a square plus b square, yes, plus 2ab into minus 1 becomes minus 2ab. Can I also write it as a minus b whole square, which is weight of x sigma x minus weight of y sigma y the whole square? Yes or no everyone? Yes, this is the variance of a portfolio. Yes, if I remove the square, I can calculate standard deviation of a portfolio as weight of x sigma x minus weight of y sigma y. Is this clear, everyone? Okay. Now, if r is equal to 0, it is in case of perfectly independent. Look at this, students. Yes, r is equal to 0. This entire thing becomes 0. Yes, in that case, what is left is a square plus b square. Yes or no, everyone? Portfolio variance is a square plus b square. Weight of x sigma x the whole square. So, sigma x the whole square plus weight of y sigma y the whole square. Is this clear, everyone? Okay. Sorry. Shortcut formulas. If r is equal to plus 1, I can directly calculate standard deviation of portfolio as weight of x sigma x plus weight of y sigma y. Yes, if r is equal to minus 1, I can directly calculate standard deviation as weight of x sigma x minus weight of y sigma y. Is this clear, everyone? Okay, this is going to be the shortcut formula. Okay. It has become too much. Okay. Now, yes, concept number 3 is calculation of minimum risk or minimum variance portfolio. Now, understand, students, minimum risk portfolio. Ideally, we want to maximize the return but minimize the risk. 1 second, students. Yes, everyone, calculation of minimum risk or minimum variance portfolio. Here we are having two different situations. In case of two securities, in case of three securities. Okay, two securities we'll be discussing here. Three securities we will be discussing with unit number 3. Yes, which is going to be with the concept of market lines. Okay, equation of a straight line. Here, in case of two securities, different situations. If R is equal to plus 1, in that case risk cannot be reduced. Risk of a portfolio is nothing but the weighted average. Directly I can do, yes, risk of a portfolio, it is a weighted average, weight of x sigma x plus weight of y sigma y. Is this clear, everyone? Okay. If r is equal to minus 1, securities are moving in the opposite direction. One security is decreasing, other security is increasing. That means maximum risk reduction can happen, yes or no? And if I plan properly, yes, risk can be brought to 0 also. But boss, if I have to bring the risk to 0, means I should invest properly. Okay. Now, if r is equal to minus 1, I know the shortcut formula. Yes, risk of a portfolio, it is weight x sigma x minus weight y sigma y. Question is asking how much weight I should invest so that I can create a minimum risk portfolio. Tell me, students, if r is equal to minus 1, risk can be brought to 0. So that means sigma p can become 0. I want to know weight of x as well as weight of y. Let me assume weight of x is equal to x, weight of y is equal to 1 minus x, because summation of weight is equal to 1. Accordingly, solve the equation. Yes, the overall risk should be equal to 0. Arrive at the value of x as well as 1 minus x. Is this clear, everyone? Okay. Risk can be brought to 0 if investment is done in the proper weight. Yes, sigma p, I know the shortcut formula. Based on that, assume the weight of security x is equal to x, y is equal to 1 minus x, standard deviation of portfolio is 0. Accordingly, solve the equation. Is this clear, everyone? Okay. Now, if r is any other value, pay attention, students, r is any other value, yes, in that case risk can be reduced but it cannot be brought to 0. Is this clear, everyone? And we want to calculate the weight of minimum risk portfolio. Just a second. Yes, risk can be reduced but it cannot be brought to 0. We want to calculate the weight of minimum risk portfolio. Yes, we have learned it in the form of 3 simple principles. There is a big formula but we will understand it in the form of principles. Yes, what are the principles? There are two securities, x and y. Okay, the risk of security x is reduced by security y. The risk of security y is reduced by security x. Yes or no? One security is having a risk. That is why we are investing in the other security, so that other security is going to reduce my risk. Okay, boss. Risk of one security is reduced by the other. Okay, that is going to be principle number 1. Yes. Principle number 2. The extent of risk reduction, I will tell it as the variance minus covariance. Individually, if I am investing only in x, what is the risk of x? It is the variance of x. But boss, I create a portfolio. Yes, what is the joint deviation? It is the covariance. Is this clear, everyone? So the extent of risk reduction is going to be variance minus covariance. Is this clear, everyone? Okay. Now, based on that, if I have to calculate the weight of x, tell me how much I should invest in x. Tell me whose risk x is reducing. Suppose x and y are there. Yes, whose risk x is reducing? Whether x is reducing its risk? No, boss. X is reducing the risk of y. So it is a risk reduction of y divided by total risk reduction of x plus y. Yes or no, everyone? Tell me, risk reduction is variance minus covariance. I want a risk reduction of y, which is variance of y minus covariance of xy, divided by total risk reduction of x plus y. Yes, risk reduction of x. Yes, it is variance of x minus covariance xy. Yes, risk reduction of y. It is variance of y minus covariance xy. This I can also rewrite it as, yes, minus covariance. I can write it as, yes, variance of x plus variance of y minus 2 into covariance xy. This is going to be the formula. I've given you quickly in 1 minute the feel of how to create this formula. Is this clear, everyone? Okay. Yes, three simple principles. Yes, risk of a security is reduced by the other security. The extent of risk reduction, it is variance minus covariance. How much is going to be the weight of x? It is a risk reduction of y divided by total risk reduction. Accordingly, I will do. If I arrive at the weight of one security, the weight of other security is going to be 1 minus weight of the security. Is this clear, everyone? Okay, boss. This one is also over. Yes or no, everyone? Example 10, if we see properly here, they are asking us basic calculations. Anyways, they're asking, yes or no, everyone? They're also asking us calculate the portfolio return and portfolio risk if investor is putting 60% in x as well as 40% in y. Okay, portfolio return, it is a weighted average. Portfolio risk, I know, weight of x sigma x the whole square plus weight of y sigma y the whole square plus 2 into weight of x weight of y sigma x sigma y into rxy. Yes or no, everyone? Weight of a minimum risk portfolio. Also calculate the return and risk of such a portfolio. Okay, minimum risk portfolio I should be calculating. Look at this, everyone. Weight of x, it is a risk reduction of y divided by total risk reduction of x plus y. Yes, risk reduction of y, it is a variance of y minus covariance xy divided by variance of x minus covariance xy plus variance of y minus covariance xy. It is variance of x plus variance of y minus 2 into covariance xy. Yes, simplify, I will arrive at weight of x is equal to minus 0.4722. Therefore, weight of y is equal to 1.4722. Is this clear, everyone? Now, for this portfolio also, question is asking calculate the return and risk. I know how to calculate the return and risk. Is this clear, everyone? Yes or no? Okay. Now we are having the final concept in unit number 1, which is going to be the concept of efficient portfolio. Now, Harry Markowitz is telling whenever we are selecting securities, now we should only be selecting the efficient securities. Now, how do we do the calculation? Directly we'll come to example number 12. Okay, bear with me, extremely sorry. Okay, yes, everyone, look at example number 12. Company has shortlisted 6 different securities as follows: A, B, C, D, E, F. Expected return is there, risk is there. Now, how do we take a decision? First, compare the return. Wherever return is same, let us try seeing. Here, 12 is there, security A as well as security F. Security A is also giving me 12%. F is also giving me 12%. That means return is same. That means here decision will be taken on the basis of risk. Yes or no, everyone? Tell me, ideally I want risk to be more or risk to be less. I want risk to be less. So tell me, here the risk is 8 only, here the risk is 9. Which one is better, students? Which one is better? A is better because the risk is less here. That means A is efficient, F is inefficient. Strike off F. Is this clear, everyone? Okay. Step number 1, compare the securities having the same return. Return is same, see the risk. Wherever risk is less, that is the best, others eliminate. Okay, now anywhere else return is same, 18, 25, 20. No. Now step number 2, compare securities having the same risk. Risk 10, 10. Here also risk is 10, here also risk is 10. So that means risk is same. So what am I going to compare? Return. Ideally return should be more. Here return is 18, here return is 20. That means which one I will cancel? I will tell B is not good. Yes or no, everyone? D I will keep it. Is this clear, everyone? Okay. Step number 1, compare the securities having the same return. Select the security having the lowest risk. Step number 2, compare the securities having the same risk. Select the security having the highest return. Okay, this is done. Now balance securities. We need to rearrange in the order of risk. Look at this, students. Tell me, balance securities. Where there is a lowest risk, A. There is a lowest return. Yes or no? Slightly more risk where it is there. In D, yes, 10% risk is there. Is it compensated with a higher return? Yes, boss, it is having a higher return. Next, what comes? C. It is having slightly more risk. Yes. Is it giving me slightly more return? Yes. After that, which comes? D. Is it, sorry, E. It is having more risk. Yes, boss. But is it having more return? No. Look at this. Security C now at 11% risk, it is giving 25% return. But boss, E, it is having a higher risk, but it is giving me only 23% less return, so that means E is also inefficient. Yes or no? That leaves us with three securities, A, C and D. Is this clear everyone? Yes or no? That is step number 1, compare securities having the same return. Select the security having the lowest risk, eliminate others. Step 2, compare the securities having the same risk, select the security with the highest return, eliminate others. Balance the securities, rearrange in the ascending order of risk. Yes, higher risk, higher return, if it is there means okay, bingo, no problem. But risk is more, return is less, that is again going to be inefficient. Is this clear everyone? Yes, based on that we are having, yes, Markowitz efficient frontier graph, not important. Yes, determination of optimum securities is also not going to be important. With this, unit number 1, modern portfolio theory is done over, my dear students. Portfolio management charts I will be uploading in our Telegram group, Think with Tabish, so you guys can go and take a PDF of it from the same. Is this clear everyone? I'll take a small break. After that we'll go ahead to unit number 2 as well, my dear students. Yes everyone, let us proceed to unit number 2, which is going to be CAPM and beta by William Sharp. Okay, now yes, what William Sharp is trying to tell, he is telling, boss, we have calculated the total risk of a security, which was denoted by sigma. Yes or no everyone, standard deviation. He is telling the total risk can be further bifurcated into systematic risk and unsystematic risk. What is systematic risk? It is a risk arising from system related factors, market related factors. Is this clear everyone? It is not in the control of anyone. COVID happened, none of the shares are performing. Yes, system related factors, market related factors. War is happening between USA and Iran. Yes, none of the shares are performing well. Okay, market related factors, systematic risk. Is this clear everyone? One more is unsystematic risk. It is a risk arising because of company related factors. Company is not carrying out the business properly. Okay, there is a fraud in the company. Company's operations are not efficient. Okay, management is doing some fraud, etc, etc, etc. Okay, now how do I denote? Systematic risk is denoted by beta. Unsystematic risk is denoted by error term E. Is this clear everyone? Okay, so what is William Sharp trying to tell? He is telling, boss, total risk can be bifurcated into systematic, unsystematic. Systematic is because of market related, unsystematic is because of company related. Okay boss, unsystematic is company related risk. This risk can be reduced. How? By diversification. Systematic risk, it is a market related risk. You create a portfolio, can it be diversified? No boss, it cannot be diversified, because this risk is inherent in all the securities in the market. Is this clear everyone? Okay, fine. So yes, what William Sharp is telling is, boss, investor should not be demanding a premium for total risk, because in total risk, systematic is there, unsystematic is there. Unsystematic we can eliminate. Yes, we should be demanding a premium only for the systematic risk. Is this clear everyone? That is why in CAPM I am demanding a premium only for the systematic risk, that is beta. Is this clear everyone? This is a basic background. Then comes the concept of beta. What is beta? Beta is a measure of systematic risk. It is telling my security is how much times risky in relation to the market. Okay, suppose beta of a security is 1.5. it means my security is 1.5 times volatile in relation to the market. If market increases 1%, my security increases 1.5%. If market decreases 1%, my security will fall by 1.5%. Is this clear everyone? Okay, fine. Now some important beta figures. Yes, beta of a risk-free asset is always going to be 0. Beta of market is always 1, because we are comparing in a relation to market. So beta of market is always going to be 1. Is this clear everyone? Okay. Then comes concept number 1, which is calculation of beta of individual securities. Okay. Now different cases. Case number 1, when only 2 years data is given. Look at the students. First year now, yes, market was giving 10%. That point in time, security X was giving 12%. Second year, when market gained 15%, security X is giving 20%. Tell me students, how much extra return market is giving? 5%. When market is giving 5% extra, my security is giving 8% extra. Yes or no everyone? Okay. When market is giving 5% extra, my security is giving 8% extra. I want to know, yes, if market is changing by 1%, my security will change by how much? It is 8 divided by 5. Yes, which is going to be 1.6. Yes or no? If I have to write it in the form of formula, 8. It is change in the security return divided by 5, change in the market return. Is this clear everyone? Yes or no? Okay, fine. So look at this everyone. This is going to be master chart for beta. All calculation first. Beta of individual securities. If only 2 years data is given, how do I calculate beta? Remember students, beta is always calculated in a relation to market. So always in the denominator I will be having a market data. Yes, market figure. Okay boss. First one, only 2 years data is given means it is a change in the security return divided by change in the market return. Is this clear, everyone? Okay. More than 2 years data is there. Yes, in that case, how do we do the calculation? Pay attention. I've given you guys a very simple way of doing it. Yes, we've told it is systematic risk of security X, beta of X if I want to calculate it, divided by systematic risk of market. Yes or no, everyone? I want to see in relation to market. I am comparing only the systematic risk. Suppose randomly I am telling systematic risk of market is 10. Yes, systematic risk of X is 15. That means beta of the security is 1.5. It is 1.5 times risk here. Okay. How do I calculate systematic risk of X? Okay. I will take the total risk of X, sigma X. Yes, into how much percentage of it is because of market related factors into RXM gives me the systematic risk of X, divided by, I will take the total risk of market, sigma M, into how much percentage of the risk is because of market. Correlation of a security with itself is always going to be 1. This will be 1. So this is going to be my formula. Is this clear, everyone? So beta of X is equal to sigma X into RXM. Yes, divided by sigma M. Is this clear, everyone? Now remember, beta is always going to be a numerical figure. Okay, yes, look at this, students. Here also, yes, change in security, it was in the form of percent, 10%, divided by change in market, assume this is 5%. Yes or no? 10 divided by 5 is going to be 2. Percentage, yes, cancel. Beta is a numerical figure. Here also, sigma X, suppose this is 10%. Yes, into RXM, randomly I'm telling, say for example 0.5 gives me 5%, divided by sigma M, suppose randomly 10%. Yes, that means it is going to be 0.5. 5 divided by 10, 0.5, percentage gets cancelled. Is this clear, everyone? Remember, beta is always going to be a, yes, numerical figure. Or I can also write it this way. Look at this, students. Sigma X divided by sigma M into correlation. Can I write it as covariance XM? Yes, divided by sigma X, sigma M. Yes or no, everyone? Yes, this and this gets cancelled. So what is left is covariance XM divided by sigma M square. This is an alternate formula. Yes or no, everyone? Okay. This how do we remember? Okay. One formula we are having correlation. This one logically we have understood. In case of covariance, remember, in calculation of beta always, okay, market will come in the denominator. Okay. Covariance I'm having. Tell me how covariance value will be coming in the form of percentage square. That means beta is a numerical figure. In the denominator I will have market, but boss, I want percentage square, only then it will cancel and become a numerical figure. That means in the denominator also should be sigma market square. Is this clear, everyone? Yes, even in rocket revision, quickly in a second I'm trying to give you guys a feel of the formula. Boss, if you want to know the detailed logic, yes, I've uploaded a revision of portfolio in detail, wherein everything beautifully I'm explaining to you guys. Is this clear, everyone? Okay, this is going to be formula of, yes, beta. Is this clear, everyone? Okay, fine. Till here the calculations are over. Now there is one more thing. Yes, there is a shortcut formula for calculation of beta, but this one we can be using only in case of past data. Quickly in a second I will try telling it to you guys. Tell me, students, now I want to do a summation. If individual values are there, say for example X is 10, 20, 30, 40, 50, I want to do a summation. How will I do? I will do a summation of X. Individually I will add 10 plus 20 plus 30 plus 40 plus 50, 150. Okay, but boss, if average is there, so I calculate average of this. 150 is for 5-year data. That means the average data is 30. Yes or no? I want to do a summation. Can I also do it this way? Boss, the average of every data is 30 into there are 5 data. That means it is going to be 150. Yes or no? Can I also tell it as n, number of observation, into x bar, the average observation, gives me the total. Yes or no, everyone? Is this clear? Now if this much is clear, from this, yes, we can pull shortcut data. Pay attention, it is regression analysis, so much things is there, but still quickly in a minute I will try telling you guys. Okay, now shortcut formula only for past data. Yes, from where I will pull this, if we are using, means quickly we can calculate beta. Pay attention, students. I have the formula covariance xm divided by sigma m square. Yes or no, everyone? Okay, covariance xm. How do I calculate covariance? It is joint deviation x minus x bar into m minus m bar. Yes, summation divided by n. Yes, divided by variance of m. Yes, it is sigma m minus m bar the whole square divided by n. Divided by n gets cancelled, so let me just remove this. Yes or no, everyone? Okay, m minus m bar the whole square, can I write it as m minus m bar into m minus m bar? Okay, fine. Now look at this very simple way of doing it. Pay attention, students. Yes, first one with first one, second one with second one. Okay, in the numerator sigma is there, summation, first one with first one is xm, sigma xm. Okay, minus, there is a minus symbol. Yes, second one with the second one. Yes, it is a sigma x bar m bar, yes or no everyone. Now this one I can write it as, instead of this, yes, I want to do a summation where average figure is given. Yes, I can multiply by n x bar m bar, yes or no everyone. Okay, divided by denominator, again first one with first one, yes, m into m, yes, which is going to be sigma m square, minus second one with the second one, yes, this is m minus m bar, m minus m bar, yes, it is going to be sigma, yes, m bar square. Tell me, whenever I am having average figure, I want to do a summation, I can do it as n into m bar square, yes or no everyone. This is going to be the formula. Yes, this is the shortcut formula for calculation of beta. Is this clear everyone? Okay, fine, this is beta. Yes, remember, this is a shortcut formula. It can be used only if past data is there. Is this clear everyone? Okay, then comes calculation of beta of a portfolio. Beta of a portfolio is simple. It is nothing but weighted average. It is summation of weight into the beta. Yes, beta of individual security will be given, or how to calculate, I know. Yes, weight based on the investment value, I'll be calculating the weight. Based on that, I'll be calculating the beta of the portfolio. Is this clear everyone? Okay, concept 1 is over, beta of individual securities. Everything quickly, tuck tuck tuck, I've told. Yes, concept 1a is going to be portfolio beta. Is this clear everyone? Weight is based on the investment value. Then comes the CAPM. Boss, it will be injustice if in the rocket revision I'm going to explain you guys CAPM, yes or no everyone. Yes, it is a telling, boss, required rate of return, it is a risk free plus beta into RM minus RF. Yes or no everyone? I'm not going to explain. Basic blocks from intradays you've been learning. Okay, here beta that you're considering, if you want a required rate for a security, you take a beta of a security. If you want a required rate for a portfolio, take the beta of the portfolio. Is this clear everyone? Okay, as simple as that. Okay, now here RM minus RF, yes, it is called as a market risk premium. Market is giving me how much premium? Beta into RM minus RF, it is called as security risk premium. Okay, fine, boss. Till here this thing is over. Now, yes, what all adjustments institute is asking? Yes, first one is risk-free rate of return. Now, risk-free rate of return, sometimes question will give, yes, the return on treasury bill, treasury bond, government securities, all these are referring to the risk-free rate of return. Now, what all adjustments could be there? Fine. First one, if risk-free rate of return is not given in the question, but coupon is given. Look at this simple example, students. Question is telling 7% treasury bill is trading at 140. Based on that, I have to calculate the CAPM return. I know treasury bill means it is going to be risk-free security. Okay, I want to calculate. Tell me there is a treasury bill which is giving me a 7% coupon. Coupon is always on the face value. Face value here is not given. But boss, it is trading at 140. That means face value should be 100 rupees. Yes or no? Everyone. Tell me every year how much coupon or interest it is giving. 100 into 7%, 7. Can I calculate? Tell me, I am investing 140 and I am getting 7. That means how much percentage I am getting? It is a 7 divided by 145 percentage is a risk-free rate. It is a coupon divided by market price into 100. Is this clear everyone? Okay, point number 1. Point number 2, calculation of risk-free. If 2 or more risk-free rates are given, in that case we will consider the average of the risk-free rate. Simple. Suppose question is telling interest on the treasury bill is 5%, interest on government securities 5.5%. So when I'm applying CAPM, when I'm calculating risk-free, I will do 5 plus 5.5 divided by 2. It is going to be 5.25%. Is this clear everyone? Okay, fine. Next one is calculation of market rate of return. Okay, yes, market can also be called as a Nifty, Sensex, market. All those things are going to be one and the same only. Okay, yes, market rate of return is given. Bingo, no tension. If market rate of return is not given in the question, then in that case what should be done? If market related information is given in the question, I know the total return that I'm going to get. Yes, it is the dividend yield plus capital appreciation. Yes or no everyone? Okay, here, yes, dividend yield percentage will be given. Opening value of index and closing value of index will be given. Based on that, I will be calculating. Yes, look at this, students. Example number, which was the example? There is some example number. Just a second. Yes, everyone, look at this example, students. Index value at the start of the year is 21,000. Index, Sensex, Nifty, whatever it is. Okay, index at the start of the year is 21,000. Index value at the end of the year is 21,850. Calculate market returns if dividend yield is 4.75%. Okay, I know the total returns is going to be dividend yield plus capital appreciation. Dividend yield is given 4.75%. Absolutely no issues. Now I have to calculate capital appreciation. Tell me at the start of the year, index was at what value? 21,000. This is P0. Yes, at the end of the year, index is at what value? 21,850. it is going to be P1. That means how much value the index has increased, 850 from where, 21,000. So it is P1 minus P 0 divided by P 0 into 100. Yes, it is going to be 4.05 percentage. So the total return is going to be 8.8 percentage. Is this clear, everyone? Okay. This, if market related information is given, okay, dividend yield plus P1 minus P 0 divided by P 0 into 100, where P1 is the closing value of index, P 0 was the opening value of index. Is this clear, everyone? Now one more type of question can be given. It is a rubbish mistake, but still we have to pass the examination. We will be doing, if market related information itself is not given and cannot be calculated. Look at this example, students. Yes, here. Yes, suppose question is telling investors portfolio consisting of the following securities: ABC, opening market value is given, closing market value is given, total dividend is given. Question is asking calculate the market rate of return. Tell me, this is not the market portfolio, this is an investor's portfolio. Here question is asking market rate of return. Here it is practically not possible for me to calculate the market rate. Institute assumes that my portfolio is a representation of market. My portfolio only is the market. So whatever is the return on my portfolio, it is a market rate. Is this clear? Institute's assumption. For to get the marks, we will be doing it. Tell me, in my portfolio, what is the total opening investment value? 10 lakh. Total closing market value 11,90,000. What is the total dividend? 60,000. So what all I earned? Yes, 60,000 dividend I got, and 10 lakh became 11,90,000. So 1,90,000 capital appreciation gives me total return of 2,50,000 on my investment of 10 lakh into 100 gives me 25%. Look at this, everyone. Important IC assumption. If market data is not available and cannot be calculated, we will assume that our portfolio itself represents the market. So whatever is the return of my portfolio, it is a market rate. Yes or no? And how do I calculate the return of my portfolio? Overall for my portfolio, I will calculate D plus P1 minus P0 divided by P0 into 100, where D is a total dividend, P1 is a total closing market value of all securities, P0 is a total opening market value of all the securities. Is this clear, everyone? Okay. Then comes the third type of question. If yes, market rate and risk-free rate both are missing in the question, but the required rate for two different levels and the beta for two different securities is given. Yes, in that case, how do we do the calculation? Look at this, students. Where is it? Okay, now look at this. Question is telling me that there are two securities A and B. Yes, beta of two securities is given, required rate for two securities is given. Yes, but I don't know the risk-free rate, I don't know the market rate. Okay, whenever a person is leaving your life, somebody else is going to enter your life. Yes or no? Tell me, generally required rate we will be calculating, but here it is given. Generally RF and RM will be given, but here we have to calculate it. Okay, simple. We will assume risk-free rate is equal to X, and RM minus RF, that is the premium, will be equal to Y. Now I know the CAPM equation. Required rate is RF plus beta into RM minus RF. Yes or no, everyone? Tell me, for both the securities, do I know the required rate? Yes, I know the required rate. Yes, risk-free rate, I assumed it as X. Yes, beta do I know? Yes, boss. RM minus RF, I've assumed it as Y. So I am having a simultaneous linear equation. Simplify, arrive at the value of X and Y. Is this clear, everyone? Quickly I'm going to tell you guys. Okay, fine. Now comes the next and the final point. Yes, sometimes question will ask you to calculate the simple average return of the portfolio. Logically there is nothing called as simple average return, but if the institute asks you, remember, yes, if question is asking you to calculate simple average return of the portfolio, my beta should also be simple average. So step number 1, I will calculate the simple average beta of the portfolio. Based on that, I will calculate the simple average return of the portfolio using the CAPM equation. Is this clear, everyone? Okay. Security market line, it is just the graphical representation of CAPM, which is required rate is RF plus beta into RM minus RF. Not important at all. Is this clear, everyone? Okay, this point is over. Next comes concept number 3, which is underpricing, overpricing. Okay, boss, I have calculated required rate. Suppose I am telling, if I invest in Reliance share, the required rate, that is for the risk I am taking, I want 20%. Is it necessary that actually I'm getting 20%? No, boss. Actually I can be getting more or less. Based on that, I'm having underpricing, overpricing. Okay, how do I calculate? For that, one of the first things we will be calculating is something called as Jensen's alpha. What is Jensen's alpha trying to tell? It is telling me how much extra return I've generated over the CAPM required return. Simple. Yes, CAPM required return for the risk I'm taking is 20%. Suppose actually I generated 25%. So how much extra I earned? 5%. 5% is going to be Jensen's alpha. Suppose I earned 18% only, that means how much less I earned? 2% less. So Jensen's alpha is going to be minus 2% negative. Suppose I earned exactly 20%. In that case, Jensen's alpha is going to be 0. Is this clear, everyone? How do I calculate Jensen's alpha? It is the expected return minus required rate of return as per CAPM. Is this clear, everyone? Okay, fine. Now based on that, how do I calculate underpricing or overpricing? Yes, one master chart I have drawn. Pay attention, students. Look at this. There are two different ways in which I can understand if the security is underpriced or overpriced. First is by comparing the return. What all returns are there? First is the required return. Second is the expected return. Required return is as per CAPM. Yes or no, everyone? RF plus beta into RM minus RF. Expected return. It is as per modern portfolio theory. Yes or no, everyone? It is a D. How much dividend I am expecting? Plus P1 minus P0 divided by P0 into 100. Is this clear, everyone? Okay. Now, in that case, how do I calculate? Step number 1, calculate the required rate of return. Okay. Step number 2, calculate expected return as per modern portfolio theory. Yes or no, everyone? Okay, fine. Step number 3 comes decision making. Yes, if the expected return is more than required rate, yes, I want a 20% return. But boss, this security is giving me 25% return. Happy or sad? Happy. Should I purchase the security or not? Yes, I should purchase. If I am purchasing, means that security should be underpriced. Yes or no, everyone? Yes, here the alpha is positive, security is underpriced. Yes, if the expected return is equal to the required rate, boss, I want 20%, security is giving me also 20% only. Yes, in that case, the security is correctly priced. Okay, still I can purchase or I can hold the security. Okay, if expected return is less, boss, I want a 20% for the risk that I'm taking, but security is giving me only 18%. Yes, security is giving me lesser return. That means the security is overpriced. Is this clear, everyone? Okay, the second way for taking a decision is based on the price. Here, what I will be doing is I will calculate value of the share. Yes, that is how much I should be paying. How do I calculate value of the share, sir? Boss, we have already learned in, yes, equity valuation, yes or no, everyone? Gordon's growth model or two-stage, yes, variable growth model, all those things, yes or no, everyone? First step is going to be calculate CAPM required return. Okay, based on the required rate, calculate the value of the share. It is a D1 divided by KE minus G. Okay, boss. Now I will compare the actual price with the value of the share. In basics, I have told yes or no, value is greater than or equal to price, only then purchase. Say for example, the actual price is less than the fair price. Boss, yes, the value of the share is 100, but that share is available at just 70 rupees. Good or bad? Good. Should I purchase or not? Yes, that means it is underpriced. Okay. Yes, the actual price is equal to the fair price or fair value. Yes. Suppose value of the share is 100, it is available at 100. That means it is correctly priced. Still I can purchase. But boss, if the actual price is more, value of the share is 100, but it is available at 125. Will I be purchasing? No, it is overpriced. Is this clear, everyone? This is how we will be calculating, yes, underpricing, overpricing. With this, concept number 3 is also over. Yes, everyone. Now we are having concept number 4, which is going to be portfolio beta management. Here we are having altogether 3 different techniques for managing the beta of the portfolio. First one is fresh investment in risk-free securities. Second one is dispose of risky securities and acquire risk-free securities. Third one is using future contracts. Future contracts we will be discussing with the chapter derivatives. So two options are there. First one is fresh investment in risk-free securities. Understand, there is my existing portfolio. Suppose in my existing portfolio I have invested 10 lakh rupees. Fresh investment, I am making a fresh investment in risk free. That means tell me whether my total portfolio value will change or not. Yes, boss, my total investment value will change here. Second, dispose of risky securities and acquire risk free securities. Yes, 10 lakh is my existing portfolio. In this, some securities I will sell. In its place, I will invest in risk free securities. Tell me whether my total investment value will change. No, boss. Yes, I will sell some. In its place, I will be investing in risk free. That means my total investment value will be the same. Is this clear, everyone? Okay, fine. Now each of the methods, let us quickly try saying directly through an example. Pay attention, students. First one is fresh investment in risk free securities. Very simple. Yes, there's so many formulas, but using a simple framework we will do it. Finished up. Look at this. There are 2 securities. Number of shares, market price per share is given. If I multiply, I will arrive at the investment. Based on that, I can calculate the weights. Beta is given. I can calculate the weighted average beta. Beta of the portfolio is 1.5. Is this clear, everyone? Okay, so the portfolio beta is 1.5. Look at this, students. If X, that is Mr. X, wants to reduce the beta to 0.9, how much risk free investment should he bring in? He is telling, boss, deva, yes, beta of the portfolio 1.5 is very high, I want to reduce it to 0.9. How do I do? So many formulas, everything is there, but we will be doing it in a very simple way. Pay attention, very simple. Yes, I will assume that my fresh investment in risk free security is equal to X. Is this clear, everyone? Okay, tell me what all I am having. I am having my existing portfolio. Yes, boss. In my existing portfolio, total how much I have invested? 10 lakh I have invested. For my existing portfolio, what is the beta? It is going to be 1.5. Always compulsorily calculate the portfolio beta upfront, whether question asks or not. Okay, 10 lakh I have invested, there the beta is 1.5. Fresh, how much I am investing in risk-free securities? X. what is the beta of risk-free securities? I've told beta of risk-free securities are always going to be 0. So what is the total investment value? 10 lakh plus X, yes or no, everyone? Now I want to calculate the revised beta of the portfolio. It is weighted average. Tell me students, yes, in my existing portfolio, how much I'm investing? 10 lakh out of total 10 lakh plus X. So it is 10 lakh divided by 10 lakh plus X into 1.5. Yes or no, everyone? Okay. Beta of the portfolio is the weighted average. Yes. Firstly, for the risky security, 10 lakh divided by 10 lakh plus X into 1.5. Okay. In the risk free, X divided by 10 lakh plus X into 0. This anyways becomes 0. Tell me, I want the beta of the portfolio to be equal to 0.9. It should be equal to 0.9. Simplify, I will arrive at the value of X as 6,66,667. Yes, what is it that we have assumed as X? We have assumed that my fresh investment in risk-free security is equal to X. Is this clear, everyone? Okay. Now if you want, we can take a proof also. Yes, existing investment 5 lakh, 5 lakh, 10 lakh was there. With that 6,66,666.66, yes, gives you the beta of portfolio as 0.9. Is this clear, everyone? Okay. Fresh investment in risk-free portfolio securities. Look at these students. Yes, portfolio beta management. Yes, fresh investment. How? We will assume our investment in risk-free security is equal to X. Okay. Calculate, step number 2, calculate the portfolio beta. Okay, in case of fresh investment, I am having risky securities, which is existing investment, risk free. In risky securities, whatever my previous investment was there will be there. I am making fresh investment, yes or no? Existing investment was there, I am investing X rupees. So that means the total investment value will be the existing investment plus X. Based on that, I will calculate the beta of the portfolio. Accordingly, I will arrive at the value of the X. Is this clear, everyone? Very simple. Now comes the second type of question, where question is telling dispose of certain risky securities and acquire risk-free securities. Look at this, everyone. The next type of question that we are having. Okay, example number 21. ABCXYZ number of shares is given, market price per share is given. If I multiply, I will arrive at the investment value. Based on that, I will be getting the weight. Weight into beta, I will arrive at the weighted average beta, which is 1.5. Okay, fine. Now, X wants to dispose of some risky securities. What is he doing? He wants to dispose of some risky securities in such a way that portfolio beta will be 1. Suggest the appropriate strategy. Okay, what he wants to do? He wants to dispose of some securities and in its place acquire risk free. Okay, which securities we want to dispose of? Question did not tell. We will assume in the same ratio we will be disposing of. Is this clear, everyone? Okay, tell me students, right now what is my total investment value? 10 lakh. Afterwards also, what will be my total investment value? 10 lakh only, yes or no, everyone? So tell me, my total investment value is going to be 10 lakh. In that, how much I will be investing in a risk free? I don't know. I will take it as X. That means how much I will be investing in a risky. Total is 10 lakh. In that, X will be in a risk free. That means risky is going to be 10 lakh minus X. Yes or no, everyone? Okay, this is going to be the first thing. Total investment value 10 lakh, in that risk free is X, so risky is going to be 10 lakh minus X. Based on this, I will calculate the portfolio beta. Okay boss, in risky I have invested 10 lakh minus X, there the beta is 1.5. in risk free I am investing X, there the beta is 0. Total investment is 10 lakh. Is this clear, everyone? So my weighted average beta is beta of the portfolio 10 lakh minus X divided by 10 lakh into 1.5, yes, plus X divided by 10 lakh into 0. This anyways becomes 0. That is a beta of the portfolio. Beta of the portfolio for us should be 1. Simplify the equation. Value of X is 3,33,333. Is this clear, everyone? Okay. Now remember. Okay, look at this. Still here the discussion is clear. Assume investment in risk-free security is equal to X. Okay. In case of dispose risky and acquire risk-free security, yes, my total investment value will be same. In that, if I'm investing X in risk-free, yes, in my risky it is going to be total investment minus X. Yes or no? Based on that, I will calculate the portfolio beta, calculate the value of X. Yes or no, everyone? Okay, now remember, whenever question tells that I am going to dispose of certain risky securities, in that case just calculation of risk free amount is not sufficient. I should also tell in the risky securities how much securities I will be disposing and what is going to be my revised position. Tell me students, I am disposing certain risky securities. Total investment value was how much? 10 lakh. Now, yes, what is the value of risk free? It is going to be 3,33,333. That means what will be the revised value of risky securities? 6,66,666.66. Yes or no, everyone? Here I am having two securities, ABC, XYZ. Previously, in what ratio I had invested? 5 lakh, 5 lakh, 0.5, 0.5. That means now also they will be in the same ratio. That means the revised value of these securities is going to be 3,33,333, 3,33,333. Is this clear, everyone? Okay. Sometimes question will also ask you that, okay boss, how many shares I should be selling? Okay, simple. ABC is there, XYZ is there. Let me do it for ABC. Tell me, ABC, previously what was the total value of shares that I had invested in ABC? 5 lakh. Now afterwards, what is the revised value of shares? 3,33,333 only. So what is a reduction in the value? 1,66,666. Yes or no, everyone? What is the market price of one share? 50. So if I sell one share, I will get 50. If I want 1,66,666, how many shares I should be selling? 1,66,666 divided by 50, it is going to be 3,334 shares. Accordingly, I will do and finish it off. Is this clear, everyone? So with this, concept number 4 is also over. Is this clear, everyone? Then we are having concept number 5, sharp single index model. Not very important from the examination perspective. So in the last minute, right now I'm not doing it. Doesn't mean that you guys will not be doing it. Please revise it by yourselves. With this, unit number 2 is done over, my dear students. Is this clear, everyone? I myself know how difficult it is, how much I'm fainting when I'm doing this. Yes, everyone, let us proceed further to unit number 3, which is going to be miscellaneous areas. Small portions are there. In that, concept number 1 is APT, arbitrage pricing theory. It is just an extension of CAPM. In CAPM, we have told that investor wants risk-free. Plus, for the risk he is taking, he wants a premium. Yes or no, everyone? Yes. How much risk he is taking? It was denoted by beta. How much premium he want? I have denoted as RM minus RF. This is a premium. Yes. In APT, this itself is called as a lambda. Point number 1. So I can write it as RF plus beta into lambda. Now, in arbitrage pricing theory, yes, it is told that, boss, there are more than one factors which impact the return of a security. So, just considering beta is not sufficient. There are multiple factors. So, I am going to incorporate multiple factors. So, it is beta 1, lambda 1 plus beta 2, lambda 2 plus so on and so forth. Is this clear, everyone? It is called as multi-factor, two-factor model. Yes, it is based on multiple factors. So it is risk-free rate plus beta 1, lambda 1 plus beta 2, lambda 2 plus so on and so forth. Where beta 1, beta 2, beta 3. Yes, these are the sensitivity of different factors. Question will give you, okay, yes, the market return, yes, the inflation, the exchange rate fluctuation, etc., etc., etc. And lambda 1, lambda 2, lambda 3. These are the premium that I want. Is this clear, everyone? Okay, fine. Now, if lambda figure is given in the question, bingo, great, nothing like that. But if the lambda figure is not given in the question, how do we calculate? Yes, it is the surprise element. Say for example, I am expecting that inflation is going to be, say for example, 5%. It is already incorporated, adjusted. But in reality, my actual inflation is 7%. So what is the surprise element? 2%. That is the lambda. Is this clear? If factor risk premium lambda is not given, it is the actual value minus the expected value. Is this clear, everyone? Okay, fine. Now, yes, whenever we are calculating return of a portfolio, how all we can be calculating? Yes, either option number 1, formula is going to be the same only. Yes, either option number 1, suppose there are 3 securities. I want to calculate the, yes, return of the portfolio. Either step number 1, as per APT, I calculate the return of each of the securities. Okay, once I've calculated return of each of the securities, now I know return of the security, the weight, I will calculate the return of the portfolio. That is one approach. Is this clear, everyone? Okay, fine. Calculate return of each security as per APT. Based on that, calculate return of the portfolio. Okay. Or else, approach number 2, boss, yes, I can directly calculate beta of the portfolio. Yes, what is beta of the portfolio? It is nothing but weighted average of the beta. Yes or no, everyone? For each of the factor, I will calculate the weighted average beta. Once I've calculated the weighted average beta, then directly I will apply the formula. Accordingly, I can calculate. Is this clear, everyone? Calculate portfolio beta for each factor, which is a weighted average. Once I've calculated that, based on that, I can calculate the expected return of the portfolio. Is this clear, everyone? Okay. Quickly, let us come to our workbook. Have a look at, yes, 1 or 2 questions as well. Example questions based on APT, arbitrage pricing theory. Okay, look at this, everyone. Example number 27. Risk free is 8%. Yes, 3 factors are given: interest rate, inflation rates, GDP. Yes, how much premium I am demanding for that is given. The sensitivity beta is given. Yes or no, everyone? Okay. Yes, exchange rate is also given. Calculate the return as per APT. Tell me, without taking any risk. Yes, investor wants 8%. Plus, yes, interest rate fluctuation risk investor is taking. Yes, how much premium he wants? 3%. How much risk is there? 1.5 times. So it is 3 into 1.5. plus here it is 0.75 into 5, 0.75 into 5, yes, plus here it is 1.2 into 4 plus 1.2 into 4, plus below also one fact is there, yes, you do it accordingly, you will arrive at the expected return. Is this clear everyone? Okay, fine. Now example number 28, risk free rate is 8%. Okay, look at this everyone, factor 1 beta, factor 2 inflation, okay, security X, security Y, factor risk premium. Whenever data is given in the form of table, we should know to read and interpret what it is telling. For security X, now beta 1 is 1.2, yes, beta 2 is 0.9. For security Y, beta 1 is 0.6, beta 2 is 1.2. And what is the premium lambda for the first beta? It is 5%. What is the lambda for the second beta? 8%. Okay. Calculate expected return of each stock using APT. For security X, tell me 8%. Anyways, I want. Yes. First beta, how much it is? It is 1.2. Yes. Into the premium is 5. Plus the second beta for security X is 0.9. 0.9 into 1.2. Similarly, I can be doing for security Y as well. Is this clear everyone? Okay, fine. Now the second one is, suppose I invest 75% in X and 25% in Y. Okay, calculate factor 1 sensitivity to the portfolio. Tell me, I am creating a portfolio wherein I am investing 75% in X, 25% in Y. Yes or no everyone? Now tell me factor 1. I want to calculate the weighted average beta for the beta number 1. Is this clear everyone? How do I do? Tell me in security X how much I am putting 75%. So it is 1.2 into, yes, 1.2 is a, for security X I am putting only 75% into 0.75. Yes, for security Y, yes, it is 0.6, yes, into 0.25. Is this clear? That is the weighted average beta of the portfolio. Okay, similarly I can be doing for the second factor as well. Accordingly I can calculate the expected return. Look at this everyone. Yes, for the first one I did, for the second one I did. Now how do I calculate the return of the portfolio? Two approaches are there. Either approach number 1, I know the return of individual securities as per APT. Now just do a weighted average. Yes, X is giving me 21.2. I am putting only 75% into 0.75. Y is giving 20.6. I am putting 25% into 0.25. This way also I can do. Or else, boss, I know the weighted average beta. Yes or no everyone? Tell me as per APT. Yes, the return, it is risk free. Yes, I know. Plus beta 1, beta of the portfolio, I know. Yes, into lambda 1 is given. Okay, plus beta 2, beta of the portfolio, I know, into lambda 2 is given. Accordingly I will do both, are going to give me the same answer. Is this clear everyone? Okay, fine. Now this one also we have done. Suppose we want to create a portfolio in such a way that factor 1 sensitivity for the portfolio should be equal to 1. Factor 1 sensitivity should be equal to 1. Tell me, that means how much weight I should be investing in X and Y. Okay, boss, simple. How much I should invest? Okay, yes, factor 1 sensitivity to the portfolio, I will be considering factor 1. Tell me for security X how much it is? 1.2. How much percentage I am putting in X? I don't know, let me assume it as X. For security Y, it is a 0.6. Yes, how much is the weight? It is going to be, summation of the weight is 1, so it is going to be 1 minus X, should be equal to 1. Simplify, arrive at the value of X. Is this clear everyone? Okay, this question we have done. This was a very comprehensive, beautiful question, my dear students. Is this clear everyone? Okay, fine. Now yes, there is one more question. Look at this everyone. Yes, suppose a question is asking you to calculate the weights. Look at this everyone, calculation of weights. Okay, investor is having 1 lakh rupees of own fund. 1 lakh he is having. He sells a short 50,000. Short selling is there, wherein, okay, yes, we will sell the security right now, get the money, subsequently purchase it. Okay, he short sells 50,000 and purchases 1,50,000 of A. Tell me, I am having 1 lakh of my own money. I did a short sell of security, which one? B. So 50,000 extra I got. So total how much cash I am having? 150. So from that I purchase 1,50,000 of A. I have to calculate the weight. Very simple, students. Tell me in A total how much money I have put? 1,50,000 I invested, purchased. I am showing it as positive. In B, I did a short selling, so I am going to show it as negative. That means net how much is my money involved? 1 lakh rupees. If I have to calculate the weight, in A, I invested 1,50,000. Boss, only 1 lakh is my money. That means I have invested 150% of my money, 1.5. Yes, in B, it is going to be minus 0.5. Accordingly, I will arrive at 1. Is this clear, everyone? Okay. Based on this, also questions are there. You guys can try it by yourselves. Is this clear, everyone? Then we are having concept number 2, which is market line, wherein we are having equation of a straight line. Very simple thing from basics we've been learning. Y is equal to mx plus c. Yes, where, yes, c is the y intercept. In simple terms, it is the starting point of the line. M is the slope. Yes, x is the independent variable, y is the dependent variable. Yes, based on that we are having capital market line, security market line, characteristic line, not very important, you guys can see it once by yourselves. Yes, but boss, based on that there is one question which is calculation of minimum risk portfolio for three securities. Multiple times it has come in the examination. Quickly across 1 or 2 minutes, let us try discussing. Okay, investor is having two portfolios, both of them are in minimum variance set. Okay, fine. Three securities are there, A, B, C. Portfolio X weight is given, portfolio Y weight is given. Okay, now what is going to be weight of each stock for a portfolio constructed by investing 5000 in portfolio X? Tell me, in portfolio X I invested 5000 and 3000 in portfolio Y. Okay boss, tell me in portfolio X I invested 5000, A is 30%, so 5000 into 30 percentage 1500. Okay, yes, B is 40 percentage, that means it is going to be 2000. C is 30 percentage, that means it is going to be 1500. Yes, portfolio Y 3000 I'm investing in the 20 percentage in A 600, 50 percentage means 1500, 30 percentage means 900. So accordingly you add. Yes, look at this, I've done it here. Question number 54. Okay, fine. Accordingly you add, it is 2100, 3500, 2400. So total 8000. So accordingly I can calculate the weights. 2100 upon 8000 means 26.25 percentage. Accordingly we will do. Is this clear everyone? Okay, fine. Now comes the second one. Suppose investor is investing 4000 out of 8000 in security A. Investor is selling, boss, total 8000 I want to invest. Yes, in that 4000 I am putting it in A. Okay, fine boss, that means 50 percentage he is putting in A. Okay, fine. Now how will he allocate the balance between B and C in order to ensure that his portfolio is on a minimum variance set? This is a very beautiful thing, my dear students. Okay, now understand, in A how much I am putting? 50%. If I somehow get to know in B how much I am putting, C I can calculate as a balancing figure, yes or no everyone? So for C I need not worry. I need to now establish a relationship between A and B. Is this clear everyone? Okay, fine. Now I will use the equation of a straight line. Tell me, what is the equation of a straight line, my dear students? It is y is equal to mx plus c. Yes, now understand, I need to know which is the independent variable, which is the dependent variable. Here whichever value is given, that is the independent variable x. Tell me, weight of A is given, that means it is the independent variable. Yes, weight of B I need to calculate. Based on weight of A I am calculating weight of B, that means B is going to be my dependent variable. Is this clear everyone? Okay, fine. Now I will use the equation y is equal to mx plus c. Yes, what is the dependent variable? Weight of B is equal to m into x. What is independent variable? Weight of A plus c. Is this clear everyone? Okay, fine. Now for two different levels I know the values, yes or no everyone? Tell me, weight of A as well as weight of B I know for two different levels. Look at this. Yes, for portfolio X also I know weight of A, weight of B. Here also I know weight of A, weight of B. Yes, based on that I can create a simultaneous linear equation, solve, arrive at the value of M as well as C. Yes or no everyone? Tell me, in portfolio X, yes, Y is 0.4. 0.4 is equal to 0.3x plus C. 0.4 is equal to 0.3m plus C. Okay, here 0.5 is equal to 0.2m plus C. I will simplify accordingly. M is equal to -1, C is equal to 0.7. Now I will rewrite the equation. Yes, weight of B is equal to M into weight of A plus C. Okay boss, M is equal to -1 plus C is equal to 0.7. Now I want to know if weight of A is equal to 0.5, what is weight of B? So substitute weight of A is equal to 0.5, therefore weight of B is equal to 0.2. Is this clear everyone? Suppose a question comes, this is how we should be solving. Okay, weight of A is equal to 0.5, yes, weight of B is equal to 0.2, I think we got, therefore weight of C is equal to 0.3. Is this clear everyone? Okay, yes, in class I told you guys a very simple shortcut also through which we can be doing. Yes, right now not very important. Is this clear everyone? So with this, concept number 2 is also over. Now coming to concept number 3, yes, which is portfolio evaluation techniques. There are two different portfolio. Which portfolio is good for investment purpose? How do we evaluate the portfolio? Yes, three different ratios are there. First one is a Sharpe ratio. It is telling how much extra return we have generated for 1 unit of risk. Yes, it is the expected return minus risk-free return divided by sigma. Suppose risk-free rate is 10%, but my portfolio has given me 20%. That means tell me how much extra return it has given? 10%. Yes, but boss, is there a risk? Yes, boss. Suppose the risk standard deviation is 2%. So 10 divided by 2, it is going to be 5. Is this clear everyone? Sharpe ratio, expected return minus risk-free return divided by sigma. Okay. Now comes the next one, which is the trainer's ratio. Trainer ratio is telling, boss, Sharpe, you only told we should be considering beta. Why are you comparing? Yes, for 1 unit of sigma. calculated for 1 unit of beta. Yes, it is extra return, which is expected return minus risk-free return for 1 unit of systematic risk divided by beta. Is this clear, everyone? Jensen's alpha we have already discussed. It is telling how much extra return we are generating over the CAPM required return, which is expected return minus CAPM required return. Is this clear, everyone? Now here also I am telling how much extra return I am getting for 1 unit of risk. More return means better. Here also I'm telling how much extra return I'm getting for 1 unit of systematic risk. More means better. Here anyways I'm calculating the extra return. So the higher it is, the better it is. Till here the discussion is clear, yes or no, everyone? Perfect. Yes, everyone. Next we are having concept number 4, which is portfolio rebalancing techniques. Yes, in that first one is buy and hold strategy. That is, we purchase a set of securities. Don't do anything. Hold it as it is. Is this clear? Next one is constant ratio plan. Here we are telling we will try maintaining a constant ratio between my aggressive portfolio, which is shares, as well as defensive portfolio, which is bonds. Is this clear? Whenever there is a need for rebalancing, we try to bring back the constant ratio. Okay. Directly let us try seeing through an example. Pay attention, students. Yes, NAV per unit of an equity fund for 3 months is given below. Jan, Feb, March, NAV is given. Mr. X invests 1 lakh rupees equally in equity fund and bond at the start of January. That means he's investing 50,000, yes or no, everyone? Okay, 50,000 in equity we are investing. NAV per unit is 100. That means how many units he is purchasing? 50,000 divided by 100, some 500 something he is purchasing. Yes or no, everyone? Portfolio is rebalanced. Whenever NAV changes by 15%, so whenever there is a change in NAV by 15%, there is a need for rebalancing. Is this clear, everyone? Okay, when compared to the previous month. Okay, there is no income from bond, no transaction cost. You are required to calculate the value of portfolio at every month end as per constant ratio plan. Now, how do we do it? Institute's answer looks very messy. The same answer we have bifurcated stepwise. Step number 1, calculate the percentage change in price and determine if rebalancing is required. Tell me, students, every month I will write down the NAV. Okay, I will try seeing the percentage change from 100 to 115. 15 rupees has increased from 100, 15% it has changed. So if there is a change of 15%, we should rebalance. Rebalancing is required. Okay, from 115 to 98, it has fallen by 17. From 115, 14.7% only. Did it change by 15%? No. So whether rebalancing is required, rebalancing is not required. Is this clear? Step number 1, I will calculate the percentage change in NAV and see if rebalancing is required. Okay. Now step number 2, I will calculate the value of the portfolio as per constant ratio plan. Tell me, students, initially I would have invested 50,000. Now look at this. First I will write down the month. I will write down the NAV. Is this clear, everyone? I will write down the value of aggressive portfolio, that is a share or mutual fund. The value of conservative portfolio, that is bond. Then I will arrive at the total value if I will add. Okay, then I will tell whether rebalancing is required. Yes, I will write down how many units I have purchased. Tell me, students, January. What is the NAV? 100. Tell me total 1 lakh I'm investing. 50,000 in equity, 50,000 in debt. 50,000, 50,000 total is going to be 1 lakh. Tell me on that particular day, January, what is the NAV for 1 unit? 100. Tell me total 50,000 I'm investing in. Yes, mutual fund. That means how many units I'm purchasing? 500 units. Okay, now comes February. Tell me what happened to my NAV. NAV has become 115. Yes or no, everyone? Okay. So before rebalancing, what is happening? In the month of February, rebalancing is required. Before rebalancing, tell me 500 units are there. Every unit is at 115. So the total value is 57,500. Yes, there is going to be no change in the bond value. Is this clear? 50,000. So total value is 1,07,500. Yes or no, everyone? Okay, 500 units are there. This is before rebalancing. Now what is constant ratio plan telling? Whenever we are rebalancing, we will bring to the constant ratio. What is the constant ratio? Initially we had invested 50,000, sorry, 50%, 50%. So I have to maintain the same ratio. So I will tell 1,07,500 is there, boss. That I will maintain the constant ratio. Yes, 1:1. That means equity should be 53,750, debt should be 53,750. Is this clear, everyone? Okay. So what I should do? Yes, I should purchase debt instrument worth 3,750. Okay, and I should sell yes, equity, my aggressive portfolio worth from 57,500 to 53,750, 3,750. Okay, I have to sell today. Today, what is my NAV? 115. That means how many units I should sell? For 1 unit, 115. So 3,750 means how much? 3,750 divided by 115, 32.61 units. Okay, that means revised how many units will be there? 500 minus 32.61, 467.39 units. Okay, March. Tell me the month of March whether rebalancing is required, not required. So directly bingo, I can finish off. Yes or no, everyone? Yes, I will tell what is my NAV. It is going to be 98. So 467.39 into 98 gives me the value of, yes, aggressive aggressive portfolio, value of defensive portfolio, that is bond, is going to remain the same, gives me the total value of the portfolio. I will write down the number of units. Is this clear, everyone? Okay. Then we are having CPPI plan also, not very important till now, question has not come, so in the last day revision I'm not going to discuss it. Is this clear, everyone? So with this, our concept number 4 is also done over, my dear students. We are having the final concept number 5, which is going to be stock lending scheme. What is happening? Try understanding, students. Assume there is Mr. A who has purchased shares of Reliance. He wants to hold the share for long term, till his death he wants to hold. Okay, who is he? He is the investor. Okay, point number 1. Point number 2, there is Mr. B, yes, who did not purchase share of Reliance. He thinks that the share price of Reliance will fall in the coming few days. Okay, now he wants to make some gain. How can he make some gain? He can enter into a short sell. That is, today he will sell shares of Reliance. Suppose today shares of Reliance is at 1500 rupees. Yes, after 10 days, suppose he thinks that Reliance share price will fall to 1000 rupees. So today he sold at 1500. After 10 days, he'll purchase at 1000. He will make a profit of 500. Is this clear, everyone? Okay. So he is a short seller. He wants to sell share of Reliance. Tell me, students, I am having a pen. I purchased the pen. Can I sell? Yes, boss. I did not purchase the pen. Can I sell? Okay. I am having you are having your laptop. Can I sell your laptop? No, boss. But I can sell your laptop. When? If I can borrow your laptop for some days, now I can sell the laptop and subsequently I can give you a new laptop. Same concept is happening here. Now understand, Mr. A is there, he has purchased shares of Reliance, he want to hold it for the long term. Mr. B is there, he is just a short seller, trader. He thinks that the Reliance share price will fall down, so he just wants to sell now so that he can subsequently purchase. But boss, if he has to sell, means he should be having a share. Now what will happen is they both enter into stock lending scheme, wherein Mr. A will lend his shares of Reliance, lend, yes or no, his shares of Reliance for a few days against a fee. Yes or no, everyone? Mr. B is going to borrow the shares of Reliance for few days by paying a fee. This is going to be the concept. Is this clear, everyone? Mr. A is happy. Why? Anyways, he was planning to hold it for long term. He is getting some fee. Yes or no, everyone? Mr. B is also happy. Why? Because he thinks the share price will fall. So he can carry out the short selling and make a profit. Is this clear, everyone? Okay, fine. Till here the discussion is clear. Okay, fine. Point number 1. Okay, purchase shares of Reliance. Okay, lending arrangement they get into. Short selling. Yes, what borrower does? Yes, he borrows. Yes or no, everyone? The shares of Reliance. Okay, then after that he sells in the market. Subsequently, yes, after 10 days or 15 days, he has to repurchase the share and give it back to Mr. A. Is this clear, everyone? Okay, fine. Now what will happen? Why will Mr. A trust, yes, Mr. B? For that purpose he has to give a bank guarantee for safety purpose. Is this clear, everyone? Okay, final outcome, Mr. A is there who had purchased originally shares of Reliance. He is getting a lending fee. Yes, Mr. B is earning trading profit, yes or no, by short selling the shares. Okay, here what all questions will come? 3 different types of questions will be coming. Type 1 question is asking, calculate earnings of the lender through stock lending scheme. Who is the lender in this case? Mr. A is lending. Yes, when he is lending the share, what he is getting? Yes, he is getting the lending charge. So it is the lending charge per share into number of shares. Is this clear, everyone? Yes, if question asks, calculate the total earnings of the lender. Now he will be getting the lending charge also, and in that period if there is any dividend declared, he will be getting the dividend also. So it is a lending charge plus dividend gives me the total earning of the lender. I will be doing it on a per share as well as on a total basis. Is this clear, everyone? If question asks, calculate the profit or loss to the borrower. Yes, who is a borrower? Mr. B is a borrower. Yes, what is going to be the profit or loss? Tell me, why on earth did he, yes, try getting the share? Yes, he wanted to do a short selling. Yes, so he will be earning profit or loss on short sale of shares. Say for example, today Reliance share is at 1500 rupees. He sold at 1500. After a week, the share price came to 1000 rupees. He purchased at 1000 rupees. So he made a profit of 500. Yes or no, everyone? Yes, this could be profit also, loss also. But wait, boss, the entire amount doesn't go to him. He has to incur certain cost. What all cost? Firstly, he has to incur the lending fees to Mr. A. He has to pay the lending fees. Yes, point number 1. Point number 2, Mr. A doesn't randomly agree to give his share. He'll tell Majaa, give me a bank guarantee that you will return, or else if you run away with my share, what will I do? So he will be giving the bank guarantee. For that he'll be incurring the bank charges also. Yes, that gives me the net profit or loss to the borrower. Is this clear, everyone? Profit or loss on short sale of shares. From that, 2 costs will have to reduce. First one is the lending charges, second one is the bank charges. That gives the profit or loss to the borrower. Is this clear, everyone? So with this, the chapter portfolio management is done over, my dear students. Remember, this is a rocket revision for the last day revision before your examination. I can explain each of the things in the most beautiful way, in the most detailed way, but boss, we are not having time right now. Is this clear, everyone? Perfect. Yes, everyone. So, what all chapters we have covered till now? We have covered equity valuation, bond valuation, mergers, as well as portfolio. Now, tomorrow morning on YouTube, I will be uploading rocket revision for the chapter IRRM. Yes, very important. 10 to 12 marks every time has been coming in the examination. Okay. Now, one more chapter. I planned of doing it right now. Yes, which was the chapter of mutual fund as well as derivatives. Okay, but right now because of the throat, yes, I am literally not in a position to speak, my dear students. Now, mutual fund is a very important chapter, very small chapter. There are altogether 12 different types of questions. One of that only is coming, and every time in your examination, bare minimum 7 and most of the times 12 14 marks of questions have been coming. Okay, now on YouTube I've already uploaded a video, a 6-7 hours video on mutual funds. Yes, there are lots of breaks wherein every different type of question I've solved. Please do watch that. I really wanted to solve it. Yes, do it quickly with you guys, but I am really not in a position to do that. Please see that. Yes, if I have to tell you one chapter which is the most important for CA final, CMA final exam, it is mutual fund. Very small chapter, but every time 10 12 14 marks questions have been coming. Is this clear, everyone? Watch that. And mutual fund, whatever example questions are there, it's a solution in a very simplified way. I will do and upload on our Telegram group, which is going to be Think with Tabish. Okay, point number 2 is tomorrow morning. Yes, we will be uploading rocket revision of the chapter interest rate risk management. Yes, approximately 1.5 hours we will cover the entire chapter. Please do watch that as well. Is this clear, everyone? Now, that's it from my side for this particular video. I hope this has made value to you guys. Yes, you guys are going to give your examination in the next 2 days. Yes, have a clean mind. Don't unnecessarily mess up things. Okay, take a deep breath. Tell to yourself, I've prepared well. I will give my best shot. Is this clear? This is the last exam. Boss, know that this is going to be the biggest challenge. But boss, we are ready. We are warriors who are ready to face the war. Yes or no, everyone? Have that positivity within. Yes, go there. Boss, take a deep breath. Tell to yourself, this is going to be the best exam, the last exam. And yes, questions could be difficult. Some questions could be difficult, but you manage it based on whatever you know, you try. Okay, start with the questions you know. Yes, wherever you don't know, keep space, keep space, keep space. Yes, don't stay stuck in a question for a long time. Don't worry, everything will fall into place. Know that there will be 1 or 2 questions which are difficult, but there will be questions for which you know the answer as well. So our intention is to focus on those parts. And AFM is a paper, even if you solve 60 70 marks, 70 marks properly if you attempt, you will be getting 60 65. Is this clear, everyone? That's it. I hope this has made value to you guys. Yes, if you have loved means, boss, I would really appreciate. Yes, some of you guys would be seeing late in the night and all those things. I would really appreciate if you put your valuable comments. Tell that we are going to rock our CA final examination. If you guys are CMA final, write that we are going to put our 200% into the CMA final examination. Okay, yes, do let me know which place you are from, at what time you guys are watching the marathon as well. And if you guys want me to come up with any other videos, do inform me as well. And if you have loved this means, do share it to all your friends. Da. Just you're seeing you're clearing your examination, doesn't make sense. Do share it to all your friends. And if you have loved our work, yes, please do recommend our classes to your juniors as well. It would really mean a lot to us. That's it for this session. And so many resources I will be uploading on the Telegram group. Yes, please join our Telegram group, Think with Tabish. The detail is available in the description. Yes, so many resources will be uploading, and we are having a theory marathon. Yes, theory marathon as well as theory PDF is there. Theory marathon is there in YouTube. Yes, trust me, 20 marks of theory. Yes, in the simplest way. Yes, I will only ensure that you guys understand and remember. That much effort we have put in. If you're having time, please do watch it, or else the PDF is there in the Telegram group. Please have a look at that. Is this clear, everyone? That's it for this session. See you guys some other day for some other session. Until then, keep studying, keep smiling, keep working hard, keep making your parents proud, and see you some other day. Take care. Bye.